Caterpillar.com.
Welcome back, everybody. Caterpillar just reporting fourth quarter results. They came in with earnings on an adjusted basis of $5.23. That was much higher than the $4.75 that the street was anticipating. Also came in on revenue of $17.07 billion. That was about in line with the expectations. The company returned $7.5 billion through buybacks and dividends in 2023. You can see that stock right now up by about $2.20. That's a gain of 0.7%. Jim Umpleby, the CEO, just talking about how they are, remaining committed to executing the strategy. So they're proud of the team's achievements for this.
Tom, let's dig into the U.S. economy, some of Friday's hot jobs numbers, and some of the other big topics this morning. John O'Brien is here, Operation Hope founder, CEO, and chairman, and Active Strategic Advisors co-founder Mick Mulvaney, who served, of course, in the Trump administration as OMB director, White House Chief of Staff, and U.S. Special Envoy to Northern Ireland, joining us, both of you. I'm actually curious how both of you would look at the numbers and if there is any light between you. I would think that there might actually be, even though we can probably agree on the facts. John, what do you think?
Well, Mick's a reasonable guy. Even on his most unreasonable day, he's a reasonable guy. My very conservative friends have to admit the bones of the economy are actually pretty strong. Some of these numbers you haven't seen in 50 years, like the sustained unemployment rate. So it's really impressive. I think it beat the estimate of many people, the jobs report that's coming out by an economic yard. But we're still leaving many people in America without the rings on the ladder to climb up. So there's a little bit of frustration. You see that in our Hope report and the 4,000 people that we surveyed. There's still a bit of frustration, but there's a difference between the reality that the bones of the economy are solid, but also the perception that I can't grab a ladder and buy my home or start my business, or the debt, my personal debt's going up. And so people are hopeful, but they need hope with a business plan attached to it. It's one of the unlocks we have created at Operation Hope. But I'd love to hear Mick's obviously take on this, but my most conservative friends in the last couple of days have been like, actually sort of agree.
Mick, you agree with John this morning?
Yeah, I think he and I are pretty much on the same page, probably both economically and politically. Talk about the economics real quick. The numbers are fantastic. Keep in mind, I don't pay as close attention to the unemployment rate because of the impact of the labor participation. I look at the raw number of jobs created every single month. Anything over about 225 is a really good number. That's a good, solid, healthy, growing American economy, and they blew that number out of the water. There are even some big revisions looking back a couple of months that took some numbers up. That folks thought maybe were a little bit softer. So yeah, the numbers are probably even better than we expect. But John's right. For some reason, it's not getting to everybody, and let's switch over to the politics now. That's why I think the president's numbers still struggle. Is that folks don't eat GDP, right? They don't understand disinflation versus inflation. What they know is that it's more expensive to live. They can't afford to buy a house. They can't afford to save money, and that's having a political impact.
John, how do you explain it?
Folks got too much money at the end of their money, and there's more people who feel that way. 70% of this country living from paycheck to paycheck. If you're making $100,000 a year, half of those living from paycheck to paycheck. If you're making $250,000 a year, a quarter of those living, oddly enough, shockingly enough, from paycheck to paycheck. But if you don't feel you've got, you know what the programs are that allow you to become a homeowner, even in a place where interest rates have crept up a bit, and there are programs that allow you to get in, then you're frustrated. If you want to start a business and you want to have agency in your life, and you don't know about 1MBB, or the government hasn't, or the private sector hasn't given you tools. I mean, the fact that have a credit score, the lowest credit score in this country are Black Americans. And everybody knows that, when the rules are published and playing field is level, the arts, politics, entertainment, we kill it. Sports, Black folks will kill it. We succeed. But in capitalism, free enterprise, we've not been given the rule book, the memo. So have a Black folks credit scores below 620. Andrew, it means when we get up in the morning, we lock out of the free enterprise system. It's not just Black people. It's the folks, poor whites who are frustrated, who are now rioting at the ballot box. So everybody needs this unlock. And I think, oddly enough, you raise credit score to 100 points, Andrew. You change America. There's a line.
Hey, John, I want to get to Mick, but I have a different question, because I don't think I've gotten an opportunity to talk to you on the air in a very long time. specifically about what's happened to DEI as a part of ESG recently in the aftermath of the firing of Claudine Gay. And I think so many questions, and if you live on X or you follow everyone on Twitter, there's obviously a raging debate about whether some DEI programs and other things have gone too far. And given what you just said, I'm curious where you land today.
I mean, talking about a conversation that's on this part of silly season. I mean, this is absolutely ridiculous. This is actually where Mick and I are actually the same race. We're not black or white, red or blue, we're green. I mean, this is stupid. The most diverse the most profitable companies in America are diverse and inclusive. The most profitable regions in America are diverse and inclusive. California and New York, as an example. Atlanta, where I am in the South Coast. I mean, just blowing the doors off of the economy because we're arguing over who gets a contract, not what race you are, or what, these are stupid questions. Of course, diversity is good for America. Without immigrants, you wouldn't have this country. I think the majority of Nobel Peace Prize winners were immigrants. I mean, the immigrant debate, the DEI debate, we should try to figure out, forget the Super Bowl this Sunday, very important, but how do we get the best team on the court or on the field, which includes all of us, to get us some more green, so we're not speaking Mandarin in 10 years. We have got to figure out we're better together. That is the only answer. And 92% of America was white in 1952, 90%. Well, the majority, half of America is black and brown today. So we got to get black and brown people and poor whites suited up in the game.
Right.
I'll put it another way, Andrew. My rich friends eat my poor friends do better if only to stay rich. This is a ridiculous conversation. No one's losing. We're expanding the table and adding a chair.
Mick?
Goodness gracious, where do you start with that? Listen, I love John Hope Bryan in the morning. It makes me feel better about being an American. We can have a long discussion, Andrew, about DEI. It's actually, John mentioned a couple times diversity and inclusivity. The thing that has always worried me about DEI is the equity, because I don't know what it is. I know what equality is. I know what the law means when it's supposed to be equal. Equity might mean different things to different people, and that sort of bugs me. The thing that worries me is that as long as DEI treats white conservative men and black women the same as they do if they're liberal, then I'm good with it. But I've always wondered if DEI sort of bent towards the more liberal political leanings. But again, that's a longer discussion for another day.
Mick, real quick, this one's also longer for discussion for another day. If a deal is reached on the border, Ukraine and Israel this week, and I don't know whether you think there's even a shot at it, is that bad for former President Trump? And there's such a view that he doesn't want this to happen. I don't know if you agree or disagree with that. Is it good for President Biden?
Listen, the whole idea of one party in Washington not wanting to give the other party a win in an election year is not new. We did it to Barack Obama. They did it to Donald Trump when I was in the White House. That's not new. So I don't think that factors in. What I think factors in is not the politics of the next election, but the politics of this particular bill. The dollars just keep going up. It went from 100 billion to what, 118 billion. It still sets a threshold, I think, of 4,000 people crossing a day. So that's more than 1 million Americans every single day or every single year coming over illegally. That's going to be the problem with the bill, as much as the politics of the 2024 election. No, I do not think it has a chance to pass.
It is a longer conversation, gentlemen. John and Mick, want to thank you. Appreciate it. Look forward to seeing you again soon. You bet. Squawk Box coming right back.
ambitiously.
Welcome back to Squawk Box. Just Capital releasing its 2024 list of 100 most just companies in America this morning. CNBC is Just Capital's media partner, and we have the exclusive launch of that list. Our Brandon Gomez is here, joins us on set to discuss some of the key issues on the list. What do we have?
Yeah, that's right, Andrew. Look, we combed through the data, and here's what we found. This year, Just Capital is once again recognizing companies that are doing right by 5 key stakeholder groups. Now, that's workers, communities, shareholders and governance, customers, and the environment. And Just Capital collected over 230 raw data points around 20 key issues identified by the American public as priorities in conducting what they call just business behavior. Now, this is key. Across every demographic, regardless of political affiliation, race, gender, age, or income, Americans were united in wanting companies to prioritize workers the most. Key issues like paying a fair and living wage and to create jobs in the U.S. Now, of the 937 companies in the Russell 1000, Micron, AMD, Elevance Health, and Cigna rounding out the top 10. Ecolab I hold off on noting because this is the first time a company from the chemicals industry has been included in the top 10. But leading the pack again this year, heavy in tech and financials, Citigroup, Intel, Accenture among the top 5. Most just companies. Bank of America, which ranked #1 last year, #2 this year. And for the first time after 6 years being in the top 100 America's most just company is HPE. Now, that's because it's leading on environmental impact issues, providing apprenticeship programs for people with resume gaps, such as caregivers or formerly incarcerated individuals, and ensuring both women and people of color earn 100% of what similarly ranked peers earn. Now, for the full list, you can go to cnbc.com/just-100. Andrew.
I have a bunch of questions, and we're going to be able to talk to Paul Tudor Jones and others a little bit later about this. But let me ask you, what sectors led the list? But before we even get there, just just a metric question.
Sure.
Given the political shifts in the conversation, we talked about DEI and ESG and all these things, which really do factor into this, so they don't use those phrases specifically. Did that change the list, you think, this year?
Yeah, so and I heard you talking to John Hope, Brian, about that issue too, and I think the core issue remains the same, right? What he was saying, it's about green. And so when you see these stock performance of these companies that are leading on these DEI issues, you can actually see that they're outpacing the broader Russell 1000 equal weight. I think that obviously companies are trying to figure out how to sort of have this conversation and how to shift the way that they're having the conversation. But you're seeing, in terms of market performance, the companies that are leading on these DEI issues are also still performing.
What sectors perform the best?
Banks, a little bit of a pullback this year, I will say first, although it's because other sectors are catching up, not because they're doing worse. Semis, in fact, leading now again, just because of more disclosure. And
in terms of how folks on a market-based approach, sort of peer-to-peer, how did everybody line up?
So I mean, when you're looking at companies that are rising, it's the ones that, again, that keyword, disclosure. AI also a big issue this year in terms of disclosure. Companies, most of them having their privacy policies within 3 clicks of their homepage, things like that. These issues remain the same, but again, for another consecutive year, paying a fair and living wage remains the #1 issue.
What about just the idea of your business practices at all? How do they measure that? I'm just looking through Cigna and claims denials charges with this new PXDX tool that they have, where doctors look at claims for 1.2 seconds and then deny them using this tool.
Yeah, I mean, so they're looking at companies. I mean, take Microsoft for example, right? So you have a company where that used to rank very highly, and now because of a FTC fine in the last year, the company drops. So annually, the rankings are shifting based on business practices and how the companies are adjusting. But then also you have to look at when companies acquire another company. Microsoft, a perfect example of that there. Activision Blizzard, when that conversation was happening, it actually dragged back the company because Activision didn't rank as highly on the Just 100 list. So those are adjustments that can be made throughout the year.
Thank you, Brandon. Appreciate it. As we mentioned, coming up later in the show, we were going to talk to Paul Tudor Jones and HPE's CEO right here on the broadcast. Squawk Box coming right back after this.
of the trial.
Still to come this morning, McDonald's set to report. We will bring you those numbers and the instant market reaction straight ahead. Squawk Box will be right back.
Happening.
Good morning, everybody. Fed Chair Jay Powell telling 60 Minutes the Fed is wary of cutting rates.
We want to see more evidence that inflation is moving sustainably down to 2%. We have some confidence in that. Our confidence is rising. We just want some more confidence before we take that very important step of beginning to cut interest rates.
We'll get reaction to those comments and talk markets with Neuberger Berman's Steve Eisman. Plus, Dow component McDonald's set to report. We will get the numbers and the market reaction. And tensions rising in the Middle East after retaliatory strikes on Houthi positions by the U.S. and the U.K. The latest from the region and what's next is straight ahead. The second hour of Squawk Box begins right now.
Good morning and welcome back to Squawk Box right here on CNBC. We're live at the NASDAQ market site in Times Square. I'm Andrew Ross Sorkin along with Becky Quick and Joe Kernan on this Monday morning. Let's show you where the futures stand after maybe Jay Powell might have talked things down a little bit on 60 Minutes last night. The Dow looks like it would open off about 12 points, the NASDAQ off about 27 points. We're looking at the S&P 500 right now. If we open now, down about 10 points, but of course we've got still about 2.5 hours to go. A couple of Dow components reporting, including this one. McDonald's just crossing the wires. And CNBC's Kate Rogers joins us now with those numbers. Good morning, Kate.
Good morning, Andrew. So this is a mixed quarter for the fast food giant. For Q4, EPS a beat at $2.95 adjusted versus estimates of $2.82. Revenues coming in at a very slight miss, $6.41 billion versus estimates of $6.45 billion. Comps coming in below estimates in all segments, globally up 3.4% versus estimates of up 4.7%. In its U.S. market, comps were up 4.3%. That is just below estimates of up 4.4%. The company said strong average check growth driven by strategic menu price increases drove its performance. McDonald's also pointed to effective menu and marketing campaigns like Kerwin Frost McNugget Buddies and Squishmallows doing well in the quarter. International developmental license market saw sales increase by 0.7%. That's far below the projected increase of up 5%. The segment did have positive comps in all geographic locations with the exception of the Middle East, which was impacted by the war, as CEO Chris Kempczinski had warned of last month. And its international operated market sales increased 4.4%. That's also lower than the 5.1% increase projected. The performance had strong comps in most markets led by the UK, but it did have some negative comps in France. McDonald's also reported its full year results this morning with global comps up 9% for 2023 and up over 30% since 2019. The stock is up just fractionally year to date. Kempczinski saying in the release, quote, "By evolving the way we work across the system, we remain confident in the resilience of our business amid macro challenges that will persist in 2024. Back over to you guys.
Okay, Kate, thank you very, very much. We'll keep our eyes on that. That stock, as we just mentioned, down about 1%.
Yeah, it is down. Fed Chair Jay Powell says investors are going to have to wait beyond March for an interest rate cut. Joining us to talk about the markets and the Fed, Steve Eisman, Senior Portfolio Manager at Neuberger Berman. Since last time you were on, Steve, and welcome. It's good to see you. We have seen surprising strength across the board, it seems like. And I wonder whether you can just give us your view, just flying at 30,000 feet, what exactly is happening in the economy? Is it organic? Is it illusory for
I think the answer to your question is no one frickin' knows. And everybody who comes on the show doesn't know. Right. And every economist whom I respect are saying there's about to be a recession because the Fed raises rates, but then they'll admit there isn't a single data point that's pointing to that happening. I don't know. You know, all I can say is that 70% of the U.S. economy is consumer-driven. The consumer seems to be pretty strong. They still have savings. They're spending money. So, you know, why everybody's getting so hysterical, I don't get it. Everybody should just wait. When there'll be a negative data point, we could talk about it. Until then, it seems to me the economy is just fine.
I've seen, and just looking for all the people that were expecting this not to happen, there's a lot of excuses for why it's happening. I've heard a lot of the jobs created are temporary jobs or second jobs. I've heard. I've heard that there's a lot of government jobs.
Listen, in my business, when you're wrong, you're wrong.
Yeah.
You know, but you see it on a screen. You know, economists can pretend till they're dead that eventually they'll be right. Like the people who say that for 40 years the deficit's going to crush us. They've been arguing it for 40 years. Maybe it will, but it's 40 years is a long time. So all I know is that the data is fine. Credit quality in the banks. You know, Capital One, the CEO of Capital One got on and said he thinks delinquencies are actually going to start to go down in the second half of this year. So until somebody can give me an actual data point that says that things are bad,
is it
fine.
possible any of it is Keynesian largesse?
It certainly is. It's certainly possible, but you don't see the government stop spending, do you? I mean,
no.
The $1.2 trillion
so we can count on that. But
that I've spoken on is just starting.
That all makes me think we're going to be back to MMT works. So why not do it?
You know, that's way above my pay grade.
You know what I mean, though.
I know what you're saying, but I don't have an answer for that.
Yeah, it's a free lunch. Is there anything organic, anything good happening? And productivity seems to be better. Organically, I mean good. A lot of good things happening, but is it organically good because of productivity rising for something that economists miss? Everybody missed it.
Honestly, I don't know. I just know the data's fine, and I don't try and go too much
Where
beyond
would
that.
the first signs show up? Because you do hear areas where they think it's a recession, whether that be in commercial real estate, whether that be...
Well, but commercial real estate's been bad for a couple of years now.
But where would you look if the consumers are
the problem is that commercial real estate is not big enough. Let me rephrase. office real estate is not big enough to have a real big negative impact on the economy.
Consumer goods sales have been weaker in some areas too. Where would you look for things?
I look at credit. You know, if consumer credit quality were to start to really deteriorate, like it started in late 2006, okay. But you know, until then, as long as the consumer is healthy, I don't think there's much to really talk about.
Does it scare you that you're not more skeptical at this particular moment, given your history?
Well, I said this on one of your sister shows last week, which is, you know, I don't really short stocks anymore. I'm long only. And the line that I used was, I was born Jewish, but I've converted to long only. I thought that was a pretty good line. And look, I just don't, I'm very data driven. If you were to tell me that there was a real pocket of credit quality that was starting to deteriorate, I would pay attention. As long as credit quality is fine, it's fine. I mean, you're going to have pockets of problem. Look at NYCB last week. That was pretty bad.
Right.
But that was NYCB because they passed the 100 billion threshold, and the regulators were all over them and forced them to increase their liquidity and increase their reserves. But is that a harbinger of future bad things happening in office real estate? Maybe, but it's confined to office real estate.
But for NYCB, it wasn't just the regulators. It was the regulators, but it was also...
And they had charge-offs.
They had charge-offs.
But again, office real estate.
Yeah.
Office real estate is confined to certain community banks and regional banks. It's not a big bank problem. It's a CMBS problem, but that's investors will have losses. I just don't see a systemic or big problem at this point that's going to hurt the economy.
We were talking earlier about the inverted yield curve and how long it takes for a recession, and it's Super Bowl week, and I don't even know which team I'm supposed to, because I know it doesn't work, I don't even remember whether it was the NFC or the AFC team.
It's an original NFC team. If they win, the market goes up.
Right, we stop following it because it doesn't work.
Right.
Can we throw the inverted yield curves happens here, recession? Can we throw that on the trash sheet?
I don't think you can throw the inverted yield curve on the ash heap of history. However, because this is such a strange period, post-pandemic, all the stuff that's happened, I don't think necessarily you can pull out your old rules this time.
Can you explain why the market has handled it so well that we're not getting 7 rate cuts starting next month? I mean, we were counting on that. We were set up for that. It's obviously not going to happen now, and we're still trading higher.
Because earnings are coming through pretty good. So, you know, look, at the end of the day, it's earnings that matter. It's earnings that matter.
The multiple can stay the same.
And the earnings go up.
And the earnings go up, so you just do...
So, look, if we were in a situation where the Fed said they were not going to cut rates, and this was a very bad earnings season, then you'd have a problem. But
do you think the Fed's still going to cut?
You know, I think the Fed has I find an amusing communication problem, which is that by very nature, they are unbelievably dovish. They know they can't be dovish, but they just can't help themselves. So last year when they had the dots, the dots were pointing to 6 rate cuts, I don't know how serious they were about those dots, but they're very insensitive to how badly the market wants free money. So then the market took off, and then Powell comes out and basically says, well, we really didn't need it.
It's not a communications problem as much as a Fed dots plot. Like, it's a stupid prediction tool.
Yeah, but they know how seriously people take it. If you know how seriously people take it, don't be so liberal in your dots.
But it's just that every time we hear communication from Jay Powell or anybody else, they basically say, cuts aren't coming, the cuts aren't coming. And
then they do dots.
So stop with the dots.
Stop with the dots.
Yeah.
Do you ascribe anything to the Fed? Maybe would they err on the side of ease because of an election year? They like to keep, you know, everybody wants to stay in power.
I don't put much stock in that. I actually think deep down, Powell is petrified of redoing Volcker again. And so I mean, put it this way. They've engineered what looks to be a soft landing. Inflation is coming down. The economy is still strong. Why would you waste rate cuts now and risk a resurgence of inflation when you really, all you really need to do is declare victory and say we engineered something really pretty fantastic, And we'll wait to see some data. If the economy really starts to weaken, we'll hold that in reserve. Until then, we'll just leave things the way they are. They seem to be pretty good. What's the matter with that?
We had wage gains that are pretty strong, that could be worrisome in terms of maybe the inflation, bugaboo is not gone completely and could come back.
Well, look, if I was the Fed, I would say, look, if wages are very strong, that's a risk. That's what we're afraid of. So we're not in any rush to cut rates. Eventually, look, the general direction eventually will be rates will go down.
You think inflation's under control, though?
As of now, that's what the data says. So we might argue with it.
Okay. All right. If I had to summarize what you just said, would it be
Optimism.
No, it would be nobody knows diddly about what's really going to happen.
No, I would say I'd go stronger than that.
In what way?
I'm saying
Because he was negative one time when something really bad happened, and now he's not. So
everybody always expects me to come on a show like this and basically predict the end of the world. And you know what? The end of the world wasn't much fun. I'm not in any rush to predict the end of the world again.
I appreciate that you're calm, cool, and collected, and that you're really just looking at the data.
But you don't think anyone can predict anything?
I wouldn't go that far. I would,
I
would just say that this time around, there's so many different things that have happened that are so unique. It's very difficult to put something into your model and make a prediction.
All right, Steve.
Thank you.
When we come back, a look at the oil market amid rising tensions in the Middle East. And then former OpenAI board member and Texas Congressman Will Hurd will join us to talk about the potential risks of artificial intelligence. Squawk Box will be right back. Despite the prospects of an escalation in the Middle East conflict, oil prices actually ended last week down by 7%. Joining us right now with more on the energy sector is Don Stroyan. He is Goldman Sachs head of oil research. And Don, what's happening? The reason that we've seen prices not only do well, but actually come down in the midst of this Middle East crisis?
Yeah, great. Thanks for having me. So really two factors. The geopolitical risk premium priced in oil prices is pretty modest, despite all the uncertainty. And second, I think there are some other factors that have been weighing on oil prices over the last couple of weeks, including higher US rates and a stronger dollar and fears about China demand. And so the question is, why is the geopolitical risk premium priced in crude so modest at the moment? And I think it has to do with the fact that the level of supply disruptions in the crude upstream market remains quite modest, a big difference with shipping markets, for instance. And then second, there is quite a lot of spare capacity that could be deployed if we were to see more meaningful crude supply disruptions.
I mean, a big part of it is the supply situation. The United States has produced much more and really stepped things up. So have a few other areas, like Guyana.
Right. Yeah, that's right. We think that the story of oil markets last year and also this year is demand is pretty firm, coming in higher than expected, but non-OPEC supply is also quite strong and exceeding expectations. And we think that will also be the story this year, although to a lesser extent. We expect demand growth to moderate as the China reopening boom is behind us. And we also think that US supply growth and supply growth from some of the sanctioned producers like Iran will moderate in 2024.
People look at the situation in the Middle East and wonder if we can get back to a 1970s oil embargo sort of a setup where you see massive inflation, shortages that come through. Is that even possible in today's world?
Yeah, so it's obviously hard to predict geopolitical outcomes. Our base case is that Brent will remain in a 70 to 90 range because high spare capacity limits the upside and solid demand. And the OPEC put limited downside. That said, because the geopolitical risk premium is so modest, in other words, the cost of insuring against big spikes is small, and because we still have wars in the Middle East and Russia, we still see value in oil as sort of a hedge against this unlikely, but still very meaningful tail scenarios where prices could spike. For instance, in the case of a closure of the Strait of Hormuz, prices would probably double, could rise 20% in the first month and perhaps eventually double if it were prolonged. Not likely, but we think it's worth insuring against these tail risks.
Look, part of it is that politicians may have learned something from those embargoes last time around too. The American administration, the Biden administration, has said that they're sanctioning Russian oil, but they turn a blind eye when that oil is shipped elsewhere because they don't want gas prices to go up at home and to face that sort of political pressure.
Yes, so I think that the energy crisis of 2022 has indeed triggered a political supply response where, for instance, the US administration introduced a price cap which aims to keep Russian barrels in the market while lowering revenues for Russia. We've also seen increases in supply from places such as Iran and Venezuela over that period. And so I do think that policymakers have been very focused on bringing down headline and core inflation and have been pretty successful so far. That said, the uncertainty on the geopolitical front remains very elevated.
As long as you see crude oil prices, I guess you're following Brent more closely, but in that $70 to $90 range that you're forecasting, it still is profitable enough to make it worth the while of either nation states or big oil companies to continue to produce.
Yes, that's right.
If you were to see a collapse in prices, it'd be a different story.
Yeah, that's why we think that in most geopolitical and macroeconomic scenarios, we will be in this what we have called the 70 to 90 OPEC range, which sort of works for OPEC countries, which works for US shale producers, and therefore we think it's an equilibrium.
Anything that would throw you off, it's always the thing we don't know that sneaks up and catches us. Where are you looking for those unknowns?
Yeah, what breaks you out of the 70 to 90 range, right? I think to the upside, geopolitical shocks that prevent OPEC from deploying its spare capacity. Because yes, there's a lot of spare capacity, but it's all concentrated in a few countries, such as Saudi Arabia and the UAE. And so if you were to see a geopolitical shock that prevents them from deploying that spare capacity for physical or political reasons, that could create a lot of upside. In terms of the downside, I really think you have to see a combination of much weaker demand and a shift in the Saudi strategy for prices to drop sort of below 70 on a sustained basis. And we think that probability is quite low. We think that OPEC Plus is very committed to keeping prices above 70.
Big picture question, is there such a thing as peak oil? And when would you say we hit it? If we need this, if we need 15% more than what we have now in 2050, is that left in the ground?
So, there's definitely a lot of oil left in the ground. It all depends on where prices go, right? If you need more production, prices just need to rise.
I'm just talking in a scientific way. How much is Malthusian bets have never worked. We ran out of stones. We run out of stones. That's not what ended the Stone Age. Yeah. We never ran out of stone. Will we ever run out? Would you run out? Could we deplete it to where there was zero left?
No, we don't. We think that's unlikely. If you just look at the reserve life right now, basically you have 16 years of oil left under current technologies and current prices. But technology is likely to improve, and prices could also rise. If the market needs it.
Amazing.
Don, thank you very much.
Thanks a lot.
Coming up right after this, we're going to look at some of the pre-market movers this Monday morning. Take a look at futures. Still got about a little over 2 hours to go before we open. But right now, we would open down on the Dow, off about 16 points. NASDAQ marginally up, just about a point there. S&P 500 off about 5 points. Squawk Box coming right back after this.
NBC.
Welcome back to Squawk Box. I'm Dominic Chu. Let's get you caught up on some of the movers that we're seeing right now pre-market. Let's start off with what's happening overall with Caterpillar shares, which are currently, you can see here, just up about 4.5% pre-market. The heavy equipment maker is just up around 45,000 shares of volume. Earnings per share here look like they beat consensus estimates, but there's still some analysis going on about whether there's comparability to those estimates. Revenues were a slight miss, though. CAT was helped in large part by strength in the North American market, where things like infrastructure and construction spending remain robust. That helped offset weakness in other parts of the world. It also gave a current quarter and full year guidance for certain metrics that imply similar growth year over year. So on balance, Caterpillar shares helping the Dow out up about 4%. That's off the pre-market highs. We're also getting some news on another Dow component, and that's Boeing. Those shares are lower ref now by just by about 2%. On 50,000 shares of volume. We're also going to show you Spirit Aerosystems as well, which is down 3% on just around 5,000 shares of volume. Boeing said it found more possible manufacturing mistakes with drilled holes in fuselages for roughly 50 yet undelivered 737 MAX model jets. Those fuselages were made by Boeing contractor Spirit Aerosystems. Now, a Spirit Aero spokesperson said that they are aware of the issue, are in touch with Boeing about it. So, again, Boeing and Spirit both down on that bit of news. And we'll cap things off with a check on shares of Meta Platforms, which are relatively stable in trading so far. 180,000 shares of volume following on Friday's massive 20% run on the heels of a better earnings report, the announcement of a dividend payment alongside a new buyback program. That move, by the way, on Friday added roughly over $200 billion to the Facebook, Instagram, and WhatsApp parent company, pushing it further higher into that $1 trillion market cap club. So, Joe, Meta Platforms down fractionally, but you can't blame them after you're up 20% in one day, Joe.
Yeah, you're right. All right, Tom, so you're watching. The tournament's going to end today. That's the way, when you talk Pebble Beach, that's a given, as you know. We know that. That's one of the charms of the tournament.
Charms.
One of the charms of the trying to make it through Spyglass where you can barely walk because it's waterlogged. But can I just say one thing, Dom, in case you were wondering?
Yes.
And it's going to complete today, and it's 48 out of the top 50, only 80 total, which is half of what it used to be. It's head and shoulders in terms of being a true premier event. AT&T and the PGA have done unbelievable things. And they've even weeded out the crappy amateurs, except for me. So
I also saw who you were playing with, by the way. That was a headline in and of itself.
The pressure on a 20-year-old kid, I can't even, and not only that.
In your first ever pro tournament, yes.
Right. And after, you play those courses down in the desert, and they're great. I love them, PGA West. But if he hasn't been on Pebble before, the wind and just the intimidation factor. I don't know how, like Wyndham Clark to shoot 60 at Pebble Beach, I have no concept of that. But to have that hit you in the face in your first pro tournament, he performed pretty well, believe it or not. But it's just everything's great. Wasn't it, Becky? Everything's great. Great.
Yeah.
The weather was
it was beautiful. You get a little bit of sun and you're happy.
Well,
right, a little bit of sun.
So, Joe, can you clarify something for me? Because, I'm a sports fan, you are as well. You were involved, so you're going to know better than me. My understanding was that they cut it off, shortened. So it's only 3 days, and that the tournament is over.
I didn't even see that.
And
I thought
that two things.
Yeah, that must have happened
At
after
5 a.m., they were still saying it was going to be potentially.
Oh, is it raining again out there?
5:30, I heard a different story.
Oh, I didn't even.
So I don't know what the.
I didn't see that.
Final call was.
No, then you're more current than I am.
I'm going to go look it up, but I'm pretty sure that they declared Wyndham Clark the winner. Of a short.
I heard that at 5:45 or something, but literally 15 minutes earlier, they were still saying it was going to be played out. Maybe they called it on the weather.
I'll tell you what, seeing the weather out there and seeing what the atmospheric river or whatever it is doing to Southern California right now, I don't blame them for. Yeah, exactly. So.
Okay. Hey, news you can use. Even I should watch Squawk Box to get some of this information. Thanks.
You got it, guys.
Yeah.
When we come back, Will Hurd, former OpenAI board member and congressman from Texas, will join us to talk about the potential risks of AI, also the opportunity that the technology provides. And in the next hour, an exclusive interview with investor Paul Tudor Jones and the CEO of Hewlett-Packard Enterprise, Antonio Neri. They'll be joining us together. Squawk Box will be right back.
Gert.com.
Welcome back to Squawk. In a recent op-ed, former OpenAI board member Will Hurd recalls the first time he felt, quote, freaked out by a board briefing and realized the real power of artificial intelligence and the oversight it would need. He writes, quote, just like a company needs a permit to build a nuclear power plant or a parking lot, powerful AI models should need to obtain a permit too. Joining us right now is former U.S. Congressman Will Hurd. Good morning to you. A lot of folks have been talking about wanting to regulate tech for a long time, big tech, social media, and now AI. Virtually none of it's actually happened in practice. Some people say it's because we don't have the technical know-how to do it. Some people say it's too complicated. Some say the technology is moving too fast. What do you say?
I think I agree with all the above. However, it's something that we should do. I equate artificial intelligence, specifically artificial general intelligence, with nuclear fission. Right? Nuclear fission control gives you limitless clean energy. Uncontrolled nuclear fission gives you nuclear weapons. And I think that's an equivalent analogy when it comes to artificial intelligence. And we should learn from the past. We have a $10 trillion cybersecurity industry, one that I was involved in because we didn't have product liability applied to software. We've seen and we know what social media is doing, leading young teenage girls to increase self-harm. We shouldn't allow that. Part of the reason was because we carved it out, the Communications and Decency Act. Let's not do that with AI. And to me, I think the first, some of the legislation we should do is very simple. Just make sure AI follows the law, follow existing laws. We have a lot of great laws about civil liberties and civil rights and protecting people. Let's make sure that these tools continue to do that. And
so what are the laws, though, that you're worried right now that AI is not complying with? Are we talking about privacy laws? Are we talking about copyright laws? And that's a huge component part of this. What is the piece of it that you're looking at specifically?
I'm more concerned about the implementation of these tools to impact individuals. Let's say a bank starts using AI to make decisions on how to give out loans. I want to make sure that if the bank uses the tool incorrectly and they discriminate against somebody because of their color or their skin, then that bank is liable. However, if the algorithm itself creates that bias, then developers of that algorithm should be held accountable. So for me,
and you don't believe that the law would allow for that now? If we were to bring a lawsuit against a bank that did that, and then turn around and also bring a separate lawsuit against OpenAI, if that was the underlying algorithm, I mean, whoever you think is developing the algorithm, sure. You don't think that they'd be held liable?
It's unclear, and that's why you're seeing a patchwork set of laws that are happening at cities and at states in order to ensure that type of thing it happens, right? And so I also want to make sure that we see really powerful AI, and that term needs to be defined, that it goes through some kind of review. Like I said in the op-ed, if you and I wanted to create a parking lot, we would need to get a permit.
Right.
And so really powerful AI, we need to make sure that an entity like NIST, the National Institute of Standards and Technology, is ensuring that the machine learning models have been tested to ensure the outcomes that they say they're supposed to, that some of these algorithms have been red teamed, that we're looking at the data that is being trained, the audibility of the programs. And so that's something, that kind of review should be done quickly, right? And we should establish a standard of what that is. So if you're going to say, hey, Will, you like these shoes, and I'm going to give you an algorithm to put, increase my sales, I'm not concerned about that. But anything that is about delivering services to individuals,
right.
Like banking loans and such, we should have that review.
Hey, well, let me ask you a different question, which is the AI industry, really led by Sam Altman, arguably somebody you worked with, obviously. It's very unique in that it's one of the few industries, and Sam's been very outspoken to say, please come regulate us. We need regulation. Very rare where sort of out of the gate a startup says, we've got a problem, this could be terrible for the world, come regulate us. My question to you is that genuine? is that a sop to Washington and to the public with the expectation, knowing that Washington will never regulate, and therefore the company looks good for raising these issues? So if in fact there's a problem later, they can say, look, I asked for this. What do you think is really happening here?
Look, it's absolutely true. That is something that Sam believes, and I think that's one of the reasons that people view Sam Altman as the Albert Einstein of our generation, of our times. I can tell you, when my time on the board was that safety and making sure that these tools were going to better humanity was a significant concern, and was the company and the board a lot of the attention when it comes to that. So this is, I think people always want to ascribe certain things to Sam, but he says what he believes. And so it's not just Sam, it's the great company him and Greg Brockman have built, and every person I interacted with in the company believes in developing these tools the right way, and it's something that is baked into the daily activities of the company.
Will, we want to thank you. It is a very worthwhile read, so go check out your op-ed. It really does sort of walk through and explain perhaps how all of this can be regulated and thought about in a meaningful way. Thank you again, Will. Nice to see you.
Coming up, we're going to talk McDonald's results in the fast food industry, and check out the shares of Estee Lauder up sharply after the company said it's going to expand job cuts to include 3 to 5% of its workforce. It said the restructuring program will boost profits. At the same time, the company's cutting its full-year earnings forecast, citing a slower recovery of its business in China, up 15% on the job cuts, though. But look, it's been a long, nasty decline in the shares. Squawk Box will be right back.
Jones. All right, welcome back, everybody. McDonald's reporting results a short time ago. Earnings per share was a beat, $2.95 versus estimates of $2.82. Revenue, a very slight miss at about $6.41 billion versus estimates of $6.45 billion. Stock is up right now by about 45 cents. Joining us right now is Andy Barish, Jefferies equities analyst. And Andy, what did you see in this report that you liked, that you didn't like?
Yeah, good morning, thanks. It's kind of steady as she goes. There was a little bit of the revenue softness from some of the challenges around the world, particularly in the Middle East. But otherwise, a pretty straightforward quarter with a little bit better operating margins to drive the upside here.
Yeah, price increases, one of the things helping out McDonald's bottom line, some of the menu promotions that they have too. That does show that the McDonald's customer, I guess, is pretty resilient.
Yeah, I would say promotions have certainly picked up. Pricing is normalizing, but you have to be pretty sharp right now in terms of promotional activity. A lot of that, though, is done through digital formats in the app these days, which I think at least allows the company to get more data and continue to expand its loyalty program. But yeah, it's tough. It's tough driving traffic overall in the category. But McDonald's is usually the one in QSR that tends to take share in good times and also when things get a little bit more challenging out there.
The situation in the Middle East, this is pretty similar to what we heard from Starbucks last week. McDonald's saying that the war in the Middle East and what they called a misunderstanding of their position surrounding the war there, putting some pressure on sales. How big of a problem is that? Do you expect that to continue?
Yeah, I don't have the numbers off the top of my head. It is a relatively small part of their business. It is in the international developed licensed markets, which is the smallest category for McDonald's. But it is an impact of some franchise and license revenues that are probably a little bit softer. I imagine it could continue here for the next few quarters.
In terms of McDonald's business in the United States, how are things going?
Yeah, very solid. A 4% plus same-store sales number in the fourth quarter. Finished up a good year. I think their positioning continues to be very strong. As I noted earlier, that's in particular in a competitive U.S. market, they do tend to continue to gain share, and I think we'll see a little bit more unit growth as they highlighted last December at an investor analyst day to continue to help that share growth both in the U.S. as well as some of their larger European markets.
Stock's up sharply in the last 4 months. Do you like it here?
We do. I mean, it's run into some resistance, as you can see, at the 300 level, but it's just such a steady Eddie with a nice dividend and share repurchase for double-digit total shareholder return. We do have a buy. We think it'll continue to grind its way higher towards the 330 mark.
Andy, thank you for your time.
Have a good morning.
Okay, coming up next, the U.S. and allies launching a barrage of strikes over the weekend against Houthi positions in the Middle East. Former NATO Supreme Allied Commander James Stavridis is going to join us next. And then another big hour ahead. Senator Mark Warner is going to be with us. Don't go anywhere. Squawk Box rolls on after this.
Last night, the U.S. and U.K. struck 36 Houthi targets in Yemen. This is an attempt to disrupt and degrade the capabilities that militants have used to attack ships in the Red Sea. Joining us to discuss the strikes, what comes next, is retired U.S. Navy Admiral and former NATO Supreme Allied Commander James Stavridis. And all this has happened, Admiral, since the last time you were on, and we were trying to decide what the right amount of force should be used back then. Do you think that this has been how you would have recommended it to the Biden administration and to our allies? Has it been about right? Is it effective?
I think it's been about right, and it's too soon to tell if it's effective. So about right in the sense that we've increased the strike levels quite significantly. Over the last 5 days or so, we've hit probably 150 targets. 100 up in Iraq and Syria, about 50 down off the coast of the Red Sea. So increase in volume. Number two, and important, the strikes have hit not only the proxy groups, but also Iranian Revolutionary Guard that are on site doing the training, equipping, and organizing. So I think it's about the right level at this stage. Whether it's effective or not, we don't know yet whether it's going to be effective in the minds of the mullahs in Tehran, who will ultimately make the decision to kind of reduce their commitment. But we do know, Joe, that it's effective in terms of degrading, destroying capability, taking out missiles, radar, C2, and all that. So mixed picture so far, and let's see what happens next in terms of response from Tehran.
Would we have to have definitive proof that Iran was involved through proxies? It resulted in the death of Americans to actually strike within Iran? Admiral, is that a possibility? I mean, there are things in Iran that I'm sure are held dear by the mullahs that you just talked about. I mean, at some point, if they're willing to kill our people, that should be something should that never be on the table, because that's a line that just can't be crossed. That it's just stated. Oh no, that would accelerate two things too much. I mean, Iran doesn't seem to give a crap about crossing lines.
Without question, it's on the table, and I can assure you, U.S. Central Command has very detailed plans, and you're right, there are some extremely juicy targets inside Iran. Initially, you'd probably go after Iranian warships. You'd go after their oil and gas platforms at sea. You'd go internally after their munitions construction facilities. Don't forget, they're supplying drones to Ukraine. There's a very rich set of targets inside Iran. We have the capability to go after those. I know for a fact those targets have been developed, processed. They're available for the president. And in terms of, do we have definitive proof of Iranian complicity in these strikes? From everything I can see, the answer to that is yes. The only reason we have not begun those strikes into Iran is to kind of give the Iranians one more exit before the tunnel, if you will, and avoid a truly widening war. I think that's smart, but if the mullahs continue to push their proxies, you're going to have to go into Iran.
Because you know what, at this point, it just looks like the Iranians expected what we're doing now, and that it really hasn't necessarily gotten their attention to the point of where it's necessary. And I understand what you're saying, give them one more chance. They've had a lot of chances. You think it's inevitable?
I don't think it's inevitable, because at the very highest level, the mullahs know if they don't cease and desist, we will go into Iran, and that will unlock a serious conflict that could end up destroying a significant part of their military capability. You and I are old enough to remember, particularly me, the late 1980s, we went through this almost exact process. The Iranians sought to close the Strait of Hormuz itself. U.S. Navy destroyed about a fourth of their fleet. They don't want a repetition of that. I hope we don't get there, but if we have to, we should go there.
I think we remember the same things. I just looked at your age, so it's you definitely don't remember. You may have less hair, but we remember the same things, Admiral, year for year. I think maybe you got one in this couple of months. I don't know. What makes me think that at this point that the Iranians would really only understand one thing, and I think our left flank in this country would have a heart attack if we went in, if we did anything like that. I don't know if the president can do that in his own party, but that's probably at this point. Do you have to be a wild-eyed neocon with blood in your mind to do that, or do you just finally say, look, enough is enough? That we just can't keep playing this dance.
I think the latter, and frankly, my sense is the administration wants to avoid a wider war in the Middle East, of course, during an election year, of course. On the other hand, if there are continued attacks that threaten our warships, for example, what if one of those cruise missiles got through and hit an American destroyer? You could have 30, 50, 100 sailors killed. I can foresee scenarios, Joe, where there is, in fact, a requirement to respond directly against Iran. I think in that scenario, we would do it. Let's hope the mullahs cease and desist. It really is last exit before the tunnel for them.
All right, Admiral, thank you. Let's hope so. Thanks.
Yeah.
Still to come this morning, Senator Mark Warner will join us right here at the NASDAQ to talk about geopolitics and much more. And later, we will talk to Paul Tudor Jones and HPE CEO Antonio Neri. Squawk Box will be right back.
.com.
Good morning. Stocks start the week at record highs, but futures are pointing lower. Corporate earnings in focus today. New results out from Dow Components, Caterpillar, and McDonald's. Meantime, the Senate unveiling a more than $100 billion border security and international aid bill. We're going to get details from Virginia Democrat Mark Warner. And stay tuned for a special interview with the leader of America's most just company, Hewlett-Packard Enterprise, and the founder of Just Capital himself, legendary investor Paul Tudor Jones. This hour as we begin the final hour of Squawk Box.
Good morning and welcome back to Squawk Box here on CNBC, live from the NASDAQ market site in Times Square. I'm Joe Kernan along with Becky Quick and Andrew Ross Sorkin. U.S. equity futures closed last week at record highs. Said they're going to start at record highs today. At this point, they wouldn't be starting at record highs, would they? They'd be the low. The NASDAQ, no, now the NASDAQ wouldn't either. So disregard what we just told you. Never mind. Treasury yields at this hour. Take a quick look. The 10-year is back about 4.11%, and you can forget about your rate cuts. Okay, so just no. I don't know, but I think for now.
Yeah.
I wish he'd come on like a financial network and talk about it instead of a little like starter primer interview for the masses. That is it easier for him to do that?
Look, he has not been on 60 Minutes since 2021. It is a way to reach out to the broader audience when you're talking.
You're not getting any hard, real, actual questions from someone who knows.
Well, really, it was an explanatory. It was an explanatory.
Well, that's what we need.
I think it's good to have people, the general public, understand more about inflation and what the Fed's role is.
Okay, good.
I do.
We'll get them all up to speed eventually.
All right, a couple of earnings movers to get you caught up on today. Caterpillar slightly missing sales estimates for the fourth quarter. Adjusted earnings apparently beating consensus, although there is some discussion going on as to whether the $5.23 a share price is comparable to estimates. Either way, you're talking about a big beat on what was expected. Caterpillar saw strength in the North American market, and that helped to offset weakness elsewhere. The company's operating profit margin jumped to more than 18% in the fourth quarter. That was up from 10% in 2022, and that stock is up by about 4.1%. We're also watching shares of McDonald's, the fast food giant, beating the street's fourth quarter profit forecast, although sales were slightly below. Comp store sales were below estimates in all segments, and the company's CEO said that he remains confident in the resilience of the business despite some of the macro challenges that will persist this year. They were able to raise prices, and that helped with things too. Stock right now down by about 0.7%. And then there is the parent company of Novo Nordisk saying it will buy contract drug maker Catalent for about $11 billion in cash. Catalent is the company chiefly responsible for filling and packaging syringes and injection pens for Novo Nordisk's weight loss drug Wegovy. The company said today's deal will help meet strong customer demand. Catalent shares up by more than 11%. Novo Nordisk shares up by about 1.8%.
Meantime, let's get back to the broader markets and bring in our own Mike Santoli, who's looking at the recent record run for stocks and whether, of course, that can continue. Mike Santoli at the New York Stock Exchange. Good morning.
Morning, Andrew. Yeah, I mean, this run to a record last week by the S&P 500 did happen kind of through a gauntlet. The market continues to be tested on some of the major premises that got us here, which is one, can good economic news be treated as good news by the markets? We had to have a bit of a rethink on the initiation of potential Fed rate cuts by Powell and by the data. And then, of course, you had some of the choppier big cap tech earnings that caused a bit of a gut check, little unevenness there, yet we get to a new record. Now, it's kind of gotten the market to a bit of the upper end of this trend line. So I've kind of been pointing this out for a while. If you want to take that as a trend since the fall, it has always projected a little over 5,000 would be a little bit of a maybe culmination moment for that, or a stop and reassess. I also want to be mindful here. 1 year ago, it was actually February 2nd, right after a fluky seeming very strong January jobs report. Sound familiar? You did have rates go higher and you had the market have a pullback. It was like 3 to 5%. Then we got SVB. It almost ended up being a 10% correction there. It doesn't look like a heck of a lot on this one-year chart, but that's what it was, and February can sometimes be choppy. So you throw all that into the mix. Now take a look at the path of the 10-year Treasury yield, because this is another factor, especially in determining the breadth of the rally. It's sort of breadth weakens when rates have gone up. We've been in this range, though, 4.2 to 3.8 or so. That's been where we've sat since the fall, and really since December, since the Fed pivot. And it seems like below 4.25, we can make our peace with that. Also, the absolute level might not matter that much. Back here, over 4% was a problem, you know, in the first quarter of last year. You can dial it back a year and a half ago, and we thought 3.5%, 3%, maybe we couldn't handle that. So if it's happening for the right reasons, if the economy remains strong, it seems like we can somewhat deal with that, but that remains to be seen. Finally, you want to take a look at the volatility index. It's another thing that says concern is sort of rising from low levels, but certainly not at a panic. We were at 12 in mid-December. We are still in this range, but now we're up around 14, even though the stock market, the S&P, has gone higher 5 or 6% since then. And so it just shows you we're clenching up a little bit. We have CPI this week, and obviously the rest of earnings season to determine whether, in fact, this trend can be sustained.
Okay, Mike Santoli at the New York Stock Exchange. Thank you, sir, for helping us through it.
Federal Reserve Chair Jay Powell says that the Fed is getting closer to cutting interest rate, but it's not there yet.
We want to see more evidence that inflation is moving sustainably down to 2%. We have some confidence in that. Our confidence is rising. We just want some more confidence before we take that very important step of beginning to cut interest rates.
Powell made those comments last night on 60 Minutes in an interview that was taped before Friday's much hotter than expected jobs report. And joining us right now with his insights is Roger Ferguson. He's former Fed vice chairman and a CNBC contributor. And Roger, listening to the interview last night, I didn't hear anything that greatly surprised or shocked me, but we have seen Treasury yields moving this morning, moving higher on this idea that the Fed is not going to cut rates in March. I don't think that comes as a surprise to you, but why do you think the markets need to hear this again and again?
Well, look, I think the markets have built in a certain kind of expectation. They've been making, bets on a March cut, and it's hard for people to recognize and unwind those bets. And in part, it's hard for people, I think, more psychologically than economically in the market to do that. And so I think this repetition gradually gets through the one person and the next market participant. So I think that's what's happening. As you said, there's nothing surprising there. It's just individual participants in the market, waking up and saying, okay, I guess they really are serious here.
We spoke with Steve Eisman about an hour ago, and he made the point, look, it's the Fed's own fault. They have a communication problem. I said, it's pretty clear if you're listening to what they're saying. He said, yes, but you have the dot plots, and the Fed dot plots have been telling people that they anticipate 6 cuts. Why does the Fed continue to put out the dot plots if it just creates confusion in the market?
That's a good question. I don't think that they necessarily think it creates confusion. It gives them a chance every other meeting to really talk about something they really talk about, which is, what is our expectation? The challenge is, to understand those dot plots, you've got to understand a lot of technicality of what assumptions people are making. You also have to understand that it's not a formal forecast. There are a lot of caveats around it. So, I think it is well-intentioned. It's a desire to say this is what might happen. But on the other hand, markets don't take the conditional, they expect it to actually be a forecast and a promise. It's not that. And so I think the challenge is just being clear about what these dot plots are and what they're not. And that's always a little tricky.
Roger, and all the times that you've been on, and it's been, we've been on this road and on these travels, we've been together. We've had you along with us, and we said again and again, and I just got the feeling that you're always pretty hawkish, and I didn't always think you should have been, and for a long time you were right, and then I thought you were wrong, and I was wondering, now I think you were right again, but I was wondering, did you ever think I've been too hawkish, and now I see all the 7 rate cuts coming, and things are definitely slowing down? Did you ever think, or were you still holding on to that position, and was it really the Fed that was wrong?
Hard to say who was right or wrong here. What was driving me was a general sense that two things. One is the Fed really doesn't want to lose credibility. The history suggests something you and I have talked about, stop-start is not considered, good central banking. And so I've always had the expectation they'd probably hang on at rates a little higher for a little longer than the market expected, for the reasons that Chair Powell is now articulating very clearly, which is, they really want a strong sense of confidence that the inflation rate is coming back down to 2%. They also have the luxury now of seeing an economy itself that looks like it's in good shape. And that gives them, I think, again, the ability to wait and see, because tight rates are not doing, do not appear at this stage to be doing significant damage to the economy. So you put those two things together, wanting to be clear that inflation is coming down to 2%, high degree of confidence, and the fact that the economy looks like it's holding up well in the face of this rapid increase in rates. And I think both those two things give them a sense that they can, be a little more patient in moving rates down, as Chair Powell has been saying.
When you look around, the economy does seem like it's doing fairly well. Why the pressure to cut rates at all? Is it what is normalized at this point?
Well, I think the issue, Becky, is this thing that's sort of elusive, the so-called neutral rate, which no one observes. But there's an expectation that as inflation comes down itself, the level of rates that the Fed should set should be coming down as well, because the real rate, which you understand is the nominal rate minus inflation, you don't want that to increase and find that you're tightening more than they feel that they need. And so it's a natural expectation as inflation comes down that interest rates should be coming down. The question is the pace at which they're doing that, and importantly, as they say, when they start. I'm in the mode that they're probably going to start in June, maybe 3 rate cuts, consistent with the way I've been reading the dot plots. The market was more optimistic. I think they're now moving, in my direction.
It seems that it's a much more complicated thing to try and figure out when you have the balance sheet as large as it is and this quantitative tightening going on at the same time. I don't think we truly understand how quantitative tightening works, where it tightens the screws, when it creates a problem. If you were at the Fed right now, would you rather be tightening up, quantitative tightening and shrinking the balance sheet more, or would you rather use the old tool of cutting interest rates? Which do you stop first?
I prefer to focus on the tool that we understand best, which is the interest rate, the federal funds rate. As you observed, we've never really used quantitative tightening this way. So I think caution should prevail there. Consistency, announcing what you're going to do so the market can get ready for it, and executing cautiously is, I think, the best thing to do there with quantitative tightening. Not try to use that as the major lever, because we really don't know how it works exactly, as you point out. And I think in those cases, being as transparent as you can be, consistent with executing a strategy is the better approach. And then where you want to perhaps use a little bit more judgment is in the area of the federal funds rate.
But if you're in a crisis, it's the brake you're going to pump first, right? As we saw last March when we ran into troubles in the banking situation, when the Fed wasn't sure about things, quantitative tightening went out the window.
Oh, absolutely, because we don't quite know how it works. But we're not in a crisis now. They do need to get their balance sheet down for lots of obvious reasons. And I think the way you do it is what they do, which is you try to be as methodical and transparent as possible, letting everything roll off exactly as they say it's going to, so that the market itself can get ready. But you're right, in a crisis moment, you stop all of that. And you don't want to go into areas that are uncertain, and you focus on the tools that you know will work.
Roger, we always appreciate talking this stuff through with you. Thank you for joining us today.
Thank you.
Coming up, an interview with legendary investor Paul Tudor Jones and Hewlett-Packard Enterprise CEO Antonio Neri. His company topping this year's Just 100 list out this morning. But next, the Senate rolling out a 12-figure border security and international aid package. We'll talk about what's at stake with Virginia Senator Mark Warner. Stay tuned. You're watching Squawk Box. This is CNBC.
Download the app.
Welcome back to Squawk Box, everybody. We've been watching the futures. On this Monday morning, you do see some red arrows ahead of the opening bell. This does come after the highest closes we've seen, record closes for the S&P 500, the Dow, and the NASDAQ 100 on Friday. But this morning, the Dow's indicated off by more than 80 points. S&P futures down by just over 7, the NASDAQ down by about 7 as well.
Senators out with details of a $118 billion aid package that includes money for Ukraine, Israel, Taiwan, and bolstering security at the southern U.S. border. President Biden says he supports the proposal, including new emergency authority to shut down the border when it gets overwhelmed. But House Speaker Mike Johnson responded by tweeting that if the bill makes it to the House, it'll be dead on arrival. He had indicated Saturday that the House would vote on a separate $17 billion Israel aid package. Join us now, Democratic Senator Mark Warner of Virginia. Senator, welcome. It's good to see you.
Good to see you, Joe.
As always. Is it a foregone conclusion that once again, this sounds good, not going to happen?
Well, first of all, let's look at the pieces of this. In this is what I've been fighting for literally for months on end, and that is aid to Ukraine. Is this country going to go ahead and honor its commitment, or should no country in the world ever trust us again if we turn down the Ukrainians at this point, particularly after the Europeans stepped up with 50 billion euro just a week ago? On the border, took a long time, but this is the most significant change in border policy in decades. It ends the whole program around catch and release. It ends up putting about 4,000 more CBP and ICE agents on the border. It increased checking for fentanyl coming into our country. And it makes changes to the parole policy. All the things that Donald Trump asked for in 2018, all the things my Republican friends asked for earlier in the year.
I guess the trope, the conservative trope, is that the increased border agents are to process more people to let them in.
Actually, now that it's out, you can actually read the bill, and you can see that what it is it makes sure there is more processing so folks can actually get sent back. The remarkable thing was about 95% of the people who were coming through on the asylum program got caught at the border, processed, released in for a couple years, and then that called catch and release. Now that is ended, but you're going to need more folks, you're going to need more beds at the border to send people back.
I mean, you've seen the numbers, obviously unacceptable, and you've seen those other numbers.
Yeah, the border's a mess.
You've seen the other troubling numbers about, I think, the president's 30 points underwater versus Donald Trump on how to handle immigration. So every time the president looks into the camera and says, I've done all I could, no one believes that. No one believes that. And we know when he did come in a couple of years ago, he said, come on in, and sort of got rid of a lot of the things that Trump had instituted. Why not cop to that? Why? It just seems like if you can keep saying it's not my fault, I've done all I could. You got one guy, John Fetterman, who seems to acknowledge it. Will you break ranks and say this is the president's fault?
The border's a mess. The border's a mess. We all acknowledge that. So we can either carp about it or make the policy changes.
Couldn't he do some executive decisions?
Every Republican senator who is complaining about this deal has said repeatedly, you got to change the law. Donald Trump said, you got to change the law. We now are giving what is needed a significant change of the law. It took a long time to get it negotiated.
Yep.
Combined with stepping up for Ukraine, combined with stepping up for Israel and humanitarian aid in the region. And the question is going to be, folks who've asked for this, are they going to take the deal, or are they going to say, no,
I think they're not going to take it. I know it might be
because we
might be Trump's fault.
Because we might want to punt until for political
It's an
reasons.
election issue. It is.
Even in hypocrisy-ridden Washington, this is rich.
Every day we talk about it. The hypocrisy you could cut it with a knife on both sides. I know.
This border deal, you got the BRT, you got the Chamber, you got NAM, you've got all the business groups that you guys talk about here every day. They're all for it. Let's do it.
Is there any? Are there parts of your party where the actual the inclination is to open the border because we are missing? We are a million short on people that we could give jobs to. There's
the hearts are our party, and frankly, the business community as well, that says we need more high-skilled workers.
Do they want to enable illegal? Do they want to enable illegal immigration? Whether they're going to vote, these people become Democratic voters eventually? Do you ever really believe that that's part of the rationale for the far left of your party? The Squad, for example.
What I acknowledge straight up is the border's a mess. We can either complain about it, or we can pass a law that would give completely new policies and the ability to shut it down. And the president said he would.
Senator, will you just shut down? Either shut down or not this question? Because look, there's the question that Joe's asking. This idea that somehow Democrats.
I see people that have said that.
All sorts of people, because they will effectively crowd out the Republicans. I mean, that is a perspective. So I think you should I'm not telling you what to do. I think you should either say, yes, that's the strategy, or no, that's not the strategy.
I have not heard a single Democratic elected official ever say, let's just open the borders and come take all. It is not the policy.
There's jobs waiting for a lot of people.
It is not the premise of the Democratic Party. There are business groups who've said that, but that's not the premise of the Democratic Party.
How about how much is the president have a carte blanche to deal with Iran the way he sees fit, or is he going to hear from?
I think what the Admiral said in
oh, you were watching?
Absolutely, I watch you guys all the time.
That's
what
nice.
he said. I think he's kind of struck the right balance.
Who's your favorite?
Hey, listen.
They're all your
who's
kids?
The most provocative? But not favorite. What he's done is, I think he's trying to thread this needle. You have got about 100 strikes in Syria and Iraq. You've got 50 plus.
Do we strike in Iran?
Even Donald Trump, when he brought us all together back, I think 2018, 2019, he told the senior leadership, chairman of the Intelligence Committee, that he thought he was going to go ahead and strike Iran. He changed his mind because he thought that was not the right thing to put us into war. Right. He ended up saying he's going to take, as a president should, and pick his time and place. And it was 6 months later that he took out Soleimani, General Soleimani, the head of the Iranian Quds Force. He didn't take him out in Iran. He took him out in Iraq. And I think that was the prudent thing to do. I think it was the right thing to do. I was just in the region, in Saudi Arabia, in Jordan, in Israel. I didn't hear anyone say the best thing we ought to do in this region at this moment in time is go into direct war with Iran.
Hey, Senator, how does cyber security and cyber attacks, how does that change the geopolitical strengths and weaknesses? Because militarily, there aren't a lot of places that can compete with us. When it comes to cyber attacks, though, when you have a nation state that's coming after our countries, after our companies, that puts things on a different
Cyber is really asymmetric. It's one of the reasons why a couple years ago we put a bipartisan bill together that says if you've got a major cyber attack, you got to at least tell the government, not so we can regulate you, so we can tell other folks in the private sector. And one of the things I'm most worried about right now, you know, we're 10 months away from election. And I think we are less prepared in terms of disinformation, misinformation, cyber attack in 2024 than we were in 2020. That's because you've got almost this perfect storm. You've got countries like Russia who would very much like to interfere in our elections so they could make sure we don't support Ukraine. You've got a number of election deniers that have increased in our country. And you have a court ruling that has basically restricted the ability of the government to even talk on a voluntary basis to social media companies. And then on top of all that, you add artificial intelligence, which can bring at scale and speed misinformation, disinformation, messing with our elections, and you got a perfect storm.
You think there's any chance of someone besides these two candidates in any scenario?
You know, I would have thought that might have been the case a year ago. I'm not sure that's the case today.
Larry Hogan, Joe Manchin, have you heard that one floating around?
I've heard of all, Joe, but I don't know any reasonable Democrat or Republican, and I say that with a lot of my Republican friends who've been thinking about this, that want to do anything that can actually help elect Donald Trump. And any third-party candidate to date that I've seen would actually add votes to Donald Trump.
Do you think you'd be a good state for some professional sports teams?
I think we got a pretty good option with the Caps and the Wizards coming in.
And that you're not going to, people aren't going to be mad at you in the district?
Well, I got to tell you, as somebody who lives in Alexandria, first thing I got to make sure is my neighbors don't get mad at me about the increased traffic. So I want to see what kind of traffic plan comes out first.
I think it's exciting, too. I do. All right, I'm not sure. You know, Washington, it's the seat of government. They don't. It's not a place for sports teams, is it? It hasn't worked out that well.
Well, this has got a few more chapters to be written before it comes about. But I've worked with the governor on this project and just talked to him yesterday.
The real Governor Terry McAuliffe or the other?
Listen, I work pretty well with Governor Youngkin. He and I have known each other for decades.
Someone said that a couple weeks ago. Senator, thanks.
Thank you.
And you still,
all
your children. You don't
all
have a favorite.
Favorites.
I have 4 dogs. They're all my favorites.
All my favorites.
Okay, coming up, investor Paul Tudor Jones joined us for a wide-ranging conversation on the markets, the Fed, and this year's list of the most just companies alongside Hewlett Packard's enterprise CEO, Antonio Neri. We are coming right back with all that and more after this.
What are you doing? Amazing. Really amazing. You know how to do it, right? Hello. Okay. Did you sleep good today? I'm not sure. Not very good lately. Why? I don't know. Candle. Receiving void energy for some reason. No, I had to put it when I put the candle. I slept actually on time.
Yeah, it's not very good. We're gonna need to solve that. It's kind of annoying now.
I got manicure today. I did you should.
Yeah, you should. Super classiest. Shade navy is the classiest color. Wow. I'm gonna make some coffee.
Okay.
Coming up, investor Paul Tudor Jones joins us with the CEO of Hewlett-Packard Enterprise. You don't want to miss this interview. Stay tuned. You're watching Squawk Box on CNBC.
Do you have one old 20? I put 20 in my chase.
No, I do have 20 that the tree over there, but yeah, here's now.
What do you mean?
I don't have old ones, so I don't know.
Welcome back to Squawk Box. New this morning, Just Capital out with its Just 100 list, a ranking of America's most just companies. CNBC is Just Capital's media partner. Joining us right now in an exclusive interview is Paul Tudor Jones, Tudor Investment founder and chief investment officer. Paul is also the founder and chairman of Just Capital. And here at the table is Hewlett-Packard Enterprise's CEO, Antonio Neri. HPE is ranked #1 at the tippy top of the list of the Just 100 this year. Good morning to both of you. Paul, I'm going to go to you first to sort of just walk through, if you could, how the Just Capital list is different to the extent you think it is in 2024 relative to the prior years, and the shifting sort of winds of what is important to folks.
Well, first of all, congratulations to Antonio for him being #1, his company being #1 in the rankings. And I would say that this year, it's not a huge shift in terms of how the rankings played out. It's more of a glacial move. Clearly the #1 issue for Americans, and it's doubled since 2010. The #1 issues, according to Americans, is all work-related issues, and right at the top is, and with 18% of our whole ranking, is pays a fair and living wage. So HPE, they just do well in every single category. One that strikes me particularly is they have, in the entire Russell 1000, they have the most generous maternal and paternity leaves that there are. And I say that for me personally because this year, as a newly minted grandfather, all three of my daughters, all three had grandchildren. So watching them hover over those babies for the better part of the first 3 to 6 months of their lives, and watching their husbands have the ability to interact with those babies, it was not just a touching and a heartwarming moment, but I just realized what a huge edge it is for those kids in life. We all know how important early childhood is. I think most of the brain synapses are formed and their cognitive abilities by the time they're age 5. So yes, that to me, at least as far as HPE went, particularly struck a beautiful spot, because I just see it real time with my daughters and their husbands.
Right. Antonio, let me ask you this. We are at a moment where there's been a lot of layoffs in the tech industry. A lot of folks even looked, I think, at what Meta did in terms of really sort of culling things, and actually, by the way, maybe getting even some mojo as a result of that. People looked at what Elon Musk did with Twitter, and there's a real sort of sense of maybe being ruthless is being good. Yeah. You are not that. And so I'm curious how you juxtapose these two ideas right now.
Yeah. Well, first of all, we have maniacal focus on driving operational efficiency and operating leverage for our shareholders. But at the end, I think about our people are our greatest assets, and ultimately, they are the one that deliver the value to our shareholders. So first of all, I want to thank Paul and the Just Capital for this amazing recognition. I know our 60,000 employees all over the world will celebrate this today. But ultimately, we are doubling down in our workforce. As a CEO and an engineer, I always said we compete with the best people, the best talent, which always is very stiff out there to attract the talent, and the best technology. So for us, it's doubling down, reskilling, give people the opportunity to grow in their career, to learn, and also implement new programs. In fact, I grew up as an apprentice in my life. And so we believe in those type of programs to reskill and grow from there.
So here's the question. If things got tight, right, how would you think about getting tighter? Meaning, do you think that the benefits come off first, or do you think keep all the benefits and we're just going to have to remove people if in fact that's the case? And I wanted to actually get into a conversation about AI and how that may affect things more broadly.
Well, you brought it up, Andrew. I think, first of all, we're living in an amazing time where this type of technology actually is going to help us be better at what we do, so we can reinvest some of those benefits back into the workforce and obviously deliver more value for our shareholders. But generally speaking, we tend to focus on all the stuff that we can remove so that people can do the job better, and then continue to improve our benefits and our capabilities by skilling people to this new reality.
Hey, Paul, I'm curious about governance as you look as somebody overseeing this Just list. And one of the big governance questions that's in the headlines is that of Elon Musk, and whether that board is independent, whether he's controllable. Wall Street Journal reporting that he's on drugs, taking drugs with the board members. What do you think of this, if this is true?
Well, I would say, if my facts are right, I think 2 or 3 weeks ago, Elon said that he'd like to have 25% controlling interest of the company. I think he's at 13% right now, having sold down a bunch of his holdings over the past couple of years. And I think it's a really, really interesting and important watching how this actually unfolds is going to be, I think, very telling and informative for the future of the country. If you say that, and really from two levels, the macro level and the micro level. Let's take the macro level first. I think one of the reasons why he wants 25% of the company is because he's thinking, I can bring my AI robotics. Do I use Tesla as a delivery mechanism for that? And that's going to be hugely important for the future of humanity. Clearly, it's going to be unbelievably productive in a fashion. We know right now that, I guess from a macro level, probably, I think the productivity gains that are projected to come from AI will probably double the typical 1.5% annual increase in productivity to maybe 3%. And the big social question is how do we take those productivity gains and distribute them through society in a way that allows society to be stable and to grow? So in Musk's case, it's particularly intriguing because here's the richest guy in the world who's saying, the way that I see AI robotics and the productivity gain that we can garner within Tesla is going to be possibly, and again, we don't know because all it was from a tweet, possibly by him increasing his own financial stake. And I don't think that this is like a hot dog eating contest where the rich necessarily win by getting that much richer. I don't know. I know 74% of Americans, or I think it's actually 83% of Americans think that CEOs already get paid too much. So I don't know how well that's going to play on Main Street. But more importantly, the big issues facing America going forward are going to be, one, again, productivity, the job displacement, estimated to be tens of millions of jobs between now and 2030, as well as how we deal with the big debt bomb that we've got coming for us. So just with, again, going back to this particular case, wouldn't it be interesting? He wants 25% of the company. Again, it was a cryptic tweet, but let's assume that he wants more of the company for doing AI robotics. As a hedge fund manager who earns 25%, far be it from me to throw stones at him for that. But think of this. Here's a guy who sees 1,000 years in the future, right? Maybe one of the greatest geniuses of our time. And yet the governance that he's proposing, at least initially, is kind of from 1,000 years ago, right? It's a feudalistic, almost vassalistic proposal in terms of sharing that wealth creation that's going to come from executing on productivity growth. So an alternative, and again, an alternative for him would be, what about this idea? What about taking, because I do think with the incredible genius that he's got, with that team of 140,000 employees, imagine what they can do for the rest of humanity. But instead of taking that extra, I guess it's something around $80 billion, something like that, rather than taking it just for himself, what if you start an employee stock ownership program for those 140,000 employees? What if he took
I think he has that already, doesn't he?
No, he has an employee stock purchase program, which is very different. I mean, an employee stock purchase program where you get to buy the stock at a 15% discount is radically different than employee stock ownership plan. Imagine if you took that $80 billion that he thinks he can do it anywhere, but let's say he did it with Tesla, and he distributed that, say 2/3 or 75% of it among 140,000 employees. What you do then is you create 140,000 people who will wake up, eat, breathe, and think Tesla every morning. You're not distributing the pie.
But
You're
Paul,
actually.
he says he wants to do it for a control factor because he wouldn't feel comfortable creating artificial intelligence if he didn't have some sort of voting control over it. So if he takes those shares and distributes them, he doesn't have control again.
Yeah, and I'm fine with that. I think it's the economic aspects of it that are important because we know that worker pay is the most important thing. Imagine the life-changing event that would be. I think it'd work out to $300,000 per employee.
Paul, in this capitalistic society, well, first of all, let me just go back. If you were the judge in the comp case, you would let him have the money, or you wouldn't let him have the money?
Are you talking about the Delaware case?
The Delaware case.
I think the Delaware case is more about process than comp. What my point to you is that we are on the verge of massive social change because of AI. We have to think about a way to distribute it, to grow it, as well as to share in it in a way that is going to be for the best and the betterment of society. In U.S., we already have the greatest wealth inequality. It puts us right next to South Africa in the world. How has wealth inequality historically been solved? It's it's revolution, it's war, or it's taxes. So if in this particular case, we have a massive, we're going to have to find $1 trillion in either government cuts and or taxes. And one of the ways that you will find those, one of the ways certainly on the revenue enhancing side, somewhere down the road, right now the markets aren't focused on it, but it's going to happen. One of the ways that you'll do that is going to be through an increase in a possible implementation of a wealth tax. Counterintuitively, in this particular instance, if Musk actually were able to get that board of directors to talk him into an extra $80 billion of compensation solely for himself, I think it would be exhibit number one at some point in the next 4 to 8 years, whenever the progressives take over after some great recession at some point. It'd be exhibit number one for wealth tax. So counterintuitively, I think you actually end up losing more money than making more money if it was him.
Well, hopefully Elon's watching this, and maybe he'll take your suggestion. I should say, by the way, that he did take to Twitter and say that he's never been tested positive for drugs, just for whatever that's worth.
Can I just go back? No. I do think Just Capital is all about markets. If you think about our two political parties right now, they do not have a vision for the future. It is why Americans are so disaffected with both of them at this point in time. The one thing that Americans do agree, and we see it in our polling at Just Capital, is there's 100% agreement on a variety of corporate issues, on issues such as worker pay, pays a fair and living wage. This is an opportunity, I think, for Mr. Musk to be truly, at least from where I sit, what he'll be remembered for most, to be a pathfinder in showing that the markets themselves can sort out the best way to keep society stable by making sure that all stakeholders, employees, customers, communities benefit from what these companies do and produce.
He's got to get everybody to Mars before he gets that done. Let me just ask you this, Antonio. And I also want to get Paul's take just on the economy and the markets, and we heard from Jay Powell last night. But I wanted to ask you what you're seeing in terms of in the enterprise space.
Yeah.
Businesses spending capital right now or not? What's the confidence factor?
I think enterprises continue to focus on what is important to them from a technology perspective to advance productivity. Obviously, AI is at the top of that list. To improve cybersecurity, to continue to digitize their enterprise, and to use data in a way they haven't.
So are you seeing people doubling down? You seeing people?
No, I see more steady and markets in transition where priorities continue to shift. Obviously, there has been a period of large digestion in the last 18 months because of the supply chain challenges. But when I think about the biggest opportunities in the market today, definitely AI, cybersecurity, connectivity continue to be top of the list.
Paul, I don't know if you saw 60 Minutes last night with Jay Powell. Do you have a take on what the Fed's doing right now, whether we're going to have a soft landing here, or whether something else is going to happen as the year progresses?
Well, you know, to me, there are two huge themes going forward. I don't know whether they'll manifest themselves this year. I kind of think one of them will. But the two big macro themes going forward are going to be the debt bomb that we have in the United States, the fiscal recklessness, and how we ultimately reconcile that versus the productivity gains that we're going to get from AI, which should be stunning and stupendous over the next few years. So those are the two, that's kind of Sila Charybdis. Those are the two forces clashing with each other. And I look at Fed policy right now as being cyclical rather than secular. Cyclical in the sense that we're looking at the current economic metrics, growth versus inflation, growth and inflation, where I think there are larger issues that we're going to be focusing on somewhere down the road. And it's going to be around how do we stop and close the fiscal deficits that we have, as well as, again, how do we use AI to benefit all Americans, not just the 5,000 or 10,000 extraordinarily brilliant people who are going to change our lives with it.
Final question for you, Paul. Grade the economy.
God, it's just great, I think. I mean, I think it's strong, but again, I think why shouldn't it be? We've got a 6-7% budget deficit. We're fast forwarding consumption like crazy. It should be going bangbusters because we've got an economy on steroids, and it's unsustainable. As Jay Powell said in his interview, his very smooth interview, we're on an unsustainable path, and we're going to have to stop it. And the only question is does that manifest itself in the markets? When does that manifest itself in those markets? It could be this year. It could be next year. Productivity may mask, and it might be 3 or 4 years from now. But clearly, we're on an unsustainable path.
Okay. Paul, we need to thank you. Antonio, I want to thank you. Congratulations.
Thank you.
Hitting the top of the list.
Yeah, thank you.
Congratulations, Antonio.
Thank you, Paul.
Thanks, guys.
My daughters all want to work for you.
We're coming right back on Squawk Box after this.
Member.
And right after a quick break, we're going to look at the top earnings movers to watch ahead of the opening bell. And a reminder, as we head to break, you can get the best of Squawk Box in our daily podcast. Follow Squawk Pod on your favorite podcast app and listen anytime. Stay tuned. We're coming right back.
Store.
Well, we've got just a little over a half hour to go until the opening bell on Wall Street. Dom Chu is here. He's got a look at some of today's key stock movers. Dom, good morning again.
All right, so Becky, let's get you caught up in some of those earnings headliners, including a couple of Dow components. We'll start with Caterpillar, which is up just about 4.75%, about 150,000 shares of volume so far. The construction equipment heavy machinery maker, global economic bellwether, if you want to look at it that way, had earnings per share come in at what some are calling is better than expected, even though there are some questions about the comparability of those estimates to analyst consensus estimates. But if you take a look overall at the revenue picture, it was a miss. Cat offered some financial guidance for the current quarter and full year that will be similar to what it saw in 2023. It was helped along by better sales in North America, which continues to see strength in infrastructure, construction spending, helped offset weakness in other parts of the world. So Cat shares up 4.75%. Next up, you got shares of fellow Dow component McDonald's, which is down 1.5%, just around 170,000 shares of volume. The quick service restaurant giant reporting better than expected profits, slight miss for top line revenues. McDonald's said the ongoing conflicts in the Middle East took its toll on those sales in the affected areas. Domestic sales, by the way, sales at restaurant locations grew in line with estimates. The global same-store sales fell shy of the mark. And then we're going to end with personal care cosmetics giant Estee Lauder, the maker of its namesake cosmetics, also Aveda, Clinique, Bumble & Bumble, and others, reporting better than expected profits and revenues. It's going to cut, though, 3 to 5% of its workforce in an expansion of its restructuring efforts. So, Becky, keep an eye on those. I'll send things back over to you.
All right, Dom, thank you very much. Folks, that does it for us today. We'll make sure we see you right back here tomorrow. Right now, though, it's time for Squawk on the Street.
Monday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer, David Faber at Post 9 of the New York Stock Exchange. Coming off Friday's all-time closing high, futures lower, yields up as Powell reiterates on 60 Minutes. The Fed wants more confidence before cutting rates. Busy week with a lot of consumer earnings and Fed speak. That's where our road bet's going to begin. Another big week for investors. Now halfway through the earnings season. Dow comes off the best week of the year. S&P another fresh record close.
Plus, more issues for Boeing. It is reporting another problem with its 737 jets. It may delay the deliveries of about 50 aircraft. And shares of Caterpillar seem to be on track for what would be a record high at the open. That is following its latest earnings, which seem to have been a beat. We're going to break down the quarter with the CEO. It's a CNBC exclusive, and it will be later this hour.
Let's begin, though, with the markets after that record-setting week for stocks. Jim, some work being done. Sam Stovall is a good example of what happens when you notch all-time highs in January and February.
Yep, well, look, yeah, I mean, we had an astounding week last week, and it looks to continue, and I think that people have to recognize that there have been very few shortfalls and some monster by big companies increases. And it's kind of surprising because when you look at the sum total of the research today, almost every single thing is price target bump, price target bump, price target bump. And yet, of course, the averages are down, David, because the futures are loath to be able to recognize what's underneath, which is that in a rather extraordinary set of earnings, considering that we've had 11 considering what we heard last night from Powell.
When you say rather extraordinary set of earnings, what set are you thinking of?
Well,
the broader set or particular?
Well, let's see. If you want to know what the strongest, I think, stocks are the industrials, and then the technology, and then so far retail. Not a lot of retail yet. These would have been the three that I would have shorted. Looking at what the Fed's done, it would have made the most sense. They would have been the most crushed. And it's the opposite. So that leaves us all trying to think of, well, what happened to this soft landing, hard landing? And the answer is there's no landing. And that was what he put to bed last night, Jay Powell. There's no landing. It's just a good economy.
Right.
We're back to reality, dude.
Right. Yeah, I mean, we didn't learn anything new from that interview.
No, but
last
I'm just
night.
saying
It was
that-
the same thing from the conversation. And they taped it, by the way, before we got the employment numbers. So.
No, but I'm just okay. I agree with that.
Yeah.
Did I need to watch it? I was watching Masters of the Air. I had to switch, and I did. But that's because I didn't have my Vision Pro yet. But what I'm just saying is that you get a situation where there's no. It's a new suit.
It's a beautiful tie.
Stay focused.
It's a beautiful tie.
No, it's like Bahar. It's a second-rate tie. It's half the price of my normal ties. It just looks the same.
Oh, I like it.
I went to Costco. They had great ties.
And it is.
I noticed, and you also said you can see the prices falling in real time.
Yes, you can. I mean, it's rather extraordinary. We went in with guns blazing at Costco.
Really?
Yeah. I mean, there was just
like real time means like you're walking through the store and you come back to an aisle and the price is lower.
I'm talking about an M&M package.
Yeah.
Right. M&M back to reality. I've got the full circle here. Let's go back to Powell for a second before we go to Costco. By the way, the gold is not available at the store. That's what I wanted to get. You can only buy that online, right? But the Shark vacuum cleaners, the price is just so through iRobot. The long knives are out for iRobot.
Well, iRobot's having some really difficult times,
But
given no
just to
longer
go back
be acquired by Amazon. Yeah.
Right, to go back to Powell.
Yes, back to Powell.
I think that we're now in an era where what he's saying everywhere, not just with Scott Pelley, is that look, we don't need to cut. We got a great economy. So I mean, we're not supposed to have a great economy. That's why I started with the industrials. Eaton, Illinois Tool Works, maybe Caterpillar. The shorts have to take Caterpillar down. They cannot let this thing be up. They've been crushed. So the shorts.
So bad. I know.
Anybody heard of those other than Nate, which goes after companies that don't exist? I think, David, more important than anything, is that we have the mandate which says, look, we don't need to cut unless we have job slow down. And instead we can come in at 3.5 next month.
And we got wage increases on Friday that were
but
fairly
nobody
significant.
Nobody cares. Because it says that we're fine. It was fine. It's not supposed to be fine, but it is fine. Now, interest rates obviously went up.
Yes.
But I'm just saying that if you're looking, this soft landing, hard landing dichotomy is something I want to take out of our conversation.
Right. You're in the no landing camp. We just
exactly.
keep going.
Well, why should we have landing?
Right.
Why should we have landing? This is not Masters of the Air where we're trying to land in Greenland, trying to land at the British Air Base. You're not watching it?
No, I haven't been watching that. Masters of the Air, Carl?
Apple Plus?
Yes, of course, right.
Apple Plus combined with the Vision Pro, along with someone who's riding on the subway and doing work, I think we discovered this weekend. Here's what happened this weekend. I think the Vision Pro went from boutique to upside surprise this weekend.
We're starting to get some street people put numbers on at least the hardware revenue contribution. B of A, 46 cents over the next 5 years.
Well, I think Tony Saunay, if we have him on today, the best numbers for Vision Pro behind us.
Well, I mean, not to say that it is not going to usher in a new wave.
Man, he's got the whole thing.
Already thinking Super Bowl.
He's thinking,
Me and Usher go way back.
Are you texting him right
I used
now?
to have his, he and I used to be texting buddies.
He's been on
You
before.
did not.
We did. We sat next to each other at a dinner. We were friends for a brief period.
Let me see.
All right, I'll show you later.
I'm sure he's busy this week, but
Yeah. But the price point of that is still too high for it to become a
Tim
broad
has said to me
consumer
Tim
product. It's 30.
Tim has said to me over and over
How
again.
many people have that much money to drop on something?
You can do buy now, pay later. Have you ever heard of finance?
Buy now, pay forever.
Pay later, not forever. Look, Tim has said over and over again, boy, like people just buy it like everything else they buy. They'll buy it with and pay interest. They'll buy it in installments.
I'm sure it will do quite well. I'm sure it will get
Do you think it'll
cheaper
change the
and
discourse?
smaller over time.
I
And
think
it
it
may
changes
very
the-
well usher in an era in which we're all wearing goggles of some kind as we more and more become digitally.
Did you see my post
We
of the
become
guy
digital
wearing
brains.
goggles in the Cybertruck?
Yes, I saw that.
There you go. There you go. But you don't need to hallucinate to get. There's two hallucinations right now. There's hallucination on AI, which means, of course, that's the lies that they put, including the a dark video. But there's also the hallucination that was the 30-person Wall Street Journal story. Actually, only 4 bylines.
4 bylines, yeah.
That's to get Elon Musk off the board.
We're going to talk about that in a little bit, I think. Yeah.
Well, I mean, it's to get Musk. The long knives are out for Musk like I haven't seen in a long time.
It does
They use
appear
was that the plainest information
that there are some
in the
people
Delaware case?
somewhere who've decided they can start to turn on him in some fashion. It's true.
And how do you feel about that?
How do I feel personally about it?
Never mind, I don't care how you feel personally because you'll never give it to me anyway.
No, I'm not going to share my personal.
I'll share my personal. I think that piece makes it sound like it's very hard for the SEC not to come back and look at whether he's an independent board, which he was never. Who thought this was independent? There's just a web of wealth. But more importantly, I think they're going to say, well, wait a second, is this man impaired? And they try to
Not impaired.
I don't think he is at all.
The journalists, obviously, they are committed to this story.
Right, okay.
Keep coming back to the same
like they were
story
committed
and
with
keep finding more evidence from 2 years ago this one or 3 years ago that one. You know.
Well, okay.
If it were written about any other CEO, everybody would be talking about it.
Thanks.
Suppose.
If it was written about a tool and die company.
Yes.
You think so?
Yeah,
First of all, we wouldn't know and we wouldn't care.
I don't know. I know and I don't care. He's the greatest industrialist of our time.
He's the greatest single business person
Did he
of
have
our time.
if he had a substance problem, which I don't think he had?
Well, that's the question. Does
Well,
he have one or
he
not?
passed all the tests.
Right? He's not a drug addict.
He passed all the tests for the NASA contract. Why should we think that he's a drug addict?
Well, I don't think we should, and I think he most likely is not. I think it's two separate stories, although they are related by this idea that some of the board members party with him, so to speak, but it's the interrelationships within the board and whether that is, in fact, a form of governance that is probably not a good one for shareholders. It goes back to the McCormick's ruling, throwing out his pay package in Delaware a couple of weeks ago.
I think that is integral
But
to what
you
happened.
raised an interesting point, which is who has he ticked off at this point who wasn't willing to turn on him in the past and now is? Because that's really what's going on.
It was Lyndon Johnson Rice.
That's really what's going on.
2019.
Meanwhile,
thank you. That's really what I was trying to get at.
Meantime, stories over the weekend about the EV slowdown making its way to Europe,
Yes.
Where German sales of EVs may fall as much as 14% this year because of fewer credits. Jim, Piper cuts deliveries and margins today.
I thought that was devastating.
And they say you should probably take this year to get educated on other non-automotive parts of the business.
Well, you have to, because there's no longer going to be upside surprise. You need to achieve sustainable valuation that no longer upside from the vehicles. And by the way, they cut the numbers of the vehicles. I thought that was really significant. I thought that this piece just said you're buying something that is radically overvalued unless they come up with something else. But you know what? It kind of reads. Again, I'm going to take Musk's side for a second. This is like what happened with Apple, where the analysts decided to bury it if they didn't have a good guide for the cell phone, and then somehow the stock goes to $179.50, then it bounces back to 186. I think if you look at this and say this is my Tesla file, what you control Tesla, Kathy Wood will take it right up. She'll buy every single share. She'll take it and bid it and take it and bid it and take it and bid it until it's up at the end of the day, because that's what the buyers do. They control the float. That's been the case since this thing came public.
And you think that happens somewhere here in the 180s?
Absolutely. They cannot that's what they do. The buyers, the fan person buyers,
so these,
take and bid.
These street lows of 150, 130, you don't think we get there?
Good luck.
There's still too much enthusiasm.
Good luck. There's too much enthusiasm. And yes, I mean, the Journal may try as best as it can to get Gensler involved and take a hard look at this because of the web of Elon Independence. Remember, they related to what, to Zynga in the article?
I don't think anybody was under the illusion that you were getting a typical board here and a typical company to begin with.
That's my point.
You knew that going in. I mean, my God, remember Solar City? I mean, it's different.
If you read the piece,
it's Musk.
If you read the piece, did you really feel differently about Musk? I didn't either.
I didn't feel like I learned anything I didn't know.
So he's a genius, and there are times when he has a party.
So your view is just caveat emptor on governance?
You bet. This is not Griselda, which, by the way, is really good. It's not Griselda. It makes it sound like it is. Parties on yachts, you know?
Well, Tesla now worth about half of Meta after that record-setting market cap surge on Friday. Biggest market cap build in a single day by any company ever. We'll talk more about what that means for the business and the future of social media. Take a look at the pre-market. There's going to be a lot to get to this week between earnings from the likes of PayPal and Disney and Uber and Pins. We're back in a minute. Our running list of companies announcing job reductions continues. Snap today, Jim, is going to be cutting a global headcount by about 10%. Got some news out of SocGen today, and of course that's part of some other companies' story today.
You go back over what Musk talked about. I'm sorry, sure, Musk is on my mind. What Mark Zuckerberg talked about. There was this moment in the middle of it which just said, hey, we don't need as many people to do this. We're not creating the content. You are, and we just turns out that we can make a lot more money than we thought. And David, if I were Snap, I would do exactly what they're doing and just make more money on the ads, because I thought that, by the way, the Zuckerberg thing was made me tremble as someone who's in the media, we have on TV.
Yeah.
Where are the ads it's going to come from for linear?
I don't know. The numbers are staggering. When you look at Meta and Amazon and Alphabet, add that up compared to old media, it's not even.
But David, what happened to cop shows, hospital shows? What happened to those? I mean, murder, homicide, NCIS, what is that?
I mean,
do people not watch us?
No, there'll be some advertising for them. It is.
How about comedies?
A good comedy is still a good comedy. Come on.
I'm just saying. Well, yeah, but that's Larry David.
Of course, your point is well taken, Jim. Listen, we ran out of superlatives to describe Meta's quarter on Friday. It added what, $200 billion to its market value. This is a point I made on Friday, worth making again to your point, which is they reduced their headcount, I think, from a high of 87,000 to 67,000.
Wasn't that incredible?
And yet productivity went the other way. What did they triple their number per employee numbers? So, that's what you want as a shareholder, certainly.
Well, look at what's happening with EL today, and that's 3 to 5%.
3 to 5%. Estee Lauder, my Travel Trust owns it. It's been terrible. There's a lot of misclassification they went over. I wonder if the SEC is going to take a hard look at that, even though the cash position was flat. But to go to what they're doing is basically saying, look, there's an inflection point. Actually, Fabrizio Freda called it an inflection point. And when you use the term inflection point, well, then you're home free if you have enough credibility to make it work. And I think the Estee Lauder did. We've got a lot of, there's so much in that. Jeffrey said it was okay. But if you look at the Stiefel note, they're positive on it. And then I think that in the end, what's that?
I got it. It's like a crazy man's kidnap. Look at this.
You've seen
this is what he's working off of. You knew this is what it looked like, didn't you?
I know. That's called rigor.
Help me! I've been taken prisoner.
No. It says didn't cut the margin outlook. Okay, and that's what did it. He didn't cut the margin outlook.
Right.
And then I combine that with we are encouragingly at an inflection point. I use brown for when it's really important. I use blue for when it's somewhat important. And you probably think this is arts and crafts.
Are we finally a believer in this story, Jim? In the EL story?
Gotta listen to this call. I mean, look, I think that there was a heavy short position that once again China was going to take it down. It is a Job-like quarter once again. They got travel doesn't work. They had higher end products. It was just okay. They got China travel. They had China to Korea travel bad. Obviously, when you have duty-free bad, I don't know what's left to be bad. Even U.S. department store didn't sound good. However, given all of that, they still are using -1 plus 1 instead of the consensus was too negative.
Okay.
And that's what did it. Consensus was too negative. And David, just so you know, that's the yellow line. Consensus too negative.
Got it.
Consensus was worse. That was really important. And the consensus was for -2, and they're coming in at consensus was for earnings per share of 208 to 223, and they're going to do it. And the EBIT margin is the same when accounting for higher tax rate. So there you go. That's called beating consensus, David.
We'll talk more about EL. We're going to dive into Caterpillar. Jim Umpleby's with us. Stock's one of today's earnings winners, on track for a fresh record high. We'll talk some McDonald's and Boeing and Tyson. Got some pharma M&A and Kramer's Mad Dash as we count down to the opening bell.
Good morning, retail traders. No, just ER.
NBC.
All right, let's get to a mad dash. About 7 minutes before we get started with trading for the week here at the New York Stock Exchange. You know, on Friday, Jim, I talked a bit about the decline in Charter Communications shares, which impacted the shares of our parent company, Comcast, as well. Had a very bad day also after better than expected earnings in many ways.
Yes.
There's now the follow-on from analysts, not unexpected, many downgrading the stock.
Wells Fargo, they had a buy on it. JP Morgan surprisingly had a buy on it. Now, David, remember
No
Donald
longer.
Rumsfeld?
Neither have a buy any longer.
Right.
Yeah.
Donald Rumsfeld, buy home. Unknown.
Well, their little station is down. Good morning, retail traders.
Is a known unknown.
Hope we had a
What
great
do they mean by
weekend.
That program is coming to an end, which subsidizes people's broadband.
Monday's always a
and-
new day for me, Monday. Then I get some idea on how I want to trade the week. Usually I start creating a good watch list on Monday. You never know what's going to happen over the weekend. Traded Netflix a couple days ago. We got that SMCI up again today. Had a 1, 2, 3 Friday. We got AMD up a little bit. NVIDIA, new high. Or not NVIDIA, Apple. And those Dow was up. CHTR, huh? We got 4 more minutes. Ooh. Yeah, that's a pretty big knife on CHTR. We'll do a 3-day rule on this one for earnings. Maybe Wednesday. But we'll watch it close. It looks to me like people might be stuck in this one. Yeah, it's not good. Ooh, that's real bad. We got a double bottom on the 180-day. There might be something to watch. Oh, mama, I'm excited. See how face-off comes here. Tesla. Tesla could double bottom at 182. We got Amazon and Google. Some of these have had crazy moves already. Microsoft, 420 coming. Eventually. We got Snow on watch. Lily. And we got 2 more minutes. I'm surprised oil ain't had its issues here. Really am. We got less than a minute. PLTR, I got 1778. That was a good year. Banks are pulled back. I got a 123 on Bank of America. Merck's had a good run.
1985.
QQQ, and we got the Russell. Here we go.
Got some more aircraft problems for Boeing. The company says it has to rework 50 of its 737 MAX jets slated for delivery due to some misdrilled holes.
Selling off an IWM right out of the gate.
Fuselages, Jim. Meantime, you got the FT with these comments from the head of Emirates saying this is last chance saloon. We trusted these people.
It's incredible because Emirates has a real substantial Airbus position already. It's been a very good relationship. So, I mean, maybe this is finally a customer of some size that the previous CEO spent a lot of time with me.
Okay, pump your Boeing. You don't put out a good product. Spy dropping. We got a 1, 2, 3 on the VWAP. It's today the 5th. It's the 6th. Major support right here has to hold on the SPX. Fifth. $49.60. On the call side.
You would have to say, well, wait a second. We have wage growth. Is that sustainable? Is that going to cause inflation?
Right. Guys, we did have a deal this morning. We actually
Are you
had
on Catalent?
Yeah, we had a few deals, but Catalent is the one I want to sort of
let's do
focus
that.
on
Let's
this
do
morning,
that.
given both its size and also our viewers may recall this is a company that had just a series of issues. Whether it was manufacturing issues, because they manufacture, their key business is manufacturing drugs for other companies. They're the manufacturing sites for many of the drugs that we know well. Series of issues there. Then in terms of their financials, Elliott came in, activists. There was a deal, or at least there was a thought that it might get sold at one point, and it didn't, but now it is. And at a nice premium. Not at an all-time high. $63.50 is the price. And the buyer here is Novo Holdings. And I have to say, Jim, I was not
NVIDIA's really up looking nice.
these things, but I was not aware that Novo Holdings,
Big spike on NVIDIA.
which is a part of the Novo Nordisk Foundation, basically manages the assets of this foundation, which has over $100 billion in assets, is the controlling shareholder of the company that we also talk about so often, Novo Nordisk itself. Of course, why do we talk about it? Because of GLP-1s, because of its big drugs, Ozempic and Wegovy.
And so therefore, was it quite weird that one entity bought the 3 plants that were involved with the
so the deal is as such, premium deal here for Catalent, which, as you know,
Oh, we got somebody, mic on.
and then immediately they're selling 3 large manufacturing facilities. They own many more than that for $11 billion to Novo Nordisk, which would seem to put them in a position to meet perhaps the ever-growing demand for their products, Jim.
Correct. And I thought
they're paying quite a price, by the way, for those 3 facilities.
I thought that was Elliott Partners, Mark Steinberg, who
Yes.
we know from last week
From
for Etsy.
Pinterest and now from Etsy. That's
But
right.
the person has wide-ranging interests, Mark Steinberg.
Apparently, Mr. Steinberg is a Renaissance man.
Yes. Yes, he's a Renaissance
Okay,
man. But I'll tell you what.
SPY's retesting.
Carl, but let's.
The SPX is retesting right here.
Are insane. Now, someone might have said, wait a second, this has got to hurt Eli Lilly because they're going to have more, they finally have the capacity to meet demand. No! And Eli Lilly's up because this is just one more sign that you can't.
Got one at
make enough of
450
this
here.
stuff. There's new trials coming out. We'll be speaking to Eli Lilly, but I do think that this is once again, a referendum that there's so much demand, and they cannot. There's no way they could meet anywhere near the supply for this. I also find it, Dave, maybe you can stop me on this, but I don't think it really created a lot more ability to make it.
No. In terms of timing and the close, acquisition expected to have low single-digit negative impact on operating profit growth in both 24 and 25. And it's an upfront payment of $11 billion. That's enterprise value for the sites, as well as plus additional value for certain corporate assets and liabilities attributable to those businesses. Now, none of it's going to happen immediately. First, you got to get the deal closed. Oh, sorry.
Someone might think that's GLP-1, but it's actually international.
Right. It's actually also off of earnings, right? So, why don't we talk about it?
Well, the international miss, interesting. The comments, Jim, from Kaczynski about the misinformation, disheartening, ill-founded in international. And then comments about the low end, Jim. Losing some traction among the low end as it's now cheaper to go to the grocery store than it is to eat away from home.
Well, look, this is the Costco issue. I mean, Costco's put through major price cuts. The meat section, it was radical, the prices I saw this weekend. I have to tell you that this conference was not unlike Luxman and Narasimha's conference for Starbucks. Starbucks hurt more domestically, no ties with Israel, but it was, look, I think Kaczynski, I think he's being very prudent in talking about how the lower end is hurt. I mean,
Okay.
the Dollar Tree, they should be. There are consequences to
Not
having,
holding up.
locked
We're at a
into
double
lower
bottom right now.
wages with higher, as Pal said, higher food prices. But one way to conquer is to go to the supermarket, but go to the right supermarket. Go to Walmart
There's my
grocer,
first trade out of the
or
way.
go to Costco grocer,
Blotch.
and you're going to see prices that will make it so you don't have to worry about going out. You'd stay in. By the way, remember, don't forget what America's Best said. Younger people going out like crazy. So
Yes.
it really is low
Yes.
end, no, high end, spend like the darn fool heads off.
Right.
Including at Chili's.
Yes, I know you had Kevin, you had Brinker on the other day, so you're all about Chili's now.
I'm about how many hamburgers. Do you know that I put up the hamburgers? I had like the most TikTok I've had since, well, no, the most TikTok I ever had was when we didn't talk about this, Mr. Hunt. I asked him a question about Taylor Swift, and that was all it took. Suddenly I was in the top 100 TikToks.
Jim, you started the show by talking about earnings and the takeaway that we've gotten, but I would argue that when it comes to technology, the one takeaway that investors seem to have is that AI is ascendant, it will never stop, and there's going to be more and more spending. And that is reflected.
The Goldman and Nvidia piece that we talked about?
I didn't even see that piece. I'm just looking at the stock price. It's up another 3.5% this morning. That is Nvidia.
I said own it, don't trade it.
Now very close, Carl, to a 1.7 trillion market value.
All aboard.
It's really not that long ago. Of course, we can all remember when it just crossed the $1 trillion mark, and here it is 70% higher.
Well, did you have with the Meta comments? Zuckerberg, I wanted to know whether Zuckerberg bought so many of the graphics cards that he blocked other companies. But there's a Goldman piece this morning which talks about all the large Nvidia, Alphabet, now beleaguered Alphabet, I'll call them that. Obviously Amazon, Meta, Microsoft. They're just buying so many of these that Zuckerberg, I felt maybe he's buying now for stuff he doesn't even know about yet. He's betting you'll need them.
Goldman was at 625. They go to 800. I was looking at the street, Jim. Average target now 680. But of the majors, Goldman is the high. Loop still has 1,000. There's some outliers there. But
well, what they're now saying is that 24 is not an inflection. Next year's going to be huge.
Watching Snow and Wolf.
There's really no limit. I mean, the 200 is going to ship. People were confused by the AMD head-to-head NVIDIA because NVIDIA did not have the software stack included in their the contest there. But I think that NVIDIA is enabling you to be able to do a lot more things with chat and a lot more things with AI.
Not working too good this morning.
You know, footnotes started. You can footnote. That's the way you get rid of hallucination. You can footnote things. It started in November with RAG. It's a form of RAG is a form of artificial intelligence that allows you to reference things.
Where do you find these footnotes?
The NVIDIA blog from November is finally come true. It's really excellent.
meantime, last night B of A had a desk note basically just musing about which company is going to make AI click for the consumer.
Interesting.
And this desk's view was that it would be Apple. Whenever that is, it would be Apple.
Well,
do you think that's right?
I think that Samsung right now has some pretty cool stuff where you can just draw a circle on something and then
SMCI looking real good.
Like my wife's mascot, you circle it, then immediately you would see everything because it out pops the Google entry. That could be Edge. We don't know, but the idea with Edge.
Dow Jones is red.
This was. David, that this machine itself will not require you to go to the cloud. It'll be right on there.
And eventually right in there.
Yes. But it matters because if this is more powerful, it will redound to Apple's benefit. And Apple's obviously AI, but Apple's best days are ahead of it.
Wow. NVIDIA. Wow.
Let's go to
I told you about it. You said we'd be safe short NVIDIA. You were wrong.
I never said that. It's a lie.
That wasn't both-faced lie, but I saw it on TikTok.
Take a look at the bond market today. We're going to get some services data, PMI in a minute, and then ISM at the top of the hour, along with SLUs, the Senior Loan Officer Survey, and Bostic this afternoon, 10-year 112. Back in a moment.
Nice little flag on NVIDIA. QQQ pulling back to double bottom. I'll get a reversal here soon. Let me get out of this. Wait. Break. AMD pulled back to support. Amazon. Watch Amazon. I'm still in the SPX here. It's hard to say where resistance is. $49, $50, $60. Got a flag on NVIDIA. I'm squeezing a few more minutes. Airlines are down. Oh, okay. Different time frames, duh.
CNBC.
That ain't gonna work.
Welcome back to Squawk on the Street. Rick Santella here, live at CME HQ with the first of the breaking news events of this week. Starting out with S&P Global, the services PMI. These are January finals that will replace mid-month read. Mid-month, 52.9. Take 0.4 away and you arrive at the final read of 52.5, best since July. And even though it was downgraded a bit. Now, if we look at the composite, 52.3 was the mid-month read. It also gets downgraded by 0.3 to 52.0. 52.0 equals August and July of last year. To find a higher number, you have to go to June.
SPX 4960s. Break it.
Services PMIs to come out, and that'll be top of the hour. Do keep in mind,
kind of stubborn this morning.
A bear steepening, less inverted on the yield curve. Rates across the curve are higher, but they're higher in long maturities. And the dollar index, it's on pace for its best close since mid-November. Squawk on the Street will return after a short break.
Got a bunch of watch lists that are up. There we go. A little bit more. Bitcoin ETFs are green this morning. I'm about ready to exit my trade here. We're at 490 now. If we break out, that'd be a very nice ticket, but I'm not sure. I'm going to go ahead and take profit at a double top. SPX. And leave one on the table.
Caterpillar.com.
Baka.
Caterpillar hitting a fresh record high after posting an earnings beat and many other things that drive this stock. We've got Caterpillar Chairman and CEO Jim Umberlees joining us exclusively now. First, Jim, I'm just going to outright congratulate you because I know that there were some last time you reported stock goes down.
Now we got an inverse head and shoulders.
And you were very clear on Mad Money that this
AMD, more drama. I mean, Amazon.
Does the breakout include?
And AMD also.
Points since that interview.
Well, thank you, Jim. It's
Meta's
great to be with
pulled
you,
back
Carl,
some.
David, this morning. Let's just start by
Okay,
just thanking our
watch
global team
Three
for
Black
our
Crows.
strong quarter and an
AMD.
outstanding 2023 record financial performance. And to answer your question, what's
3 Black Crows on AMD right here. Yeah, don't trust the market too much. But I'm going to check out these AMD calls. February 9th. The 185 strikes. They can't dip from any more from here. What about that SMCI? What's it up to? Damn, I can almost put it on this here. This thing's running. SMCI. I don't know what they're freaking out on AMD for. New high on SMCI. Okay. AMD faces new challenge on China advance. So China. We'll stay away from it for now. China.
China.
Oh, yes. NVIDIA is going to squeeze any moment. SMCI really moving.
market right now that's rewarding winners more so than looking for kind of the stories that are unfolding and somewhat mixed. But
still got one SPX.
Your guest was optimistic on both these names and saw potentially more upside in Gilead because of the more depressed multiple. But with this earnings event on the horizon, looking at a neutral to bullish strategy, selling a put vertical.
NVIDIA broke out to a new high.
The February monthlies, the 75.70, looking for about $1
Called it.
credit. So
The breakout on the flag.
you're going to risk 400 to make 100. Break even will be 74. But for a stock that's trading 76, 77, you take a little bit more risk for that break even that's below the stock. So you don't actually need upside. You just need the stock not to go down or hold on to its value. If it does go up, that's fine. If it goes down small, that is also fine. Anything above 75, you would keep the credit received if these options expired worthless. In the event that there was some type of substantial downturn in the stock, 20, 25%, let's say, around earnings for whatever reason, you will be insulated to that max loss of 400. So you have sort of the protection against the really scenario, negative scenario to the downside. You don't participate in tremendous upside because you do have that defined profitability, but you have a relatively higher probability of success than, let's say, just buying stock because your break even is at 74 as opposed to the real-time price of around 77.
Seems like a trade that makes sense for kind of a range-bound stock. If you don't expect the range to really break, but you don't want it to break to the downside, obviously, then you can be secure if it does. So you can take advantage of most of the outcomes within the range. Basically, it's like all of them pretty much. And that's kind of the way Gilead's been. It's done a lot of chop back and forth between like $75 and 85, basically. Vertex, how about that one? Let's go
Yeah, we
back
talked
there.
about a market that's rewarding winners. You look at names like NVIDIA, look at names like Lilly. They just continue to make new heights. So Vertex, which has done a little bit better, if you're looking for more just direct upside, let's say, in a name like this around the earnings announcement, maybe you look to something like buying a call vertical, which is a little bit more outright bullish. Now, at the time, the stock was trading closer to 425. So these prices may already be relatively stale. The idea would be to buy one strike that's in the money and then sell a strike that's out of the money. Look to spend about half the width of that spread. So in this case, it was a $5 wide spread. The stock was trading around 425, and I looked at the 422.5, 427.5. You're able to do this for a 250 debit. Granted, these are a little bit less liquid options. Things tend to be a little bit wider, so risk definition could be important there as well as price discovery. But it creates a 1-to-1 risk-reward ratio. So a stock can go up and go down. Now we know it can also kind of do nothing. But in the event, with this type of strategy, with a tremendous amount of volatility around this earnings event, this is a situation where it's likely, just with that $5 wide window, to be all the way in the money or all the way out of the money around this earnings event. Now, it does have a little bit more time as it goes out to next Friday. But the idea here is you're risking $250 for a chance to make $250 in a directional, play with the break even near the current share price. So if the stock did absolutely nothing, you would look to break even. Really, any up move, you'd be working towards max profit, and really any down move, you'd be working towards max loss. And that's evident by 15, 20 minutes passing since I looked at this, and it's already fully nearly in the money. It just goes to show dynamic markets, how much this can move, as that $5 wide window is about a little bit over 1% on a $425 stock.
Okay. All right. Makes sense. Stock's been doing pretty well, and more bullish, more discreetly bullish than the Gilead trade. I think makes sense and resonates with what we heard from Hard Josh. Thanks, Alex, for the trade. All right, we'll come back, give the other half of the data this morning. Do you have any ISM services coming out in a moment? We'll be right back.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education, crafted just for traders. Also, you can trade brilliantly.
to Schwab Network.
Daily live exclusive content tailored to today's investors.
Broadcasting 24/7 from our studios in Chicago.
And from the heart of Wall Street at the New York Stock Exchange.
Up-to-the-minute market insights.
Example trades and stock-specific analysis featuring the smartest minds in the business.
No politics.
No noise.
Analysis ahead of the biggest events for the economy.
From bell to bell and beyond.
Watch live
and on demand.
24/7, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services.
Available anytime, anywhere.
On any device for free.
Schwab Network, empowering every investor and trader.
Every market day. Empower your portfolio with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Morning Trade Live. A little bit of action here as bonds sell off some more. We do have data. We're going to take a look at the ISM number for services alongside the PMIs that we just saw for the composite above 50. Russell's getting smacked around a little bit. Nasdaq down about 20 bips, but don't forget also we sold off a little post-close yesterday. I was just reminded by Mr. Coffey. So some of this happened after the close Friday. But we are right across the board. Over the next hour, we've got a lot more stocks to talk about. We're going to take a look at charts, fundamentals, technicals, everything.
Little knife.
Palantir, talking about that stock here in a moment. The trade of the morning.
Big knife.
Alcoa, Alan Nuttman is going into steel and metals. We'll discuss REITs and real estate after a regional bank scare. Should you be concerned about the commercial real estate in America?
Be careful.
Master, NXPI, Eli Lilly, and Spotify, which just inked another deal with Joe Rogan as we continue to look at earnings ahead this week. Right now, I've got Ben Lichtenstein, host of the Future Show, every morning before.
Nvidia pulled back his support, but I don't know if it's going to hold.
Small cap spin, and bonds sold off some more, so I think we should talk about the data.
Bonds sold off more. SMCI pulled back.
What we've seen, the Russell, the standout player, taking a look down almost 2% on the day. So small caps coming under pressure. Oliver mentioned yields on the move higher. I noticed the dollar up and through the 104 handle convincingly now. We're talking new highs for the year against all of the G10 currencies except for the Canadian dollar, the Chinese yuan, also to new lows here. And I think, to Oliver's point, some of this is tied to what we're seeing here in terms of the data. So earlier this morning, we had the PMI number. The S&P Global Composite PMI came in at 52. That was higher than prior levels of 50.9. It was below expectations, though, at 52.3, and the services PMI came in at 52.5. That was below the expectations for 52.9, but higher than the prior levels. And that's going to be a theme that you're hearing about in terms of these numbers here. All of them were higher than prior levels. And taking a look here, Oliver, at the most recent numbers that just came out, the ISM data, this is strong across the board. And this is going to send stocks lower.
Oh, look at bonds right now.
It's going to send bonds higher and, yields higher. I mean, taking a look here, Oliver, you've got the ISM non-manufacturing, the employment, which is now gone from contraction, 43.6 to 50.5, so back above 50. Taking a look here, they were looking for 49.4. Non-manufacturing new orders, 55.0. That's above prior and consensus levels. The non-manufacturing PMI for the ISM coming in 53.4. But really what stands out here, Oliver, is look at the non-manufacturing prices, 64. That's up from 57.4 prior. 56.5 is what they were looking for, and this is definitely not what the Fed wants to see. Coming in again at 64. I'm just going back to see.
That happened in the manufacturing number too. ISM manufacturing, we saw prices paid pop as well. So this is now 2 in a row that inflationary component surprised bigly, as they say.
Highest we've seen since March of last year, spring of last year. So. Yeah, definitely not what the bulls are going to want to see here. Definitely a sign of what we saw Friday, right? Strength in the economy here, whether you're talking labor.
Bulls ain't happy.
Again, in the services sector.
Okay,
So bonds moving, you got the 10-year index up there, multiplied by 10. So we're at 416 right now. 0.75% drop in bonds. So here's the thing, though, is that last week, even with the spike in yields on Friday following jobs, we were still
new all-time highs.
Below the yields for the week. So this morning, now we're kind of, I feel, still catching up because bonds probably should not have been rallying when Powell kept saying no March, no March, no March last Wednesday. So it feels like we're still kind of catching up here. The bond market was a little bit asleep at the wheel first half of last week.
Catching up or digesting, I would say. I mean, this is a market that right now has have a well-defined upper extreme established at 5%. We got a pretty well-defined lower extreme here around 3.7, 3.8 here at this point. So not surprised to see a bit of a chop type trade within this range, but very supportive of that longer-term narrative, kind of 2 steps forward, 1 step back in terms of the rally we've been seeing in stocks. That's progress. Oliver mentioned the rally we saw Friday to near 4,200 in the S&Ps. I mean, I'm sorry, near 5,000 in the S&Ps, a significant move to the upside here. Oliver, as I take a look here, I think, again, if yields, the market feels, I feel like it could stomach yields even inching their way up a little bit here to maybe 4.5%. With strong economic data is what we've seen here. The market doesn't mind seeing yields higher if it's backed up by strong data, I feel.
This being the inflation component, the hot part, may not be that way this time, right? With the prices paid.
Okay, may not be, but we're not necessarily seeing we're not at a point where the Fed's going to shift to,
hiking.
No, I mean, we're still in a very kind of pause phase right now. The one thing that I would keep an eye on is U.S. dollar, because we have seen that starting to inch its way up. So a reflection of that pushback from Fed expectations, but also could create a bit of a headwind for stocks at this point. That would be maybe a bit of a fly in the ointment. But here you can see, and the reason I say that is working our way through the middle of this range opens up a door for a retest of the upper extreme, as I always say. But even still, very much range bound at this point. I feel like the market, with the strong data right now, could stomach higher rates. 2 steps forward, 1 step back. Again, we might see some pullbacks, but the trajectory's still been to the upside.
That's the big test. How long can stocks rally alongside higher yields? So
pretty good sell-off here.
Inflation-linked data might be a little tougher with jobs, but we'll see. Because last Friday was real strong. Because the equity's making all-time high. The yields up. Going to test that again this morning. Good look at the
Be
numbers.
careful.
Very important ones. Thank you, Ben. Okay, Mr. Lichtenstein hosts the futures every morning before MTL. A little bit of a shake-up in markets. Bonds selling off pretty big now, 0.75%.
We got a pretty good drop to the 9.
Let's talk about what's ahead of us. Markets correspondent Diane King Hall joining us again from the New York Stock Exchange as we talk some Palantir here.
Old resistance will become support if it does dip.
Volatility with some of its government contracts. What's the tone right now, Diane?
Look, the stock is trading water.
Somewhere close to right there.
Report its quarterly results after the bell today in terms of what is expected. Adjusted EPS expected
491.11.
Revenue expected to come in at 603 or a little.
That has to hold. Well, I think that has to hold. Let me see. That might not be it.
What will Wall Street be looking for? Customer growth. Will it see customer growth in commercial? Obviously, it has strength in government.
Let me just go back and look at that 3-year.
Reported in November with the NHS, National Health System over in the UK.
Yeah, 470, 480.
Access to a massive trove of data.
480 is your low support.
Health data, so it was a controversial choice for Palantir to receive that award with that contract. Now it has that contract in partnership with Accenture, PwC, and a couple others. But again, it will be the customer growth, and especially also on the commercial side, that will be looked at today in terms of its results and what extent has AI helped this number. It's a data analytics company. AI has been a big part of the story when you think about companies like this and all the tech companies that we looked at last week. So that will be one of the things in question today. How much is AI helping it grow? Earnings guidance, another thing. We'll get outlook. We'll be looking for outlook on 2024. What does the picture look like in terms of expectation for where future growth will
Cheaper to eat at home, huh?
And then, of course, also the overall longer-term
Well, McDonald's charging $18 for a freaking Big Mac meal. That hamburger probably cost them
It's always that kind of mystery of
$1.75 to make.
Palantir. It's been a good year, but it hasn't been without.
But the overhead.
Revenues are going to rise from a year ago, which is good, but you know, we're talking low double digits, not quite what people thought. I think when this company, you know, debuted at almost $40.
That's right. I mean, look at where it is right now. It's at $17 a share, so certainly not where it has been previously. And so today the question will be, can it grow its customer base? Can it grow more outside of just the government space? The commercial growth you saw in the third quarter, it did have some better than expected growth there in the third quarter. Can it keep up that momentum? It had double-digit, more than 20% growth in terms of its commercial revenues.
AMC taking a beating.
In this latest quarter, and even when you
DWAC moving up.
Contract,
DWAC.
We don't see those numbers yet because it just secured that contract in November.
Got it. All right, nice. So good perspective here for us. Some of the existential stuff with these big contracts for Palantir kind of moving the needle outside of earnings. So now time to see what they can do on the bottom line. All right, thanks, Diane. Good look ahead here for the stock. We know another person watching the earnings. Mr. Alan Nuttman joining me here in studio in Chicago. All right, Alan.
That kid's still pumping AM. It's going to be a big week for AMC.
You jumped me a little bit last week.
Oh, God.
I brought up that it was down a couple of bucks, and I asked you which expiration was. And I said June, but if you look at it right now, it's essentially back to break even from what we did. So it's still in a range. So the range is telling us that we're going to get a breakout move. You know, when my indicators are looking for positive action, I've got a June option. This could be the catalyst, but I'm not using this earnings as the key indicator. I'm looking at the fact that I've got a bunch of time. I'm seeing a lot of leverage accumulation on this stock. So there's a lot of positives that I'm looking at in that stock, and I've got a limited risk option. So we'll see what happens with earnings directly, but I like where it stands for between now and June. June's a long ways away.
True. Where's your pain point for Palantir? We're at 16.8.
Yeah, my pain point is always in, you know,
way down there.
Is half of what you pay for an option. Okay. So that's math. I just try and make it simple math. So if you lose half your value, either the stock's gone the other way or the market's run out of time for that option. So there's still plenty there, but we've been in this range. Let's see how it reacts. And I'll look to see, you know, the breakout and see if it's a fake out breakout or you get some follow through, because that's more critical than the actual initial reaction for me as a trader.
Got it. All right, for user trading, we're also watching S&P 5,000. We're so close. We're going to get it this week.
We got within 25 points.
Yeah.
Now, you've got to like Friday's action.
Hey, for sure.
I mean,
Stocks up, yields up.
Everybody is like, oh, the market's too hot as far as, you know, everything's too hot, economy's too hot, too good. When was the last time you said that? Say it out loud. I'd like to say it out loud. I'd like to hear you say that the job market is too hot. Well, exactly. There's not, but people were using that as an excuse to knock down the market, and I'm like, well.
That's why Friday was so big. You go up stocks, we're okay with it.
Right, and the market reversed after opening lower.
I don't think it is as hot. I don't think it is as hot as they say it is. I don't.
I thought that was the start of something. Obviously, it's taking a little bit of a pause right now, but that's why I look at long game. So
your stock conviction though is not dependent on bonds.
No,
that's one thing that I've gathered from you.
Right, that can be an accelerator if it starts working with me. That can be a catalyst, and that's really what I'm looking for. The next catalyst I'm looking for in stocks is when yields break down below 375. That target's 325. That's going to be a huge tailwind. And there's still a chance that we could get a cut in the next meeting, but looking at the numbers for May, there's 65% chance of a cut, and there's a 10% chance of a half point. Half a point cut, there's a 10%. So 10% is not negligible. That's somebody sees something.
The May half a point?
Yeah.
So they think if Powell
I don't know
March,
what they think. I just
regret
trade. I don't even think I don't care what people think. You know, if you were that kind of person, you could watch the 60 Minutes from last night, and he said three more cuts are in by the end of the year. So I trade.
60 Minutes?
I trade with the market. I trade what I see.
Now.
I got the headline. I trade what the market tells me, and the market is telling me there's a 10% chance. So that's pretty
for the
confidence.
Double. For the double cut.
Yeah. So that's confident.
All right. You're trading Alcoa this morning. What's up? You think it's steel?
There goes SMCI out of the channel, out of the bull flag.
This is a stock that is what, 70% off its 2022 top. It was at $98. So from risk reward, you have to be very selective now with the market conditions and the move we've already seen. This is a stock that bottomed out, and it did have a nice healthy bounce. I mean, it doesn't look like, but if you pull up the chart, when it bounced from 25 to 35, that's a pretty big move. So we made some money on Alcoa, positioning there with these in-the-money options, took some profits as you know, as I follow my plan. Now we've come back inside that range again. So
stabbing again. So
going after it again, a second chance attack. Again,
Double top.
The stock is way down. From
Now we're going to see what's going on with this thing.
Between 25 and 35 for the last 6 months. Okay, so 30 is kind of an important pivot as you watch it on a weekly basis.
627.94 is the number.
Once again, and again, I'm looking at.
And we just got a new high.
The way to play
SMCI.
This particular stock again.
AMD.
Way down.
Double top on Apple.
Just this time last year.
Like it? All right. Taking the round 2 for Alcoa.
Round 2, so I'm looking at a 25 call for July.
Okay.
6 months of time. Again, that low is near 25. Give me the right to be long.
I want to get a put really on SMCI.
That bullish divergence, meaning it made new lows when it made that low, but not new highs implied volatility. That was a sign of a sentiment shift, and that was what our signal for the upside. I'm seeing a lot of leverage buying right now. And we're right now at about the 200-day moving average. So
These things are freaking expensive.
From risk reward, I like where it's
580 put
that from a value standpoint.
for 650.
It's a hard market right now because, you know, Meta went from what, 100 to 400.
Yeah, 80 to 480.
Yeah, I mean, geez, you know, some of these things you missed out on, but, you know, there's still great opportunities, still some stocks that have a lot of upside if you're bullish.
All right, like it. What you are? Looking for that S&P.
Bullseye option.
Appreciate
there's bullish.
Yeah. Well,
oh, leave that alone. Leave that alone.
I don't know, you're chief market strategist. At bullseyeoption.com. All right, when we come back, let's talk some REITs. There was a bit of a scare in real estate last week as regional banks almost hijacked the economic discussion.
The SPX.
About commercial properties. And how does
Oh.
it balance, though, with the very
Well, the SPY didn't hold.
side and residential properties?
This huge sell-off today.
Talk real estate next as markets are dealing with a
Could be a Monday flush out.
bond bears are back from Friday, selling off some more after ISM and PMI services came in.
SPX was at $1 just a second ago. And I thought about the trigger here. If I move these up to 49.50, 49.50, SPX.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Wrap up the trading day with me, Oliver Rennick, for the biggest earnings coverage, 3 p.m. Eastern. It's Market on Close.
Okay. SPX calls.
In the Schwab Network.
All the need-to-know info from every trading day. I'm Renita Young. Earnings, data, the biggest headlines that move the market, all condensed into a few minutes. Download the Schwab Network app and join in on the latest market trends, available anytime, anywhere, on any device, for free. Recap your trading day with the wrap, right here on schwabnetwork.com.
Kickstart your morning with a full dose of commodities, technical analysis, economic data, and live reaction in global markets. Available anytime, anywhere, on any device for free. And available on all your favorite streaming services. Futures with Ben Lichtenstein every weekday, 8 a.m. Eastern on the Schwab Network.
Morning Trade Live. Let's talk some real estate. Last week, a blow up in New York Community Bank after earnings. Everyone's scared about commercial real estate and office space again. Joining us from Vert Asset Management, Sam Adams is here with us, the CEO. Sam, welcome back and good morning. Thanks for being here.
Thanks for having me back on, Oliver. It's great to be here.
Appreciate that. All right, so let's start kind of going back a little bit, because last week we had all these things on the calendar, and then regional banks almost hijacked everything after the New York Community Bank thing. So I know you don't cover the banks, but from the real estate and the REIT connection through the office space, what'd you make of that?
Well, it's always scary when there's trouble in the banking system because obviously REITs borrow an awful lot of money to finance their properties. And so there's usually a connection between the stock market moves for REITs and what's going on in banks and, of course, in interest rates. And that's why so many REITs have been beat up for so long. But a lot of investors haven't caught up with what REITs have been doing over the last 10 years, which is really de-risk their debt portfolio. They've lengthened the maturities of their debt.
They have.
Captured the historically low interest rates. And so all these interest rate rises we've seen recently and trouble in the banks aren't going to affect the quality REITs because they've got 7-10-year terms on their debt. You know, they're paying 2 or 3%. They're not feeling these interest rate effects, and they're not troubled by these problematic banks. That being said, you know, it frustrates the markets. It increases uncertainty, and you see the weakness in the stock's result.
Do you think that there are time bombs or landmines in the commercial real estate market, particularly office stuff?
Yeah, there is certainly some problems there. We saw this previously in the retail sector, in the mall sector, right? There was a lot less need for malls, and so a lot of the weaker players got kind of flushed out. There's a couple of bankruptcies, but most of that was confined to the non-public stuff. The REITs that are publicly listed are pretty disciplined around some of these things, so you didn't see a lot of problem with those. More of the guys that had Class B, Class C properties, they struggled. The Class A guys, they've done well, relatively well, right? REITs have been, like I said, been getting beat up. I think we're going to see a parallel here in the office space. There's a lot less demand for office now, at least for the coming years because of work from home. And so there's going to be some Class B offices, maybe in suburban areas, that are just not attractive to anymore. They won't be able to lease them. Those are going to struggle. But I think the signature properties, the downtown, headquarters, where companies want to host their clients, those properties are going to be fine. And so it really depends on where your properties are located and what quality they are on whether or not you're going to be okay. I would lean really hard into the Class A, really high-end properties through these difficult times.
Really seems like it's going to require a lot of homework to properly invest in this group. I guess no blind buying of ETFs at this point. I mean, it sounds like there's going to be a lot of stuff mixed in together.
Yeah, I think there's a, you're going to find some weakness in the public guys. You want to stay away from those guys. A couple of filters you could use that we use are, excessive debt. If they have too much leverage, just, stay away from those guys. We lean into the guys that are focused on sustainability initiatives. That does two things for them: lowers their cost. If you're using less energy, if you're using less water, creating less waste, you have less cost.
Okay, we're at a breakout point right now on the SPX.
Initiatives that give you higher revenue, higher ability to charge higher rents. Nowadays a lot of companies have a sustainability program. Their headquarters, they want to be a LEED certified building. They want outdoor space. They want, natural light. They want all these amenities. And I think that's a good proxy. If you have say an office REIT with a lot of green certified buildings, they're going to have the higher quality buildings, the ones that are in more demand going forward.
Okay. One of the things that does seem kind of, I guess, positive for the group is that at least everybody's talking about it, right? So at least it's kind of a known risk. But is there a timeline that's a little harder to put our finger on? Like, when will the stressed properties really get that kind of debt wall? Because it seems like this group moves pretty
Damn, I had
directly to rates. When
295.
right now, generally the sector is down. It's like they really need the cuts quickly. And is that the truth?
Well, I think there's guys that are in trouble that they're like, you know, the mantra was survive till 2025. That was for those guys. And now they're like, ooh, maybe that rhyme doesn't work anymore. We need a little more time. But like I said, the high quality public REITs, they've got their maturities out to 7 or 10 years. They're not paying extra.
SMCI is getting ready to squeeze. I don't know which way, but we did break out of the 1, 2, 3 on the bull flag.
Portfolio is not driving higher costs. Meanwhile, the economy is still strong, right? They're still having low vacancies, and so they're doing quite well. You saw that in most of the REIT subsectors, with the exception of office. You know, residential and industrial, they all went up plus 10% or more last year. Office only went up 2%, but that means there's an opportunity there. There's some office REITs there. Vornado comes to mind, and you know, they have a big Manhattan portfolio. If you really think that New York's going to go away, then yeah, you don't want to hold Vornado. But if you think New York's going to come back, you know, Vornado's a good play. That's kind of where it's going to end up. I don't think the specific debt situation for that individual REIT or some other ones is going to change things. They've got time. They've got 3 or 4 years at least to get back on solid ground, and already many of them are signing up new long-term leases. So I'm not concerned about the high-quality public guys.
Right. Well, as a former long-time Manhattan resident, my last 2 trips back, it sure felt like it was back. A lot more than it was a year and a half, 2 years ago. So it seems like it's still pretty good regional play.
Yeah, and there's certainly going to be some offices there that, you know, people aren't going to. They don't want those Class B offices anymore. But Vornado holds those signature towers that people want their headquarters in. And I'm glad to hear you say, as I've heard other people say, that New York is back. Would never count them out after all the things that they've been through over the years. They keep coming back strong.
Right. Hey, Sam, to come back to SPG for a sec, because a lot of folks kind of see this as the stressed, you know, mall REIT, but the shares have done quite well. And your point about sustainability, I just wanted to come back to, because I think it's interesting from, I guess, a profitability standpoint for them.
Yeah, there's 2 ways that sustainability for malls can drive more revenue. You know, like I said, it's usually a cost-saving thing, but if you put more different types of amenities, you reduce the amount of distance people need to travel. This is a concept called urbanism, and if you put retail and entertainment and dining and theaters and you know, gyms all together in one place, that means people will go there, spend more time there. That's increasing foot traffic. That drives more revenue to the retailers in the mall, right, which drives more revenue and longer and better leases for the mall owner, in this case, Simon Properties. And there's lots of different ways they can do this. Another way to do this is with EV chargers. Do you have an electric car, Oliver?
I
Or
don't.
have you thought about buying one?
I definitely have, but you know, I like to travel. I can need better range.
Yeah. Range anxiety is a real thing. I was in the Bay Area doing a road trip in December, and my car was getting low, so I was looking for a place to charge it up. I punched in the app where I was, and it said a couple exits, take a left here, and it was really convenient right off the freeway. And I plugged in my car, looked around. I'm in a mall, right? I'm like, oh, okay, well, I'll go check some things out, do some Christmas shopping. Now, I don't shop in person hardly ever. I do it online, but I was there at the mall. I had a half an hour, 45 minutes to kill.
Going shopping at the mall.
Why not do it there, right? So that's an example of putting in a sustainability amenity.
So AMD's got China problems. Apple's pulling back from the double top. Good eye.
It's pretty good. Hadn't heard that part about it before. I like it. Great details, Sam. Appreciate the deep dive into the sector. Good stuff. What's that? You got Zion National Park behind you?
That's actually French Alps.
Oh, wow.
But it looks like Zion
Why
because
does
it's
it look so
orange,
dry?
right? That's the color from Zion, right?
All right, cool. Thanks for the time, Sam. Next time, bring us a Chicago REIT.
Oh, yeah, well, Vornado's got the big building in Chicago, so I mean, it's not technically a Chicago REIT, but they got a big building there.
Good stuff. Fun chat. Appreciate it.
Thanks. Bye.
Tim Adams, CEO, Vert Asset Management. All right, big French Alps guy. Nice. Can't take the EV there. Chartmaster's coming up next. We got Chipmaker with NXP. We're going to take a look at Eli Lilly for biotech and Joe Rogan's platform known as Spotify.
Knock, knock. Number one broker here for the number one hitmaker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only format you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
Every morning, every trade, always live. Expert earnings analysis, in-depth technical insights on every changing trend in markets. Available anytime, anywhere, on any device for free. Welcome to Morning Trade Live on the Schwab Network. I'm Oliver Rennick.
Get each and every angle, the whole picture. Everything comes full circle on Trading 360. Catch us right here at the New York Stock Exchange on Trading 360, only on Schwab Network.
Download the Schwab Network app and join in on the latest market trends. Available anytime, anywhere, on any device for free. Schwab Network.
Accelerate your market knowledge and shift your perspective into full gear. Real-time example trades, a full hour of trading insights. I'm Tom White. I'm Kevin Hayes. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Our earnings prep continues with some charts. The chart master team, Rick Ducat, Jim Horn. With NXP to kick off here. Let's keep talking some chips, Jenny, and autos. Tesla's at 6% right now, by the way. All right.
Brutal.
Yeah, unrelated, but kind of with NXP, big car market.
Yeah, you can always make the connection, and we did hear from On Semi, which did mention.
I'm gonna go get my coffee going and be right back.
Something to consider for NXPI, which does report today after the closing bell. Although I will say, we've been looking at some of like the laggards of the semi space. This name is at least
SPX broke out of the flag and consolidated. Mike said something interesting here on the weekend.
of its revenue guidance is be about 3% year-over-year growth.
He was talking about strategy, about catching the knife.
That would indicate growth of about 2.5%.
What was I getting ready to say?
Also had a pretty healthy history of beating.
Yeah, what breaks out,
4 quarters. We also
many times will come back and consolidate. Come back and find a support.
Overall, its radar system.
So don't ever think you missed a trade just because you missed the breakout, because a lot of times they will pull back.
Yeah, and that's
I mean,
where
a
I
lot.
definitely see it related to Tesla, but estimates for its automotive revenue are currently pegged at around
They always pull back and consolidate. That's why I say wait. You got plenty of time when you're taking a knife. Snake, break out, pull back, boom.
However, this is a company that's fairly China exposed, so right now that is expected to be a considerable headwind.
Retest of the breakout area, exactly.
And we also are expecting its mobile segment revenue to drop about 6%. So bit of a mixed picture. So it's interesting because a lot of the growth estimates are sort of leaning on that automotive segment. Any disappointment there, we could see, I'm sure, a disappointing revenue result.
Relies on that because they're expected to squeak out a small gain on the top line basically because of that.
Exactly, and I also think we talked about this last week, where it's like these automotive exposure is like a tailwind and a headwind, because when things are going well, it's going really well.
Yeah.
When things are weakening as they have been, typically some of these names are sliding.
A lot of these chip
I'll be right back.
that before were kind of secular growth stories as being the first ones to really put chips and all this tech into cars. Now they're becoming a little bit more cyclical, becoming a little bit more kind of tied to the autos, as the charts have shown. I mean, NXPI is not a bad chart, Rick, but both on Semi and NXP going into their earnings were a few of the chip makers not at highs.
Yeah, not bad, but certainly not anything to write home about in terms of this chart. We can see we had a nice move upward after those April earnings that we saw. Gave back some of those gains, then a notably sideways period for a while, creating this large volume node here, centered around the 200 level. So this volume profile study shows areas of heavy trading. Then we had a bit of a V-shaped downward move here, took us back up into our 52-week highs there, then gave back some of those gains once again, here trending more sideways here. Between like 204 to 224 or so, those are the areas to be watching in the short term here. RSI, not really giving us much of clues for directionality or any kind of bearish divergence or bullish divergence or anything like that here. It's just, hanging out here, coming into an increasingly smaller range. Let's see if we can push above those highs that we established during our last rally upward here. That would be a bullish sign here, especially if we were also to take out this resistance right here. So, in terms of our trend assessment, we're above all three of our moving averages that we follow. Yellow 21-day, orange 63-day, purple 252-day exponential moving averages. They're all tilting up, albeit somewhat modestly in terms of the shorter term exponential moving average. But, so that gives us a bit of a lean toward the upside, especially because RSI is above that 50 midline as well. So, 224, old highs right here, that's the point to beat. Then, our best closing high came in near 223, and even though we had some activity to the upside beyond that, we didn't really get a close that was beyond that level. We closed around that point near 233 several times here, so that's a key area to watch to the upside. To the downside, right around here, we've got a few things. 21-day EMA, a gap right here that began, it was breached and filled and everything, but still perhaps worth noting, right around 214. Then our 63-day EMA near 211, ultimately then 204. That gap, or not the gap, the highs and then lows that we established.
A lot happening at that low 200 level. It seems like it's a chart that's more about kind of stability between 200 and 215-ish rather than momentum in either direction. So maybe we get kind of
There's the knife. Dadgummit. I knew it. I knew it was coming.
An interesting one because OnSemi didn't have great numbers. The stock is rallying big anyway. So, all right, nice perspective. Like the chart. Let's keep talking pharma. We spent a good time this morning talking about biotech, and Novo's got this deal for Catalent the market is liking. Eli Lilly has been a big winner, so it seems like there's quite a bit of optimism building in this sector, Jenny.
There is, and I was actually looking at its performance over the last 5 years, because it's been on a pretty breathtaking run. It's a 440% run.
Breathtaking.
The last half a decade.
That is breathtaking.
It is breathtaking. No pun.
Adjective reserved.
You're right. No pun.
Is that like a weight loss pun?
I probably could have done a little bit better, but I mean, essentially, that's what the strength is all things tied to, is obesity as well as overall just diabetes. And its weight loss drugs. I mean, it's grown its revenues from about $21 billion in 2018 to an estimated $34 billion for its full year in 2023. That's pretty healthy growth, and it's expected to continue as this trend persists. So they did, and for example, in November launch an approved Zepbound for chronic weight management. However, its evaluation at this point is becoming somewhat suspended from reality because it's trading over 100 times its 2023 earnings. That's crazy high. So I do think it puts it at risk here for then any sort of slowdown in any of its weight loss drugs. We could see this thing crater because right now there's such momentum. I mean, Nova's no exception either. They're just, right now it seems like that is all anyone can talk about in the pharma space, but I just always worry side effects, long-term effects, when people start, maybe wanting to wean off these drugs. What does that look like for Eli Lilly? It's concerning.
PLTR.
Thing's never had
Okay, we're at support now. On the top of the bull flag.
Red candles anyway for a year, which is super bear, even for a stock.
But this has had such a huge run. I mean, I'm with these guys.
Yeah, that's a good point. We were talking stomach punch.
I really am.
Stomach churning. If you were bearish in this game, because we're up.
I did call my irrational exuberance video out last week, but then we had a big breakout.
Went from strong to stronger to even stronger here, because you can see that we had this gap up on earnings back in July here. We formed kind of an ascending triangle type pattern here, kind of a more narrow one, but we had the concept is the same, bouncing around between our support and resistance here, horizontal resistance and a trend line.
Get back in this trade again.
Acceleration of trend then. We broke through our moving averages. We had this shorter term channel between our two white.
I wish I had the nerve to short this sucker
to the upside today. We're up more than 6%.
to that one support level at 480.
Into the overbought area. 84, quite a high reading. Remember, RSI only goes up to 100. So getting
balls, exactly.
Is worth taking note of here. Look for the crossover back below the overbought area for a bearish signal. That threshold is 70. Now, if we were to zoom out,
Vic's showing some 3 green Italians.
Potential resistance here. We take our blue linear regression line, our line of best fit based on closing prices. One standard deviation to the upside comes in just about at 678 or so. One area to watch potentially. Not saying it's going to make it there, but that is based on our own price history, a potential resistance point. Support, post-gap high, or pre-gap highs, 672.62. Then our linear
SMCI fell inside the channel now.
There will be some supportive areas to watch in the shorter term.
All right, nice. Eli Lilly, a lot of momentum behind it, and even by its own standards, pretty hot in the last week here for the chart. Okay, good perspective on the momentum there for Eli. Last one, Spotify and big Joe Rogan deal renewed.
$250 million. And people are mad about that because it's like controversial, and it's like, hey, if he gets views, I mean, you're like he gets an audience.
Yeah.
So not views, he gets listens, but still, nonetheless, I mean, it's pretty major deal. They shell out for their podcast business, which has actually been.
You got a double bottom on high or low on Apple.
Top line growth, but hey, for this quarter, we're still expecting really strong figures.
Meta.
Profit last quarter, and even though we're expecting losses per share at about 8 cents this quarter, it would represent an increase.
Let's see if SMCI wants to pull back to this bottom support. Means we broke the channel of the bull flag. I want to see if it pulls back to this bottom one. In fact, I'm going to set an alert.
They did also raise the prices of their subscription earlier this past year.
I'd rather see it right there exactly at 604.20. But I think that's asking too much. So we'll take it right there. It might bounce. We got some hard resistance here.
So that's huge as far as offerings go. But think about
You got to play it safe today.
like you end up making more money from that offering. So they have to figure out the right way to like have their consumers happy with like the proper offerings of audio, podcast, streaming, while also not spending too much, right? Because like right now, Amazon owns Audible, which you pay per book, so it's expensive, but like they're making money on it every single time you purchase a book. I understand that this would just be like a catalog available to subscribers. That's expensive.
That's kind of the thing with the hundreds of $1 million deal with Rogan's out there. Wow, good for him.
Good for him.
I'm just trying to figure out how it adds up for Spotify. I guess they get that many people from it that are. It doesn't matter if they're like new people signing up. You know.
I feel like it keeps his audience, right? Because if he went somewhere else, perhaps they would follow.
Right. Yeah. True. Okay. Fascinating. Stock is finally looking good here. It seems like, Rick.
Yeah, almost doubled from the yearly lows, up 92% or so. And what I wanted to highlight here, acceleration of trend. You know, these are not necessarily great trend lines. They don't connect very well. What I was trying to do, though, is illustrate that we went from a moderate move to a steeper move to an even steeper move to the upside here. We had a bit of consolidation around this area, developed a nice volume node around 194 or so, it's kind of centered around that area. Then we broke above our old highs. We pushed upward here, and we really took off from that point. We're above all our moving averages. They're all trending upward. They're diverging apart from each other. Not really a ton of signs of slowdown according to our moving averages. But if we look at our trend line, we're kind of right on the edge here, and RSI shows that momentum
Very
is
tasty
slowing
right
down
here.
a little bit here. A tiny bit of bearish divergence as the stock made new closing highs, but we're heading into earnings. You know what I mean? So there's an
I'm gonna try to scalp this
situation
thing.
coming up. It's really common for momentum to slow and for prices to
Get my
kind of
water
go a
here.
little bit sideways as we
This
head
is
into
the
earnings. So I
49.50.
wouldn't make too much of it, but it's still worth noting. It's still an important thing to be aware of that's happening here. Now, once again, +1 standard deviation channel, right where we are now. Noteworthy because momentum is slowing down and we're at a resistance point here. So a push to the upside could lead to an energetic breakout. A rejection could mean the same thing.
49.15 Lotto right here.
Two channel comes in at 246 or so.
At 115.
Stretch from here, but you know, stranger things have happened. To the downside, we've got this small gap and our 21-day EMA coming in between like 207 and 209. That's a supportive area to keep your eye on.
Seems like the stage is set for some drama in the Spotify earnings. With such a good-looking chart generally over the last year, but now kind of extended a bit to where they might need to deliver something really impressive to justify a pop to the upside. But that's the type of thing that could build in that kind of fear of missing out style rally. If not, maybe we get a big swing because it is not exempt from downside moves like we got back here last summer in the earnings looking at the second quarter. So that's the difference between this chart that's kind of had a few rough spots versus like a Eli Lilly, which is just up and away. All right, nice look at the charts for QCAD. Jenny Horn, thanks, team. All right, when we come back, we're going to get an update on Snap. Then we'll get our market meetup panel in here, talk about the session that is starting off with some volatility. Snapchat giving a little bit back of recent gains, but still hanging out near the highs.
I remember when I first started flying and we would experience turbulence, I would watch the flight attendants. If they're not nervous, then I'm not going to be nervous.
Well, they're getting paid not to be nervous, honey. I'm nervous watching you talking about being nervous. Don't you understand? You're making me nervous. Coin at 116. Coin drama. We're at 140. SPX Lotto's at 115 to 140. Come on. Give me more. Give me more. Give me more. Oh, give me more. Tesla 176. Stop using Tesla for a fleet, company fleet. SAP, SAP, to stop using Tesla as company fleet. We're going to 100. Guy pulled over for wearing an Apple Vision Pro while driving. That kid don't have to worry about money. I forgot my coffee. I'm gonna go get my coffee here. Okay, now what? Something don't make sense here. Oh, okay. Let's see, I'm back down to 115. Could have sold them there.
As we do have the NASDAQ down now about 90 bips, Joe, so we're just not seeing that kind of offset that we did on Friday with higher rates.
Yeah, you're not getting from the mega caps offset.
No meta bailout.
You know, we talked about it Friday. The breadth was really starting to kind of weaken in the overall markets, and it was really a 200 billion market cap move from I was going to say Facebook, Meta. You know that kept the market alive. I mean, think about that for a second, Oliver. You know, McDonald's is about 215 billion. So Meta adds to McDonald's, and the market adds an all-time high, but yet it can't maintain that, because if you look at some of the advanced decliners today, these are big moves. 7-1 in terms of decline versus advance in the S&P, 10-1 on the Russell, and 4-1 on the NASDAQ. So, you know, we've been talking about this idea. It's been a concentrated move, and we're at a point now where if you look at the S&P 500, you know, the 10s, we talked about the Magnificent Seven. Well, now you add Eli Lilly, Berkshire, and Broadcom, and now you get the 10 largest market cap stocks. Well, Axios had a good article over the weekend talking about the fact that represents 33% of the S&P 500 market cap, those 10 names. We have not seen that concentration in 50 years. Doesn't mean that it can't continue, doesn't mean the market can't go up, but it means it's a small sliver of the companies that are doing the heavy work.
Key man risk, key stock risk, right? Too much riding on a few players. What do you think, Nick T?
I think another way to kind of think about that is the underperformance we've seen in the Russell, guys. I mean, look, you're almost a percent down in the NASDAQ this morning. Russell's down over, quietly, as always, right? Because it doesn't have those. So I think that is a really interesting kind of barometer to see the weakness in other names that aren't those, 5 to 10 names that Joe just mentioned. And when you see the size of the companies in the Russell overall, and obviously the sector makeup is extremely broad, but there's not many companies in that index that are as big as the move that Meta had on Friday. So it's awfully easy as you start to look kind of just below the surface to see how the market's pushed around by these major names. And I think from a risk standpoint, it's just extremely important to think about hedging and to think about diversification in a different way, right?
Tesla's retesting.
S&P and buying the NASDAQ and saying, I have this exposure, you're not exactly diversified.
I'm still in the SPX. Mister is one I've been wanting to trade.
We're seeing a down move here.
So we missed it.
Individual names, or you're hedging, through sort of, the VIX complex of products or
it hit the 200.
There's a lot of alternatives and ways to protect yourself. And you kind of have to watch both, right? You have to say, well, if these top 5 to 10 names are down significantly, there's going to be a big pullback in the market. Most likely from a sort of a macro perspective. It also means that there's likely real value under the surface that hasn't gotten sort of the run up that these big tech names have. So I think there's value in equities out there, but it's just very, very skewed by those tops. You gotta dig a little bit below the surface there.
True. This morning, the stuff below the surface is a little further below the surface. It seems like rates are a Russell problem. That prices paid was pretty hot this morning, Joe.
It was 52.5 on the services number. You know, between that and the jobs growth that you got on Friday, and even the manufacturing ISM last week was much better than expected. It's showing a global economy where prices are kind of holding firm, and it is expanding, or at least on the services side, you're seeing some expansion. And look, the comments over the weekend from Powell, you take that and you add that with the ISM. Services data this morning.
Netflix
It shows that the likelihood of a Fed cut, he says 3, but now look at the probability for May. It's gone from 85% just a week ago down to about 65%. So big moves.
Yeah, things can move quickly on those expectations. Thanks, guys. Appreciate the thoughts. Bill Mazzola, Nick Theodorakis, Trading 360 with Nicole Pedalides is up next. Thank you for joining Morning Trade Live.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 5 years in a row.
Stay
With
up.
Investor Checking, you get the award-winning.
I can't have it dropping much more here.
Time, any.
Amazon. Mister looks real nice on the tape. Okay, we're on our second breakout now from the snake. SPX 49.50 strike at 130, 135, and at 115. We got to break the 50 SMA on the 1 minute. And if that happens, I think we're off to the races. We're getting ready to squeeze. And I'm getting ready to have lunch here in a second.
They are still somewhat seeing the challenges of what is being exposed to Asia as well as what is happening overseas. This is as a result, we saw their sales drop around 7.4% from a year ago, which does also reflect a headwind due to business disruptions in Israel and other parts of the Middle East. So this company is making priorities to be sort of efficient and also be ahead of some of these headwinds they're facing. But they needed this lift today because ahead of this report, Nicole, shares were looking disappointing, to put it lightly.
All right, thank you so much, Jenny Horn, markets correspondent. Appreciate it. Let's get some insights in the news shaping the markets. For that, we welcome in.
There we go, SPX.
As chairman and CEO at Axis Capital. Thank you for
break
with
it.
us. What happened, right? Everybody started to realize that maybe they're not getting 6 or 7 rate cuts. Is that what this is about?
I think that's right. I think over the short term, we're going to see obviously volatility in the market. The markets are down a bit. But look,
best time to trade.
Of your viewers have watched Jerome Powell's interview on 60 Minutes. I think he's managing things extremely well. I think he's the best Fed chairman we've seen probably since Paul Volcker. I think the approach they're taking is sound. And notwithstanding the fact that we might not see 3 rate cuts, more likely 2, I think it sets the stage for an absolutely fantastic late 24 and 2025.
Isn't 2 a far cry from even the 3 that were anticipated? I mean, everybody, when they were saying 6 or 7, they knew it was 3. They were hoping for 6 or 7. But they didn't expect that it wouldn't be 3.
Yeah. Well, I think you're right. I think it's a disappointment over the short term, but I think Powell and the Fed are managing things extremely well. I mean, we have to think about the markets not on an intraday basis or even an interday basis. Our approach is to look at the markets over a 6 to 24 month time frame. And we believe the stage is being set for a very good post-election 2025.
Yeah, I see March is at 17%, May is at 69%, June 95%, and July likelihood of the cut would be 99%. What camp are you in?
I'm in the May camp. I think it happens sooner rather than later. Of course, sooner would be March, but that's unlikely to happen based on Chairman Powell's comments on 60 Minutes. But look, whether it happens in May, whether it happens in June, July, it's going to happen. It's going to happen twice this year, and that trend is going to be very strong, very powerful for the markets. And when it happens, you're going to see the bond markets react very positively. You're going to see the stock market react very positively. It's just a question of when and not if.
When?
What do you think about the fact that the dollar is moving higher today? What do you make of that, and where does that fit into the story? It's above the 104 level.
Well, I think it reflects the fact that, that we're seeing interest rates tick up a little bit. I think the dollar continues to be a very good place as a store of currency. I think that over the medium term, the dollar is going to continue to get stronger, given what's happening in the world, and so it doesn't surprise me at all.
And so now, what do you tell investors? Do we still go with 60-40? Or how do we diversify our portfolio so we have some winners, I guess, in the short term or long term?
Well, look, our firm invests in both the private markets and the public markets with a principal focus on the private markets. And we take a medium to long-term view. I mean, in terms of how we think about asset allocation for the average investor, they have to start thinking about the private markets. When you look at private markets valuations relative to the public markets, it's an extremely attractive place to be. And by the way, you touched on 60-40. That broke down in 2022. 2023, still tough. And so it's all about diversification and investing for the medium to long term. So we think the private markets are the way to go. We're hoping to see legislation come into place for 401k plans. We are in a bit of a regulatory, sort of snag between the Department of Labor and the SEC. I think that'll get worked out. But I think once you see 401k plans investing in private investments, which, by the way, is one of the best things that can be done for the retail investor in this country to match their long-term liabilities and their assets. Once that happens, I think it's going to be a game changer for the economy.
Yeah. Tell me about, do you think no sector is immune to this volatility? People still love tech. We're seeing NVIDIA even with higher price targets today from the likes of Goldman Sachs. Where would you say maybe, do you like tech? Are there other sectors that you lean towards a little bit?
Well, I try to take a fair and balanced approach to things. NVIDIA, I have to tell you, is a fantastic company. I think the best is yet to come. So when you think about it over the next year to 5 years, I'm hard pressed to think of a better place to be in terms of tech stocks. And then, within the Magnificent Seven, one could argue that they've gotten ahead of themselves. I would simply take a dollar cost averaging approach over the next 12 to 24 months. But I think you have to be in those names over the next 5 to 10 years. And it's very, very difficult, as you know, to time the market. So I think the best approach would be a dollar cost averaging approach.
Dollar plus averaging.
Understood. Joe, it's great to see you. Joe Tagrosa of Axis Capital. Thank you. Coming up next, plenty more to come here on Trading 360. It's time for the big three. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein will go through the technicals. Jessica and Skip will take us through the trades for IBM, Meta, and Amazon right here, Trading 360, Schwab Network. We will be right back.
My dad was a hard worker. He used to do side jobs, installing windows, charging something like $100.
Not you. You really need to shave. I used to tell that to Jack Dorsey. He finally shaved when he had to go to court. Your dad would not be proud of you with a beard like that. So please shave. I can't stand it. Boy, look at my watch list. Red, wet the bed. Jimmy alerted coin. So far, we've up a couple of bucks. Actually, we're up $4 from the alert. Jimmy mentioned coin. We're in SPX at 190. We broke resistance. We broke resistance. We broke resistance. Yes, I'm still in. I want more. Give me more. I almost got carried away again, started singing. Blake it. Anybody else in these babies with me? Because if you are, you're being rich. Wheelbarrow full. Do 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 do. $2. $2. Say what? Turn down for what? Oh my. This is it. We're up $100. You can make a business decision. Make a business decision. Is this going to be one of them where I go back and say, if I sell it, well, I say, damn, they're at $5.50, and I got out at $2. And they're at $6.50. And I sold them at $2. Oh no. Not again. For that, I will hesitate. And I'll go into the kitchen and grab a shot of vodka and a Valium. I swear, if you're having the hardest time trading, just concentrate on the SPX and the SPY. Until you get to be in the now. Then when you're in the now, that's the hardest part, is being in the now. Monday, let's think about it. I could write a song about each day of the week when it comes to trading stocks. I'm not a quack. I'm a factster. Monday. It's like taking a week off and going on vacation and coming back to work. Or it's like coming in on Monday and having to read all your emails. Everybody that I work for, that's what they do. They sit there and they read their emails every Monday. And then your week starts out. So you got Monday, trying to figure out being in the now. Tuesday, you've got created your watch list for Monday. So you know either if you're going to be a bearish week or a bullish week. I think today was a flush. Because I keep hearing people on Schwab, a totally different outlook than what you hear on CNBC. They're a little bit reluctant, where CNBC just going all hands out and making excuses. So Wednesday comes in, you've got your watch list, you know that A, B, and C jumped a little bit too much, or it pulled back a little bit too much. You know it's had some real good volume and really been momentous trade, so you want to buy the dip on it in case it pulls back. Then Thursday comes around and you're saying, okay, well, I've got my good trades in today, this week so far, and I know the end of the week's coming around and I'm going to be a little bit less reluctant to hold anything over the weekend because you just don't know what's going to happen. Then we come back in Monday and do the same thing over again. Same way as trading throughout the day. That first hour and a half, bam, get all them good trades out of the way, and then do your homework and buy the dip the second part of the day, like I did here with the SPX. We're going to come back and retest this resistance here. It has to hold this to stay bullish. See, as Mike said this weekend, what was resistance now becomes support. So they always retest. You're saying to yourself, oh, damn it, I missed that trade, Jim. That was a nice trade, 90% on that. Good job. Well, don't worry about it. It's going to come back and retest. You'll have a second chance maybe. So when Jim says make a business decision, does everybody know what that means? That's right. So Kat Had a nice little breakout. Jimmy made a business decision. For the people on YouTube, when I say make a business decision, that means think about profit or think about cutting your losses fast.
We took out 132 invalidation point here, and everything else has been off to the races here. This has been, again, a very bullish story here, and this stock here has performed well for those who stuck with it.
Right, understood. And you still have this bullish stance here. Jessica, final thoughts on this trade you put together?
Absolutely still have a bullish chance. I believe it is very important to think about the structure of the options trades. Today, there is a way to utilize options in more of a longer-term income-oriented view, and that's the structure that I've laid out with all of the trades today, because sell-offs represent that broader opportunity to add companies to your overall bullish investment thesis on days that are pullbacks like today.
Okay, next up, Amazon, which has been also a winner. It's up about 50%.
She just said what I just said.
52-week high.
How dare you?
Your thoughts on this one and why it jumps out at you as a winner?
Yeah, absolutely. And still, again, that narrow-based AI theme that we're focusing on today. It's all about AWS. We really were waiting for AWS. I recall
all them Bitcoins turn red.
Just to even see that play out.
All them
we've
indices.
got some positive trends, and management expects that to accelerate in 2024. There was definitely positives for the quarter with lots of backlog growth in Q4, which is up 41% year over year, which is incredible numbers speaking to the growth. And I love what CEO Andy Jassy said. He emphasized the potential for AI to become a multi-billion-dollar opportunity, and that it's currently at a relatively small size. So there's a piece of a pie really to go around.
Piece of the pie.
And that's what I take away from that statement.
I'll take some.
So lots to really like about Amazon from this quarter, especially expecting that to accelerate like the CEO states and the numbers stated or seem to going forward. Same type of trade structure here. Selling to open in Amazon March 22nd, 165 put. Again, that's that 45 days. That accounts for proper theta decay. That was yielding about 395, so 395 total earlier today. The premium that I'll receive up front. Maximum profit potentials when Amazon stays above 165 like it is now. But if it moves adversely, I've really reduced my break-even point and cushion pressure. That's the intent of these type of trades. I actually have a break-even rather than the current price of around 169 to about 161 due to the structure of the trade. And that's what the key takeaway really for the trades that I submitted today are, despite the overall bullish investment thesis around AI that we talk about so much, Nicole.
Yeah. And how'd you talk about the 45 days and how you're coming up with this, but just quickly, Ben, your thoughts on the technicals, please.
Yeah, same trade structure as Jessica mentioned. I'm not surprised because a very similar pattern playing out on the chart here. You get a high conviction trade to the upside, a market that was in balance. You get the earnings, the news, and you can see, again, almost identical depiction in terms of the other two names that we looked at, IBM and Meta. This is Amazon. Big move up here last week in reaction to earnings up to 174, 175, and you can see on this 5-minute candle chart areas of consolidation that have formed at higher and higher levels. If I could get these areas of consolidation, there they are. 170 is the one that we're currently balancing around, as you can see, Nicole, and just off that recent high. So very bullish pattern playing out here. Now this is short-term charts. Let's not get too focused on the granular. Taking a step back though, you can see a similar depiction in terms of the other two names that we mentioned. So again, not surprised to see a very similar approach towards trading it. Here you can see areas of value that have formed at higher and higher levels. In this instance, Nicole, we're going all the way back to earnings in October of last year. Stock was trading around 118. And you can see, it looks like we're balancing again around 170. It looks to me like anything above 150 is still bullish. And I noticed this test of 145, which held, that's key. That's what the bulls are looking for, those retests that hold. This is a stock that's in a very much well-defined trend up, 2 steps forward, 1 step back. And much like what we just talked about in terms of Meta, very much a comeback story because the stock had been trending lower. Amazon bottomed out in the fall of 2022, beginning of last year, down around this $80, $90, $100 level. And then you can see, while we were balancing around 95, what did the bears want? A new area of value to form at a lower level to solidify that working assumption that we're trending lower. Instead, what happened? Look at this. 124 was a reference point you were keeping an eye on if you were bearish. We got above it. Everything above that since has been bullish. So I can understand approach towards trading this one, very similar to the other 2 names. Almost an identical chart here.
Yeah, understood. Thank you, Ben. Taking a look at those. And Jessica, final thoughts here. I know you have the 45 days on most of these trades. How do you come up with that time period?
Yeah, it's such a great question. So whenever we're selling options, I look at 45 days until expiration because the option is, the price is derived from the underlying security, but implied volatility, and we are adding an expiration date. And the longer expiration period, the more expensive it's going to be. So I want to allow some time for that, we call it theta decay, but daily time decay to occur because these are neutral to bullish trades, and it allows me to buy it back at a lower price if the security just stays the same. And that's the intent of it, is this is a time play in addition to a neutral and bullish view. And then I'm selling an at the money option, which just means the strike price is relatively close to the current market price. That way, if it does move adversely, I'm okay adding it to my longer term portfolio. Gives me more premium is the takeaway.
Yeah, understood. It's great to see you, Jessica. Thank you so much always for being on the show with us today in the Big Three. Jessica Inskip of Options Play, our own Ben Lichtenstein, IBM, Meta, Amazon. A great look at the Big Three today. Thank you both. Coming up next, we're going to spotlight
whatever she said.
This technology company, and the CEO is going to join us. In fact, the former Honeywell battery company's outlook is something we want to learn more about. This SPAC merger. STI is the ticker symbol. We'll be right back.
Coin's trying to break that 63. I've took off a few of my moving averages and I've added 2, the 21 EMA and the 63 EMA with the 200 SMA and the 9 EMA. And I'm trying to learn how to use these a little bit different than what I've been using. I'm following the 21 and the 63 with this one trader here on Schwab. And it seems like it works in different time frames, which I'm kind of handy to. I like working them in different time frames.
Fascinating.
I could have bought them SPX puts at 140. It's very fascinating. That doesn't make you a fascist. Okay, Jim, did you make the mistake by selling these and you're going to start bawling in front of everybody? Could have got these at 140, maybe even cheaper than that. So as I go into the kitchen and grab me another shot of vodka and a Valium, I will be refilling my coffee. Fascinating. I'll be right back.
And sharpen your skills with immersive online education crafted just for traders. Also, you can trade brilliantly.
Trading at Schwab is now powered by
Okay, I'm gonna start balling.
Unlocking the power of Think or Swim, the award-winning trading platforms. Bring your trades into focus.
I'll have to jump back in this Mac 140 to 220. 400
technical stuff.
You got to be kidding
Tailor
me.
the platforms to your unique needs with nearly endless customization. And track market trends with up-to-the-minute news and insights.
Shut up. Talk stocks or don't talk at all. Could I opt for the non-commercial here on Schwab? Yeah. Okay, it's coming back to us again. What's this guy got to say?
Which are both hydrocarbon-based feedstock. What we are going to use
Is that O.J. Simpson's lawyer?
Which is made from recycled or wood waste biomass, heated at a very high temperature, and then once that is completed, then it will go into a graphitization facility that we envision.
Okay, get ready.
In the next 12 to 18
We've got the trend line right here.
then you will have synthetic graphite.
Where's the hammer?
Graphite is preferred by most of the EV manufacturers. We feel that this is the cleanest way to be environmentally conscious if you're using a lot of petroleum, because to get coal tar pitch, you have to mine coal. To get petroleum coke, you would actually have to continue to process petroleum in a refinery. It kind of defeats the whole purpose of having the EV. So this is a much cleaner way of doing things. There's an abundant supply of wood waste in the United States and North America. And in our using our production facilities, proposed production facilities, we feel like we're going to do that in a more efficient and cost-conscious and environmentally conscious way.
Yeah, understood. When we think about the IRA, the Inflation Reduction Act, I'm curious how that could help you in the long term, and also
Solid iron.
a little bit about the
Solid iron.
for EVs. I think that's part of the frustration for folks.
SOLIDION.
How far they can drive or how long they have to charge or whatever. What do you foresee happening, particularly since you're fully immersed with these EV batteries and the like?
The best days are ahead for EV batteries. If you look at the technology where it was about 10 years ago and where it will be, and the curve in between, obviously, I'd be surprising if you could see an internal combustion engine have that type of efficiency curve. A lot of the challenges for EVs are the cost of the materials. The Inflation Reduction Act, as you mentioned, really benefits us from the standpoint of most of our, if not all of our manufacturing will be local. Especially when it comes to the graphitization, it is a material that China is either in the process or is already limiting supply into the United States. And right now they are 80+% of the graphite market. So when this Inflation Reduction Act was, was contrived at the time, I don't think we thought we would be.
So this must be a new IPO.
The benefit that we currently are, but it is what it is.
Thank you so much. It's great to see you. Congratulations to you and the team. James Winters, CEO of Solidion. Thank you. Coming up, the Disruptors, Kevin Green is standing by, and he'll take a look at Chevron. He'll have a trade for us as well. It's a price target increase from Bank of America. Details on Chevron next.
Chevron.
Binge watch the market with the Schwab Look.
Nice little rebound right there. Right off that support line. 140 to 190. Dow Jones down 365 points. That's a pretty good sell-off. What do I have for support? Oh man. Huh.
No noise from bell to
Now Lily really went to. There's another one had me fooled.
Our panel is ready. Kristen Owen, Executive Director, Equity Research at Oppenheimer, and Lee Bull, CMT Senior Manager, Trading Education. Education at Charles Schwab. Thank you both for being with us. Your thoughts on Caterpillar today, Kristen? I'll start with you.
Yeah, hi Nicole, thanks for having me. You know, as you said, stock is hitting record all-time highs. We had record revenue, record earnings, record profitability on the stock, and an outlook that largely assumes that is maintained next year in this sort of flattish environment. And what I think we're seeing in the stock today is that flattish outlook is sort of consistent with what we're seeing in the broader economy, a relative resilience in these end results, and that's sustaining that earnings profile going forward. So that's helping them lift their ME&T free cash flow. That was a big takeaway that we learned this morning, as well as their margin targets on the upper end of the range.
Yeah, and did you like that when you saw that, Kristen, when you saw that they lifted the high end of the profit target range? Did that bring you some support in your thoughts and calls? I know you have I think you have a perform rating. Where do you think this stock is headed, particularly since it's hit a record high today? Right now it's at 321.
Yeah, certainly it is constructive that they're finding more points of leverage in their model. What we look at is, as we see, okay, we're lifting the top end of the ME&T free cash flow. That should be positive for dividends. That should be positive for buybacks. On the margin, lifting it at the top end of the range, keeping it at the low end of the range maintained. So we've actually introduced a little bit more variability in the earnings across the cycle, rather than just saying, hey, at all points in the cycle, we're lifting that bar higher. So it's a little bit of a puts and takes on that margin outlook, where we think, you know, the ME&T free cash flow, pretty straightforward, better dividends, better buybacks through the cycle.
Yeah. Legal, you always have some great positives and negatives for us. I'm curious on some of the negatives. Tell me a little bit about that and what people can be wary of, for example.
Right. I think it was a great, as Kristen said, it was a great report. They did say they had a little bit of unfavorable change in their dealer inventories, though. They also said China is still a weak spot, as is Europe. They also said the supply chain has improved, but it still has a ways to go to get to the peak efficiency. One thing I would say that I think maybe is a little bit unappreciated is there seems to be kind of a global push to more protectionism, with more tariffs in the offering, perhaps. And I think since 50% of their sales are overseas, that could be a bit of a drag going forward if that really turns out to be true. I know ex-President Trump said today he put massive tariffs on China if elected. So I think that's something we have to watch, though.
Yeah. And what was one of the positives that stood out to you? I see you have several, Lee.
Oh yeah, I mean the positives were they see great momentum in their for large engines in data centers. They said they see a lot of opportunities in mining due to energy transitions, and mining is a big portion, obviously, of their of sales. And they also said they had a lot of interest in their services business too. They said that growth in services could help mitigate any softness in sales. So they're especially saying that there's going to be a lot of service revenue because of rebuilding of a lot of the mining trucks that is going forward in there. And then finally they said, of course, while there's weakness in Europe and China, there's obviously, with all the acts that we've had, the CHIPS Act, the IRA Act and all of that, there's going to be good infrastructure spending in the U.S., and they're pretty positive about that.
Okay, and Kristen, thank you for that, Lee. And Kristen, just final thoughts here, because I know you have this perform rating on Caterpillar. I'm wondering, you know, when do you make this a buy rating? Do you think it's fully valued right here? Are you also concerned about some of the things that came up, a weakness in China and maybe unfavorable change in dealer inventories? And is Deere or Caterpillar the better player in your mind, Kristen?
Yeah, at this stage in the cycle, Nicole, we are not used to a cyclical company that is going to be flat on a year-over-year basis. So I think we all need to sharpen our pencils and understand, what does that mean for valuation? The current stock price, as it's indicated now, puts us right at about mid-cycle. So understanding, are we expecting earnings to grow in the future?
Or are those risks that Lee pointed out going to overwhelm some of those prospects for growth? So I think we all have to sort of take in the outlook today and see where our estimates pencil out. Where we like in this space, though, and you mentioned Deere, I mean, that's a name where we've all sort of taken that first cut on where we expect estimates to be in 2024. So in some way, a slightly more de-risked story coming into this quarter than, say, Cat was.
Okay, thank you both. Kristen Owen of Oppenheimer, Lee Bohl of Charles Schwab, thank you both so very much. Great to see you. Good luck there at Caterpillar. Thanks for being with me, friends. I'm Nicole Petalides, live here on Trading 360 every day at 11 a.m. And I also see you at 2 p.m. for the watch list, so join me then. In the meantime, keep it right here. Fast Market is next.
They're 220. The SPXs. PLTR drop. We'll drop on PLTR. We can drop a little bit more. That's 3 crows on an hour. Snow down $5. AMD, Dow. Some of these are interesting supports. UPS. Yeah, see, UPS is at a very interesting spot. Yeah. There's some pretty interesting spots. Goldman Sachs at 200 on the 1 hour.
Out with me for the hour today, getting the old band back together. We have a show for you today based on earnings, based on news, everything we have going on today. We'll look at Spotify. We'll trade that. We'll report on it. We'll give you all the news you know ahead of their earnings tomorrow after the bell. Then we'll trade, Snap. We'll trade Snap first. Then we'll trade Spotify, like Foley will do presentation on Spotify. And then we'll end with pharmaceutical giant Eli Lilly in our final segment of the day. Before we bring in my co-host for the day, Alex Coffey, let's get to the 4 major indices and see where they sit at 11 o'clock Chicago, 12 o'clock Eastern. The S&P 500 down just under 0.5%, 23 points to 49.35. The NASDAQ 100
Snap's
down
at an interesting spot.
73 points to 17.
We're at the 200 on Snap on the
Dow
hour.
Jones Industrial Average down 0.9%, 353 points to 38,301. We'll call it 38,300 even. And the Russell 2000, by far the weakest of the 4 indices, down 1 3/4%, 34.5 points to 1928 and some change. Now let's bring in my co-host for today's show. You know him as the co-host of Next Gen Investing with Jenny Horn. Coming up right after the show, he's Mr. Alex Coffey. Alex, good to see you.
Pleasure to be
I
here.
see you a lot, but good to see you anyway. Interesting, coming off this massive week that we had a week ago, ending with, as it's hard to find adjectives for the payrolls number, for Meta's earnings, everything we ended the week with. Jerome Powell on 60 Minutes last night. Give us your original thoughts on everything you're seeing as we go from last Friday and that big week to today.
We have an increasingly concentrated rally. I mean, you even see it today. We were talking before the program began. There's only about 20% of the NASDAQ that's higher today. You got about the same number of the S&P 500, actually a little bit less. It's about, let's call it 13% of the S&P 500 that's higher today. But the names that are higher are important names. They're names like Apple, they're names like NVIDIA, and they're not small moves. It's 4.25% to the upside for NVIDIA again. And so you start looking at this, and the risks clear. The risks are you lose the Magnificent Seven or your top 10 stocks or whatever you want to, wherever you want to draw that line in the sand, your big mega cap tech firms, they go down. There's probably not going to be a rotation that can withstand that. The thing is, they're not going down though, Kevin. They just continue to go up. So this rotation that's happening is a rotation out of other places into those names. Now, historically, that story ends a little bit shaky, but it hasn't ended yet, and it's still exciting to watch. Now, I'm excited for this week because outside of some Fed speakers, which there's a lot of them, there's really nothing else going on. There's some scattered earnings.
Very little data.
And it's going to force this market to digest everything that we had last week. And there were different points last week where the message was received differently. And so let's see what the path of least resistance is here. At new all-time highs, I mean, we're 0.8% off. I'm going to call it all-time highs here. With a very concentrated market, where do we go next without those catalysts to keep driving the market action? Where does the market go when it has to sit alone with its thoughts?
How are the Fed speakers, and there's lots of them, like you mentioned, going to put a dovish spin on that payroll data? I think the payroll data, because of Meta's earnings and Amazon, which basically got what was an afterthought, that it almost got passed over. The fact that wages have gone up now for 2 months in a row, and both on month and year over year.
The amount of hours worked has plummeted, though.
Yeah.
So if you took that, average hours worked times the average wage, the actually weekly earnings is lower. And so ironically, you might be working less, but you're also making less money, although you might have got that raise, per hour on the average worker. So there's so many contradictory things within this survey, and it's not just household versus establishment. It's like within the establishment survey that are sending different messages, but it's so polarized now where it's like things like the soft data, like PMIs and things, have been saying contraction. Yet the job headline number is strong. GDP is strong. Inflation's come down. You talked about wages remaining robust. Earnings have been strong largely from the companies that matter. It's like one thing is saying things are perfect, and then the other side saying things are falling off a cliff. And it's like, do we end up somewhere in the middle? Is there even room for us to end up somewhere in the middle, or does this data just have to converge one way or another?
One of the names that we're looking at today is Snap. Now, they come out with earnings tomorrow after the bell, but they have big news out today. And for more on that, let's bring in Jenny Horn, the other co-host of Next Gen Investing, with the news on Snap. Jenny, is this a good thing that they're laying off people, or is it a bad thing? The stock was originally rallied, now it's down, Jen.
Yeah, Kevin, I think it's really interesting that we've seen typically positive reactions to this like restructuring layoffs because it makes the company more lean. But lately that somewhat has changed. It's not the first time we've seen a company sell off in reaction to what you'd think would be perceived as a good thing as far as at least the street is concerned. So they did announce plans to reduce their global workforce by about 10% to enhance their business focus and overall investments. Now that's about 500 total jobs because their total workforce right now stands at around 5,300 employees. They do estimate the pre-tax charges between around 55 and 75 million, mainly covering severance and related expenses, with 45 to 55 million as future cash outlays as a result of these layoffs. They did say that most of these costs are projected now for their first quarter, with potential extensions into second quarter or beyond. And of course, we get those fourth quarter numbers, like you mentioned, tomorrow after the closing bell. But this is just the latest round of layoffs for the company, which cut about 20% of its staff in 2022. It also reduced their staff by about 3% in 2023. So this has been a relatively consistent pattern. So maybe that's why it's being perhaps read as a negative, just because this is a company that is consistently having to lay off its employees, which is a bit of a concern. But I always find it interesting because we joke it's like the 9 lives of Snap, because it keeps coming back. I mean, all-time highs, $83 a share. We're 80% off those levels. But hey, we are still up 110% from our 52-week lows where we're currently trading. So just to speak to some of its volatility, and I was looking about like their target demographic, almost 70% of teens say they use Snap. So that's perhaps why it's not in my wheelhouse. And actually, the majority of their major growth is now expected to come from Europe or just internationally, where they're expecting actually sales here domestically to shrink, but all their areas of growth are overseas. So that's why, to me, I'm like, how is this company still growing? It's growing elsewhere, apparently.
Yeah, Kev, Jenny and I have talked about this, where we kind of called it cat-like with the 9 lives,
Sure.
because it's broke below $10, and so many times when stocks get into that single-digit territory, they don't come back from that. Snap's done it literally 7 or 8 times, and it continues to surge back.
Well, how do they do it?
They do it from being in a space that's growing, which is social media, but there's still concerns. That's why they're not at $83. And Jenny, that's where my question goes. We know this isn't Meta. So Meta's year of efficiency had its impact. A year of efficiency on Snap is maybe going to look a little bit different, and I don't think it's expected to look like Meta. But as we go forward and we start thinking about the timing of this, to me, this also said that Snap wasn't sure how the market was going to react. It gives them 24 hours now to get this kind of messaging and everything buttoned up for when they get all these questions tomorrow afternoon.
Yeah, and I think what it comes down to is ad revenue, because obviously we saw a nice result from Meta last week. I mean, it was a nice result across the board, but Snap grew their ad revenue pretty modestly, 0.7% last year. So they need to improve that figure, exponentially. And I think the fact that we could see any degree of lagging ad revenue, I mean, that is basically the entirety of their revenue. So that's going to be a very, very key metric for Snap. But it's amazing to me because, frankly, I don't really understand the 9 lives of Snap, because when you look at, I was just checking the largest social media apps in the world right now, Snap is 8th. So behind names that I'm sure have a larger international presence that maybe I'm just not familiar of, but 8th is pretty brutal, and as far as the growth story.
I don't know what to do with Snap because I'm so many generations removed from their demographic. My children are too old for Snap. What does that say about how old I am, Jenny?
I'm too old for Snap, Kevin.
Thanks for coming on as always, Jen. Have a great day. All right, Alex. Now, we're going to talk about Snap in the next segment because we're going to cover them ahead of earnings. But let's get back to our macro discussion, because you mentioned not a lot of economic data this week, although we did just have some that came in stronger than expected. Market took a leg down when that happened. If you just break this down, there's so much noise from earnings season in this market right now, Alex. How do investors get back to concentrating on the fact that you had an enormous rally in the 10-year yield? You've had an enormous rally in the dollar. That should be affecting the overall market. The Russell 2000, the weakness there, at some point we're not going to be able to ignore this, Alex.
Yeah, but so I did the math. It's a little bit stale now, but from November to the midpoint in January, the move that we had seen in just the Magnificent Seven names would have been equivalent to like a 35% rally in the Russell 2000. From a market cap standpoint, the Russell 2000 is only like a $5 trillion index in entirety. You add Apple and Microsoft together, you're bigger than that. So in terms of value. So from just like a math standpoint, it's just not as important, but it is telling us something. It's telling us that there's not a lot of faith in a lot of these, small cap companies. The regional banks are under stress again, potentially based off how they're trading. We know that there's a lot of companies that are very rate sensitive in that index, but the companies like Apple and Microsoft and Nvidia that carry all this weight, top 10, I think Joe Mazzola told us this morning, it's like 30% of the S&P 500. So if we use that benchmark, those 10 names, if they're able to just kind of thrive or do okay because their businesses are very, they're in this like strong growth trajectory, they sit on cash, they're not heavily indebted, interest rates going higher doesn't really impact them. They have pricing power in the industry, so they're able to kind of weather the inflation storm by passing it on to consumers. So I think that's the part that we've missed the last few years is this historical kind of inverse relationship between stocks and bonds has broken down for the companies that matter the most. And so while we used to think NASDAQ 100 so influenced by rates, I don't know if that's the case anymore because these big mega cap firms have hijacked that index so much.
Yeah.
And they can thrive seemingly in all market environments to some extent.
They're all healthy. And the Magnificent Seven or the Magnificent 5 or 4, whatever you want to whittle it down to.
Or 10 or 20.
Yeah, exactly. It goes in both directions, right? One good day in the market, they want to add to the Magnificent Seven. One bad day for a couple stocks, they want to take them out. It's a very fluid group, but the core of this, they're healthy and they're getting healthier. And Nvidia, that stalled out on the chart after that big blow up. It consolidated for almost 2 quarters before now it's accelerating again. AMD is gonna compete with Nvidia, but we don't know when. They keep promising. It's like free beer tomorrow, right? It's never.
Oh my gosh! Don't even get me started on this. You don't even need earnings anymore. You can just say we're going to have earnings somewhere down the line, and the market loves it.
Exactly. Eventually, this market, just like it did in streaming, just like it did, and you can make the list of the sectors. They're going to demand profitability, and when they demand it, they're going to have winners and losers. And you could be the winner. Nvidia could be the hands down winner in this space, and the stock could be $350.
Yeah, we've had this conversation a lot of times, Kevin, and it's like the problem is let's say, like for argument's sake, let's say it does go back to some lower level. Where does that move start? Does it start from 1100? Because at that point, if you started to short the stock, for example, now, I don't know that you can weather that kind of a rally. And we saw it in Tesla. Tesla went from like 600 to 1200 very, very quickly. This all pre-split.
Yep.
And then in rapid succession, it kind of went back to those levels that it had been. It's 50% off its highs from a few years ago now. If you use sort of the post-split, it's like 14 or 414.
Netflix went from 700 to 175.
Yeah, and
back to 500.
And like 60% of that move was in 2 sessions post-earnings. And so
massive.
Things can change rapidly. And what's the kind of the key factor in all of this is during that time, Tesla's business got stronger.
Yes.
During that time, Netflix took a stronger position.
Clear winner in streaming.
Yeah, and was able to crack down on passwords, so it kind of used that trick, but it also embedded ads relatively successfully.
Massively successful.
And they became a cash flow positive company along those ways. So it's off its highs, even though the company is stronger. And so the thing that worries me is everyone's somewhat in agreement and consensus is, yeah, these mega cap companies are strong. But because everyone's in agreement, they've gotten more and more expensive from a valuation metric. And at some point, earnings drive those stocks, valuations matter. It's just at what point do they matter? At some point, even if the earnings start to improve, it has to be relatively priced in. But the thing is you could have been saying this since Nvidia was $400 and it's almost $700.
Yeah, Nvidia consolidated. It hit $500, consolidated for 2 quarters. It's almost $700 now, right? And it's done that relatively quickly, ahead of their earnings on February 21st. I mean, the Meta move, it was all good news. No one will go against that. But the move is ridiculous. how far the stock moved.
$90 move to the upside, $88 stock a year and a half ago.
I mean, September of 22 was $88, 13 PE.
And we're not talking about a biopharmaceutical company that came out with some new, drug.
Yeah,
we're talking about Facebook's parent company. We're talking about Instagram. We're talking about things that we know, and we're talking about $1 trillion company.
Yeah.
It's massive, massive in terms of some of the movement we've seen, and it goes to show that even if you're bearish, you have to acknowledge there's upside, because we just watched the greatest market cap creation in a single day ever, and that was just on Friday.
A lot of these mega cap tech names need what? Digital advertising revenue. Snap does too. We're going to take our first break of the show. We're going to come back and cover Snap, because they need digital ad revenue just like Meta, just like Google Alphabet, just like all these others. Take a quick break. Let's come back and talk about and trade Snap. See you then, everybody.
Boom.
So you're welcoming ads, you're looking for something, maybe a new couch or something, and you would like to have that new couch. You'd like to find out where you could get that couch that you like, that you found on there. When you're on Snap, you're more than likely communicating with your friends. You're maybe checking on what they did the night before. You're doing something.
It's videos, right?
It's
Is there a texting feature?
There's a texting feed. It's a communication app, I would say. There's other aspects to it, but it primarily began as disappearing pictures and captions.
Right. And they stay up for a short time, disappear. Is that changed?
I mean, I'm not in on it, but yeah, I mean, it changed a little bit. I think it.
Needless to say, I'm not on it.
It's also very, if you're on Instagram, it's a lot of the same features that Instagram now has embedded. The idea of the story on your Instagram, the idea of direct messaging on your Instagram. These are all concepts that were somewhat ripped off of Snapchat and embedded into Instagram.
I remember that.
But my point being, if I log on there in the morning, say I'm a Snapchat user, like you said, maybe I'm 16, 17, 18-year-old kid, and I'm seeing what my friends did, and all of a sudden you put an ad in front of me, I want to get through that ad as fast as possible. I'm not really paying attention. I'm clicking through it the second I can because it's not really a part of my experience. If I'm on Instagram, I'm scrolling through. Sometimes, the way that they've done it, I don't even know what's an ad and what I follow anymore.
Exactly.
And that's the difference. The ads are more welcomed in some of these other social media experiences than they are in Snap. And because of that, I don't know how effective they truly are. And I think that explains why you could see a Meta outperformance and you could see a name like Snap struggle in this digital advertisement, because you're not required to spend it everywhere. If you have a limited ad budget, you want to go where you can get the most for those dollars.
Here's something that's a little more granular about these layoffs. They lay off 10%, about 500 people. They front-loaded the charges all into the first quarter. Is there any sense that they may be clearing the decks, right? Getting all these expenses, all this bad news out, setting up a good second half of the year?
I'm not a corporate accountant or in that world, but there might be rules on that too. I'm not sure if you have to kind of front load that once you know the expense and once you announce it. So I can't say for sure on that, but what I will say is the market didn't react the same way on this stock as it has with others, and it tried to. This is becoming a more common headline, and look, it's 500 people. I'm not going to discount it. I hope those displaced workers can find jobs. But 500 here, 500 there, 1,000 here, 1,000 there, it adds up over time. A company like Snap is laying these workers off because they don't have the work for them, or they can't sustain it. At one point they thought they did. So even if it's an efficient move, it's inherently not a good thing. A company like Meta, a company like Walmart, some of these companies have bloated so much. They're massive.
They're not calling it a year of efficiency, are they?
It's already a company that's had to make these kind of moves.
Right.
Like I said, it's had 9 lives for a reason. It's made its way back from making cost-cutting measures at times and focusing on growth. And so it's just not the same story as it is in other names, and I think it's a little bit more of an alarming one. Now, the stock's already rallied at 100% in the last 2 or 3 months. That also shows that a lot of this is good news, might already be priced in too. So they might have a better story to tell, but you're buying the stock that was $8 a couple months ago at 16.
And the other cautionary tale, and it's tricky. Google Alphabet didn't have good ad spend numbers. Meta did. Snap it's questionable what they're going to do because they've never really competed well with a company like Meta. Are they the other end of the spectrum? Because Meta seems to be in the sweet spot with Instagram and Facebook. They seem to be right there where most of the demographic hangs out.
This is a good question. I think the reason why is I think we all universally agree that the year of efficiency is somewhat prevailing or across the market.
Yes.
As a result, that means you're tightening costs. That means you're probably spending less on marketing. So if you're spending less on marketing, you're probably more selective where those ad dollars are going. In good times, you might have more money to spend. It's a little bit of a love for everybody. In a time like this, you're focusing on where you get the most for your money. And right now, it seems that's places like Meta, that's places like Alphabet, that's places like Netflix. Doesn't mean that there's not ad dollars going to Snap. I'm just not sure it's the first on the pecking order. When I look at this stock and I start considering, the impact that earnings could have. The one thing that I think is quite interesting is somebody finally got them on the phone and said, you got to go after the Metas and the Alphabets because they would come out, they would have bad news to say, they'd take down the market, and then Meta and Alphabet would say, well, that had nothing to do with us. We've still got good numbers. So they're after those numbers now. And now they have that high bar to live up to. Meta just reported. Meta said everything's good, if not better than good. So how does Snap live up to that? I think that's the big question because they rallied in response.
They're looking for 6 cents of EPS, so profitable, but not extremely profitable. One last thing before we get to your trade, and this is, it feels to me, I'm the older demographic. You're probably the sweet spot in terms of the demographic for social media. I know Facebook and Instagram is where most of my social media is. Younger people are Snap. That's probably not you. What is the sweet spot for social media? Is Instagram kind of the one place where all ages are?
I think it just depends on the person, right? I mean, there's new things coming up like TikTok and others that are constantly trying to reinvent the wheel. To me, I think I'm not a super active person on social media to begin with, but I would say Instagram seems to be that place that all generations have sort of met. I think the X app is still one of the primary places people go to get
News.
information.
Yes.
And then I think Facebook has become a dashboard of sorts. You know, I'm much more likely to use my Facebook login information to fill something out than I am to log on Facebook.
Yes.
Although it might still be a part of my, every day. You click through them in the morning or whatever. You're making your coffee or whatever it might be. And then LinkedIn, I think, is a professional, landing spot.
Right.
Snap, I think, has been isolated to a younger demographic. But it doesn't mean that I wasn't on it at one point. I just kind of evolved. I'm in a different place in my life than I would have been when I was a college kid or a high school kid. So it's not to say it's a bad thing. It's just a different type of an app.
All right, now let's get to a trade.
From a trade standpoint, though, Kev, I think you can make the argument for upside. I think you could. I think the argument is things have been positively received. The market's looking at things as a glass half full right now, largely. And Snapchat has had a nice run.
Yeah, stock has rallied. I mean, the chart looks actually relatively healthy here.
Yeah, and so I looked at something that's a little bit more on the bearish front, Kev. It's looking for kind of a downside reaction to this earnings announcement. Now, I went out a little bit in time, not making it just isolated to earnings, but went out to March 22nd, so it's quite a bit of time.
46 days.
It gives us a little bit more of flexibility in the event that this stock does rally around this earnings event. And I looked at buying an in-the-money put, the 17.5, and then selling this then out of the money 14.5 put. And I looked for about half the width of the strikes. Now, to me, the price sensitivity, how much this costs, being close to the half the width of the strikes is more important than the actual strikes themselves. Others are different. If you're a technical trader, the selection of the strikes might be more important. This is a strategy where a trader would deploy this if they think the stock's going to be lower, maybe substantially lower in this amount of time, a month and a half from now. And so, to me, it's less about the strike selection. It's more about the width of the spread and the money spent to create this 1-to-1 ratio of risk 150 to make 150, and then have that break even relatively close to the current share price. So the current share price, Kev's a little bit over $16 right now. It's 16.5. Our break even is 16, so we would need some help from the market here, about a 3% decline in the stock. But we have earnings that could be that catalyst, and if that isn't the catalyst, well, one, it's risk defined, and two, there's plenty of time for things to turn around in the event that they don't.
Buying an in-the-money put, selling an out-of-the-money put, $3 wide with a 150 debit on this trade. The risk is what you pay for it. You're looking for a move to the downside with the break even, like you said, around $16, Alex. Final thoughts on a trade about 24 deltas short. You're paying some theta, but it's very close. It's almost nothing.
Yeah, so my final thoughts would be this is, while it's not an exact earnings trade because it doesn't expire on Friday, it's going to have exposure to earnings. So I still consider this an earnings trade. If you wanted to wait till after, you would wait till after. And if you're bullish, you would never look at this strategy. But you could look at something in this family. You could look at a call vertical structured similarly, where you buy an in-the-money call, sell an out-of-the-money call if you were a little bit more bullish. But I look at this company as, in this space, in social media, as just because something like Meta did well, doesn't mean all of this is going to crescendo for all these companies. It could be more of a winner-take-all market, less so than everybody's doing well.
Yeah, the question is Meta now dominating digital ad spend?
More than they already were.
Exactly right. So this is a March 22nd of 2024, 46 days out. The 17.5, 14.5 put vertical trading about $1.50. $1.50 is the risk on that trade. The max value for this, if you hold it, it goes below 14.5, is $3. All right, let's take our second break of the show. Come back with Andy Swan from Likefolio. He's going to talk about our cash tag. So that's Spotify. Coming off the Grammys last night, Spotify seems like something great to talk about, and they have earnings tomorrow morning. Take a quick break. Come back in 2 minutes with more Fast Market. See you then, everybody.
Spot. S-P-O-T. Huh. Took a while. What did that just say? Snap. I was just looking at that vertical call. Man, there's a 19-20 cents. Now it's at 30, 31. Now it just dropped back to 19. Very strange. Well, it's set up nice.
Job reading the room in terms of what investors want to see and where interest rates and the market is heading. So overall, we see Spotify continuing to dominate both Apple Music and Pandora. We see no change in that. It's really just a matter of, how much will their customers accept price hikes into the future. We think they've got room to certainly expand on that. And we think, Spotify can be wildly profitable within 2 or 3 years. I think they're just getting started on that side of the equation.
Andy, doesn't it kind of have to be that way, though, if you're Spotify? Isn't it existential when you compare it to something like Apple? Like, Apple Music could literally just be removed, and Apple's stock probably wouldn't even matter. It wouldn't even move. Right. Spotify, if all of a sudden Apple Music was the primary place, could cease to exist in theory. So when I start thinking about this, I happen to use Apple Music just because it's included with my phone plan. But I'm the first to admit that I think the Spotify experience is superior. But to me, the experience is close enough that the not having to pay, free makes it worth it. So as we look at this, my question is how much is this kind of like how Netflix had to look at its space? Like Disney had its parks, Disney has its, its brand, IP that it can monetize. Netflix had to make streaming work. It was existential. The same way that Chewy has to make pet online work because Amazon's selling those products, but they don't really care if Chewy wants to try to steal some of that business. For Spotify, it had to be success, and so far it looks like it has been.
Yeah, I think that's a great point. I think the analogy to Netflix is, really the analogy to use here. And I think Spotify's in much the same situation as Netflix. I think they got there a little bit faster, but they're the only player in the game that really matters. And like you said, the game that they're playing is the only game that matters to them, and that is dominating audio, unlike some of their competitors. And so I think that Spotify, if you're going to be betting on Spotify, what you're betting on is the ability of this team, of this company, to continue to expand, the user base, but also, more importantly, I think, to continue to expand the dollars that they receive per user. And that can happen, in subscription fees, that can happen via audiobook downloads, expanded subscriptions, premium plans. I think they have plenty of room to grow on that front. Also, of course, the advertising dollars. So very similar to Netflix in that regard. And I think both companies, at least for now, have shown us that they are by far the best in the space, some of the best companies at executing on a vision in the world. And so if you believe in that vision, these are companies that execute against it. Why not take a shot? I think that's why we've been bullish on Spotify for a long time and continue to be so.
Andy, when I look at a company like Spotify, the first thing that jumps into my head in terms of profitability is they're like the reverse Uber, which means they may have room to charge more, which Uber really doesn't. They may have room to pay their people less, which Uber can't. So even though Trevor Noah took a shot at Spotify last night for trying to make too much money, it looks like they've got room on both those. So as long as music stays popular, which it's as popular as it's ever been, do they have room to change those metrics to become more profitable?
Yes.
Yeah, I think they absolutely do. In fact, I look at it as this is one of the few companies, in the world that could probably do significantly better on both the revenue side and the expense side. They started cutting costs last year in both, some overhead costs and personnel costs, and there was no
SPX
negative
520.
impact on the user experience. In fact, the user experience, by many tokens,
540.
got better. And at the same time, I think that they raised prices. They didn't see any meaningful pushback on that. Like, full consumer happiness numbers stayed very stable. And so I think they have room to expand the revenue side while continuing to cut the expense side. And that's a powerful place to be. And that's the promise, of all these companies we talk about all the time. It's when will they be profitable? The answer is always they're building out a platform. They're building out a user base. Once they get there, they can do these things to achieve high profitability. Well, Spotify is pretty much there. Netflix is pretty much there. And now they can start squeezing, and we'll see if those theories continue to work. For both those companies, we think the answer is yes. But, there's more to prove. There's always more to prove. And I think Netflix is ahead of Spotify in proving the pathway. And so Spotify just kind of has to follow that lead, in my opinion.
Andy, when we look at how this, expense plays out when it comes to music, isn't it also a situation where the Taylor Swifts of the world are like the John Rahms in golf, where they can get these massive contracts, but it's like at the impact of the guy who's ranked 68th in the world or 70th in the world that you don't know their name? If you're an up-and-coming artist, you just want to be on the platform. You might even pay to be on it to get that exposure. Where Taylor Swift says, I'm not on Spotify. I mean, their memberships could plummet by 20-30% overnight.
Yeah, it's the same. It works both ways. It worked with Joe Rogan. They bet on Joe Rogan. An exclusive deal took him away from YouTube, took him away from all of the other platforms where you could potentially listen to his podcast or watch it, and they put him on Spotify as an exclusive. It was I think it was a 10-figure deal. I can't remember exactly. It was an enormous deal, 100 million plus, I believe. And it worked. Everybody came over to Spotify. Everybody that's into podcasting came over to Spotify. And all of a sudden, they dominated the podcasting space. And like you said, now others just want to be on the platform. So I think they have a good history of going after those really important players and making sure that they're happy so that they can continue to expand their audience base. And so far, so good. I think Spotify knows this industry and this business better than anybody.
News reports that Joe Rogan just upped his deal with Spotify, and the rumors are as high as $250 million. Andy Swan, co-founder of Likefolio.com. Thanks for coming on, as always, and sharing the Likefolio.com data. Have a great day, Andy.
Thank you. You too.
All right, Alex. When we look at this, by the way, here's the power. I was watching the Grammys last night with my 17-year-old daughter. Taylor Swift announces her new album on Instagram. Within 2 minutes, 500,000 likes on Instagram.
I saw like 4 million.
Right. Well, she said like in a minute it was 500,000.
Yeah.
I'm sure it just kept going the whole night. But incredible how all these social medias have come together, and Spotify in many ways is a social media platform as well. It's incredible.
No, and it really is. And I guess my point was that, you know, we're in this world where it's like the biggest of the big are getting bigger, but the small is somewhat being forgotten. You see it in sports, you see it in the music industry, and there's a, you know, it is what it is. But the same thing is happening in stocks. The same thing is happening with these companies, Kev. If Spotify's the winner, they're here to take it all. They're not playing just to survive, and I think you see it in some of these stock price performances.
Earnings before the open tomorrow morning. The trade we looked at was something we do a lot on this show because of the divergence between the front expiration implied volatility, which is 114, and the second, which is 74. If you did an at the money, well, just slightly higher, the $230 call calendar is trading around 65 cents. It's ticked up maybe a couple pennies since then, but you see the graph there. This is a stock that's already had a good run. It's close to or at overbought territory, but if they come out with good earnings, it could consolidate here. This is $8 above the market, Alex, which is inside the expected move. Your thoughts on a slightly bullish, almost at the money call calendar?
Yeah, I think it just depends on, in opinion. The great thing about the calendar spread is how customizable it is. So this is one way to look at it. Someone who's more bullish, choose a different strike. Someone who's bearish or neutral, different strike. But a strategy as you walk through the reasoning behind, taking advantage of that vol differential between the 2 weeks.
Big daily theta. And like I said, a more at the money. It's only $8 high inside the expect move. The risk, 65 cents. Whatever you pay for this calendar spread is your risk on that trade. Be careful if it were to move up towards 230, you could have some exercise and assignment risk, but the overall risk on this trade is the 65 cents. All right, let's take our final break of the show. Come back with Ben Lichtenstein update, Kevin Green talking about Eli Lilly, the pharmaceutical giant. Weight loss, diabetes, a lot to talk about here. Take our final break of the show. Come back with more Fast Market. See you then, everybody.
SPX just hit resistance.
room, where Mr. Ben Lichtenstein is going to give us a market update. Ben, Neil Kashkari making a couple comments. A lot of Fed speak this week, but the market, after being down fairly hard after some economic data, seems to be hanging in there, Ben.
Yeah, Powell really set the tone here last night, right? It seemed like, and then kind of carryover of that pushback, Fed rate cut expectations, as you mentioned here, Kevin, the market. Not necessarily a start to the week that the bulls were looking for, but we are rebounding, coming off lows for the session. You've got the SPX, which is just off those all-time highs that we saw last week, Friday, in reaction to the jobs report, up at 49.75. Currently hanging out around 49.45, so just about 30 points off that all-time high. You got the Dow about 400 points off.
SMCI is really hitting it. This is a crazy one. Even the puts are expensive. Like the $600 put for $7.40 for weekly. I should have wrote that number down. The put on the SMCI. I could have probably paid.
Up 4.8% today, about $32. So with the earnings coming out before the open tomorrow morning, we took kind of an interesting look at this in paper money, and we took the expected move, which in this case is about $40, and we lined up our strikes, but we were a bit aggressive, thinking maybe some of the move is out already in this name. So what we did here, we did the short iron condor, where we went to just the end of this week, right, 4 days. We sold the 730, 740 call vertical, right
Short.
in line, that short strike with the expected move. Now, this is a bit aggressive in terms of an iron condor. I'm going to show you the trade-off on that. On the downside, the 680, 670 put vertical. Now that gives us about
The
a
spread
1.5
ratio?
long deltas, a little bit of a skew to the upside here, but the trade-off on that, on being aggressive with your strikes, lining up those short strikes, the long strikes, the end of this to the expected move, gives us a total credit of $6.20, trading about $6 now on the Thinkorswim platform, but a larger take-in. Now, you still have, as always, the strategy that we're looking at here is a short iron condor. We did an aggressive with our short strikes. We sold the 730 call, the 680 put, only $50 between our short strikes. That's aggressive here. That's why the trade-off is you collect more premium. So you're playing here with this short iron condor for a very, very muted move in either direction. If you think it might have a big move, you would do something, either move your strikes out or do the long iron condor for adding for an expected move. This one took our strikes in, collected more theta, but the risk, of course, is an expected move. If you collect $6.20, you've got $3.80 of risk on that trade. Make sure you understand that. The wider, the trade-offs are, the wider you go out, the less risk, but the less premium you take in as well. So make sure in iron condor you can adjust those strikes. The risk reward is often in line with that premium. All right, that's our show for today, everyone. Thank you so much for joining the Schwab Network and Fast Market. Alex Coffey and Jenny Horn are coming up next with Next Gen Investing. For all of us here at the Schwab Network, have a great day and a great afternoon. We'll see you tomorrow with another edition of Fast Market.
Boom, boom.
Knock, knock. Number one broker here for the number one hit maker.
Thanks for.
There's that SMCI.
risks as well as previews here. We'll kick things off with our upvote and downvote segment. We'll chart and trade those upvoted names as always. FOMO today is one of these names moving to the upside on the heels of its quarterly update this morning that's on semi, which could be perhaps a good read for some of these EV stocks, although Tesla not necessarily seeing any love today as spillover. Then we'll also look at NVIDIA, which is at new all-time highs, or touched new all-time highs earlier in today's session. Last but not least, under 30 today, we're looking at Sphere, which is a fun one. Its first quarterly report as a public company, and it saw a pretty stellar quarter as far as its Las Vegas revenue goes. So that Sphere that we all know and love is doing quite well as far as money it's bringing in.
So I'll be honest, I hadn't spent we're gonna obviously
Better
talk
be
about
honest.
the end of the show, but just I can't hold in. I haven't been to it. I hadn't really looked it up, but just
SMCI
on
put
media,
weekly
the
strike
other day, or
$600.
last on Fast Market, and I just happened to come across some friends who were at a concert at the Sphere in Vegas. It's incredible. It's got to be the coolest environment I've ever seen for seeing a concert.
Okay, so that I've also heard similar things, and I've seen like almost like nature type of visuals, and it truly is remarkable. Like as far as technology goes, really what the Sphere is capable of. Yeah, I'm excited to talk more about it because it's broken into various revenue segments, but specifically, its Las Vegas revenue was killer this quarter.
Yeah, the stock's doing okay too, so we'll talk that at the end with Jeff Pierce. Looking forward to that, but let's do upvote, downvote, not endorsement, not recommendation. Half earnings recaps, half earnings previews. Let's start with the recaps. Estee Lauder, 12% to the upside.
12% to the upside, and they needed it because this name had been beaten up pretty substantially as we did see the fact that it's exposed very much to Asia and, of course, the slower than expected recovery. That has weighed on shares. That was still a theme of this quarter, but they did announce these expansion plans to boost their overall profit recovery plan, including a headcount reduction, saying that they're expanding their profit recovery plan for fiscal 2025 as well as 2026 to include this restructuring program, laying off between 3 and 5% of their positions. Once fully implemented, they expect the pre-tax restructuring and other charges of around 500 to 700 million. And they do expect the profit recovery plan to return about 1.1 to 1.4 billion in operating profit, which was well ahead of what they had previously expected. Now, they also said they do expect to feel some of the macro volatility in other areas around the world. They did lower their fiscal 2024 earnings per share outlook. They also did see sales drop about 7% from a year ago, which reflected the ongoing challenges in the Asia travel retail, as well as some of the overall softness they are seeing from mainland China. So it wasn't exactly the strongest quarterly report, but perhaps the fact that they already have plans in place to fix up their overall balance sheet is seen as what's a huge win here.
Better than feared, is right? It seems to be the kind of the tone of many of these reports. More layoffs, Jenny. But what I found incredible, they needed it as right, and it's like this 12% move. You can't even spot it on this chart. It's way over there, barely off the lows, even with this massive double-digit performance. Incredible how much weakness this stock has had. But right now, anything with exposure to China, even the mighty Apple, struggling to some extent so far in 2024, is the China weakness is just so pronounced relative to what we're seeing in here in the U.S., for example. Next one, though, McDonald's. We had talked about that 300
There she goes.
being a brick wall. Well, it never even got close to it. It just went straight down.
I was going to say the brick wall that continues to hold because this name lower.
I was going to get a put, but not now.
Pretty mixed picture, actually. Adjusted earnings beat expectations. Sales were up 8% year over year. But they did fall slightly short of expectations. They said their same-store sales in the U.S. rose 4.3% and about 3.4% worldwide. However, the international development license markets did see same-store sales
No
just about 0.7%. They did see the largest sales lag due to the war in the Middle East, and said their overall international operated market segment, they saw same-store sales growth of about 4.4%, led by the UK, Germany, and Canada, partially offset by some weakness in France specifically. Now, overall, they actually saw their loyalty members were more than 20 billion for fiscal 2023 and 6 billion in their fourth quarter. They acknowledged the fact that this was some pretty staggering growth for that loyalty program, but the CEO did say that they are expecting to remain resilient in spite of some of these macro headwinds. But again, the exposure overseas, and specifically in some of these various Asia countries, continues to be a weak spot for massive companies, even like McDonald's.
Yeah, pretty steep sell-off today, no doubt, but of course, steep can get steeper. We saw that about a quarter ago before the stock bottomed out around 250, but in a hurry it was back, so you have to wonder how much investors are seeing today. As you said, some of the numbers somewhat mixed at worst. Maybe seeing an opportunity to get involved. Not so far intraday, down about 4.5%, but we'll see if this sell-off is beginning something bigger or just a blip on what's been a really nice trajectory for several years for McDonald's. Next one on our list, also on a nice trajectory, at least over the last year, and that's Spotify. News of re-upping the Joe Rogan podcast. We got earnings on the horizon here, Jenny. And we just were talking with Andy Swan from Folio. He had nothing but good things to say about Spotify.
I mean, $250 million is that Joe Rogan contract, or that they renewed that contract, and it was like the internet, it was in outrage about it. But hey, I mean, I think that with his following, they obviously see it as a good deal. We know their podcasting business has been more expensive than they thought, but I think that some of these major deals are the bulk of that. But all in all, this company has continued to surprise to the upside. Last quarter, they actually posted a surprise profit. And the street is expecting for this upcoming quarter that momentum to continue, even though it's not expecting another profitable quarter. So they're expected to lose about 8 cents per share. That would still mark an increase of 94% from last year. Revenue is expected to climb 22%, and they attribute a lot of their strength recently to just lower marketing costs and lower personnel costs. They've also raised the prices of their subscriptions over the last year by about $1 to $2, depending on your various plan. And they highlighted this in their third quarter earnings call, saying they were in the early innings of a benefit from that. So it is expected that those price increases will continue to have a positive material impact on their upcoming fourth quarter. They did also announce recently in the past several quarters they were going to start audiobooks with access to more than 150,000 audiobooks. And I'm very curious, it's not available, I don't believe, in the US yet, but as someone that listens to audiobooks religiously and you pay per book, which gets quite costly when you're flying through these audiobooks. I'm curious if this catalog is all included, because then it's a great offering, but they don't really make that any additional money off of it for someone like me that's already subscribed.
Well, that would be a pretty big game changer within this industry. You talk about the Audible, which is somewhere in between. You get the credit a month and you sort of build a library over time. You talk about the kind of the Apple audiobooks, which is the old school iTunes, buy the song, 99 cents. That book's a little bit more expensive. Does Spotify then disrupt the last place they have gone to in audio, which is the audiobook? Now, I don't know. I don't have the details, but that would be a potential game changer. Look, I'm Apple Music. It's included in my phone bill, but I'm the first to admit the Spotify experience is better, but free is free.
Free is free, and
included, I guess.
I will say I'm still mooching off my dad on Spotify, which is where my allegiance sort of stems from. But as far as audio streaming goes, I mean, it's incredible, because we used to pay it was 99 cents and it was $1.29, and I can never go back to those days.
The point I made though with Andy, and I think this holds true, is it's existential for Spotify though. They have to be the leader in this space. If Apple Music caught them, Apple's not even focused on it. What's that have to say? This is the only thing they're doing. They better be the leader. It's got kind of Chewy versus Amazon, Netflix versus Disney and the likes, and they're looking a little bit more like Netflix than they are Chewy at the moment. Last one on our list though is Chipotle. Talk about a company that's changed the game, a company that's been very different for investors who have doubted it over the years.
Yeah,
I'd have always.
A relatively more pessimistic note on Chipotle this morning ahead of its earnings, which are out tomorrow after the close, where it was saying its returns as far as a year-over-year basis have been so inconsistent. Because when you look at 2021, we saw a return of 26%. It was down 21% in 2022, and then up 65% last year. But I was like, hold on a second. All things considered, something very major was going on from 2021 to 2022 as far as the restaurant space. I mean, one of the most
they got the target.
The pandemic. So I give them some breathing room, because they have been a relatively
They sure did.
player as far as restaurant consumer discretion.
Jimmy was not a believer.
So I don't think you can necessarily just break it down by those specific, somewhat outlier years. But as far as growth, it is slowing, but its profitability has held up well, thanks to the fact that they've raised prices. That being said, the company's balance sheet remains strong at about $1.8 billion worth of cash. They've been consistently opening up new stores when they had about, they're pacing now to open between 255 to 285 new restaurants this year, with at least 80% including this new Chipotle concept. Their positive performance can be attributed to so many things, one being margin expansion as well as increasing their prices, good execution of their overall digital strategies, and overall solid products. I mean, this company did something, they sort of pioneered the whole like watching your food be prepared, and for that reason, people continue to love Chipotle, and it almost has like this cult-like following where rarely do I meet someone that's like, nah, I can't stand Chipotle. I feel like it's pretty well loved.
Yeah, it's got this perception that it's healthier than a lot of alternatives that would be the same efficient kind of quick meal. I've made the argument that if you're not a big leftovers fan, you really can't make Chipotle at home for any cheaper. So it costs what it costs, especially if you add the guacamole, get all the add-ons and stuff. But the thing that I wanted to point out, we think of Chipotle as this powerhouse in this space, of which it is.
It sure is.
$70 billion market cap. Just a no news day in Apple. It's up $3 today, $45 billion. So while we think of this as a powerhouse, it is objectively a powerhouse. There's still levels to this as Apple's creating over half its value just on another trading day.
Yeah, that is remarkable when you put it into that context. But street high price target is $3,000. I will say the average right now is around $2,450. That's pretty much right below, actually now $30 below where we're currently trading. So the street's a bit mixed. And when you have this high price tag, I feel like price targets go all over the place naturally. But we'll be looking more at Chipotle coming up next as far as technicals and example trades, as well as Spotify, the names that have yet to report their earnings. Stick around, Next Gen Investing. We'll be right back.
Perfect timing.
price movements to show up in them. Exponential moving averages like we're using here, they're more weighted toward recent price action, so they reduce some of that lag, but they don't eliminate it entirely. So we'll have to look and see what RSI is telling us about the pace of the gains we're seeing here. But for now, you know, based on our conventional trend assessments here, things are looking pretty decent. We had some volume spikes around earnings and around our gaps in this chart here. So look for heavy trading. If we do get a big move on earnings, that would show conviction in the direction of the move.
Okay, so as far as RSI and then the momentum of this trend, what are you seeing?
Well, looking at RSI, we can see here it's been trending up pretty nicely. However, a little bit of bearish divergence here. Price made a higher close. RSI actually made a peak that was below the previous peak here. So RSI not quite matching up with the price action here. You know, but the same the thing to consider, we're heading into earnings. It's not uncommon for momentum to slow when we have this event risk type of situation here. So I wouldn't necessarily be, you know, super worried about it as a sign that the trend is starting to degrade, but it is worth noting. I mean, it's still the bearish divergence is still there. We are seeing a slightly slower pace of gains here. It's a little complicated though because the RSI is in the overbought area, which is a sign of strength here. So on one hand, we have the divergence. On the other hand, we have the overbought situation that we're in here. So momentum's still quite strong and still geared toward the upside. But, you know, worth noting that it is slowing.
Okay, so nothing to be concerned of quite yet, and as you said, typically it's not unusual ahead of an earnings event. Their earnings are tomorrow morning, so a bit of ahead of Chipotle's. But now, as far as those key levels you're watching here ahead of what I'm sure will be a busy day tomorrow, what are you seeing?
So it's interesting, once we add our standard deviation channels here, we take our blue linear regression line, our line of best fit based on closing prices, we take standard deviations to the upside and the downside to create these channels. Right here we can see we're actually quite close to that +1 channel. This would be a resistance area to watch. We are above it right now though, so it would be regarded as being a little more supportive, coming in just below 221. So this could be a key point to hold. It could be lead to an energetic breakout in either direction if we do manage to either push above it or kind of falter and fall below it here. If we do keep moving to the upside, +2 channel, our +2 standard deviation channel comes in at 246. Not saying we're definitely going to make it there or anything like that, just saying based on our previous price action, this would be a relatively extreme point. That would be a place you could start looking for some potential resistance to the downside. We've got this small gap that formed near 207. We've also got our 21-day EMA near 209.50. So between those areas could be a support zone. We've also got this green line here. This represents some old highs that we established near the 200 level. We eventually broke above them, but that would be, you kind of look for old highs to become new support after becoming prior resistance. So old support becomes new resistance, old resistance becomes new
I've
support.
said that before.
Just a general adage to follow in your trading.
Yeah, and I think very well put, and of course something we pay attention to very closely here. So now when we trade this name, Alex, of course, earnings out tomorrow morning, but seems like right now, given the fact that we are right around, I believe it's all-time highs, and we're also up 18.5% this week. I mean, so walk us through in a more neutral leaning example trade just for, you know, purposes of the fact that this name has been on a tear.
Yeah, market maker move around 20 bucks. That of course looks at real-time option prices, spits out some math, does some math, spits out a 1 standard deviation range based on those option prices around 20 bucks. About a $220 stock. So we just use those as loose guidelines. We're thinking 240, we're thinking 200 as sort of a general range for about $40 that the market's thinking is realistic. Of course, not a limit for what this might do around earnings. Looked at basically surrounding that level. So selling just outside the upside and just below the downside, the 242.5, 247.5 call vertical alongside the 197.5, 192.5 put vertical, creating what's called an iron condor. Two credit spreads surrounding the stock, looking for it to stay within that plateau of profitability between our short strikes, creates about a $48 window between 196, our downside break even, and 244, our upside break even, where this could at least be relatively profitable. $1.50 max profit, or $150 is based off that $1.50 credit. $350 is the max loss, and really, how does that max loss happen? You get a Meta or Netflix-like reaction. You get a massive move one way or another outside what the market's pricing, multi-standard deviation move. So rather than being exposed to that, you're limited to just the width of the strikes net of the credit, which is 350. So looking for kind of a relatively quiet earnings, but protected against the loud earnings.
Which we know that they have seen, actually, their last quarterly report was a nice move to the upside, so of course capable of moving in either directions. But next name today here is Chipotle. And Rick, I have to put you on blast because you sort of bucked my overall trend where I was like, no one dislikes Chipotle, but you're not a huge Chipotle guy.
It's not that I don't like it. I just find that I never choose to eat there. If I want something fast, I would go for something you could eat while driving because that's probably what I would want it for. And if I wanted Mexican food, I would just go to a Mexican restaurant and sit down and enjoy it. So it's just kind of in that, what's the opposite of a sweet spot for me? Like kind of the opposite situation.
Dull. I totally appreciate that perspective though, because I think I burnt myself out of it in college and it took me a few years to get back into it.
Certainly not trying to disparage Chipotle. It's a fine product, you know.
Honey, we can't date. I just can't eat there. I can't stand it.
10% from those 52-week lows here. Now, notably, we
Honey, you and I will go.
Period of sideways movement.
I love
Once again,
you.
Kind of sideways here after we had an earnings.
He doesn't like
down.
Chipotle.
But a lot of the action has been just kind of meandering sideways for quite a while here.
I have to eat my burrito.
Crossed above our moving averages.
It's a move.
After finding some support 3, maybe even 4 times at our purple 250 2-day EMA. Took off, made our way above those old highs.
What am I doing here?
Upward in a channel type shape here. Once again, you can see here is about where we topped out at 23.48, had a big move upward when we
I am
did
impressed.
break to the upside. Trend assessment, above all of our moving averages, they're all trending up. They're all diverging, similar to our last stock that we covered here. Faltering perhaps a tiny bit today, not really holding on to some of the gains we made, but still, we're basically at all-time highs. We're just a little bit below it at this point here. So not a bad-looking chart at all.
No, absolutely, especially because I feel like typically Chipotle is like ahead of the game, where the street likes the fact that they're relatively innovative. It doesn't ever feel like
They're disgusting.
Short-sighted on their earnings calls, at least. But now, as far as the momentum of this nice uptrend, another name, like you said, at pretty much all-time highs.
Yeah, really not much to complain about once again in terms of looking at momentum.
Maybe I'll have to go back here and try it again.
A little upward action here. A trend line, you could call it. You can use trend line, support and resistance, similar to price on RSI. So we can see here, we had a peak here. We crossed above that peak. The price also crossed above the resistance around the same time. Now we're finding ourselves in the overbought area once again. This is regarded as a sign of strength. Kind of counterintuitively to the way it sounds, you might think, oh, overbought means it's due for a pullback. It means it's stretched too thin. Really, it's the opposite. It means it's like going into overdrive. The pace of the gains is quite strong. The bearish signal comes when it crosses below the overbought area, below that threshold of 70. So be on the lookout for that if you're worried about a downturn in this name. But for right now, we're fairly high. We're at 77 right now. RSI only goes up to 100, so this is a pretty strong reading in terms of upside momentum.
Okay, so very little room for doubt here ahead of Chipotle's earnings. Unlike Spotify, maybe some question, but this chart looking relatively stronger in its conviction. So now some levels you're watching here ahead of their earnings, which are tomorrow afternoon.
Once again, including standard deviation channels here, because as I said, we're at these all-time highs. Not really much of a way to project where you might find resistance because we have no prior price action to go off of here. So once again, +1 channel, quite close to it right now, comes in at 25.10. So we reached very close to that area, only about $4 away from it on a $2,500 stock. That's not very much at all. If we do keep moving to the upside, if we get good earnings, if we move to the upside, perhaps we have this trend line that we formed to the downside. We duplicated it, we put it across the highs. That gives us our channel. That comes in, but at like maybe 26.50 or so, or somewhere around that area. Or the +2 channel comes in near 27.43. To the downside, we've got a nice little confluence here. We've got our trend lines, we've got our old highs, and we've got our 21-day EMA, all coming together near like 23.50 or so, 23.50, 23.60, around that area. So be on the lookout for that to be supportive.
Yeah, and a lot to look at here. And I know that they did, I believe it's intentionally that their stock price is so high because they protect their float. But I wish they'd split their stock because it's like a psychological thing at this point. But appreciate the breakdown as always, Vicky Cut, our chart master. Now trading this name, Alex, walk us through what you're thinking leading into some more optimism, just given the fact that pretty much all technical indicators point to positivity out of earnings.
Yeah, the big per share price makes it a little bit more difficult for the everyday retail trader to participate, but options can reduce it a little bit. That being said, this is going to be one of the bigger trade illustrations from a risk standpoint that we've looked at on this show over the years. Big product, big trade, oftentimes goes hand in hand. So looking at a broken wing put butterfly to the downside here, Jenny, what I find interesting, before we go through the details, we have a break even on this trade of 2,272.
Standard deviation.
Right now in real time, the stock is trading at 2,485. So we're over $200 away from the stock price in real time. And that's kind of a function of the fact that this is a bigger trade and a bigger product. And so just going after this Friday, this would be an earnings related trade. And buying a $25 wide put vertical, the 23.25, 2300, and then selling a $50 wide 2300, 2250. Those converge at this point of 2300. That's our best case scenario. And what's fun is if the stock were to move down and find itself in that area, you can see theoretically this can expand to as much as $2,750 in profit if it's done for a $2.50 credit. Now,
wow, that ain't
most
bad.
traders would hope that that would never really happen and it would just stay out of the money. You simply keep that credit, which in this case would be $250. If it does collapse and it goes all the way in the money to be beyond $2,250 here, Jenny, you can see we have $2,250, $2,250 in risk. So one of our bigger trades that we've looked at, you find that $25 wide spread, $50 wide spread. You subtract that, you're left with 25, which of course would be 2,500. None of the credit leaves you with 2250. So a trade that's neutral to bullish, but the best case scenario actually at a lower price right at those short strikes at 2300. Although big price, big stock, a lot of days to expiration left throughout the end of the week. You don't really want to be catching
She's
that
thinking about it.
You would want to get there by the end of the week.
But to your point, this is really a more cost-efficient way to look at Chipotle because, I mean, like you said, per share, it's $2,400 right now, just slightly over. So this is still, I mean, like, if you were outright buying shares, you'd be looking at perhaps even more risk, just given that relatively high price tag in Chipotle. But we will leave it there for both of these names. Now, coming up next, it's time to discuss another earnings move, but in reaction to its earnings, that is On Semi, which is pacing towards the best day in over a year. On what was a pretty mixed fourth quarter. We'll discuss those numbers more coming up next.
My dad was a hard worker. He used to do side jobs installing windows, charging something like $bucks a window when other
Well, puts her at 680 now.
The mood around that as Tesla's struggled. But all that out the window today. The stock's up almost 10%.
Yeah, pretty nice move to the upside. Its best day since November of 2020 today, or at least pacing for its best day. But it's rising after these weaker than expected financials, which seems pretty counterintuitive. But it is being read by those that are really optimistic in this name that perhaps a signal that the worst could be behind them as far as
Are they
overall.
calling the bottom of the inventory glut and stuff again?
I mean, yeah, I say this with the asterisks because I feel like this is just, a few analysts' opinion because I think it's very difficult to call bottoms in some of these markets. Like they're saying the bottom in terms of the demand market for EVs, which of course, is, like you said, this company has pretty sizable exposure to. But now, on a fourth quarter basis, their adjusted earnings did come in better than expected. Sales were pretty much in line at $2 billion. Both figures fell on a year-over-year basis, but it appears that with these results, so much pessimism had been baked in. They gave pretty disappointing guidance on October 30th, and we saw the stock then tanked as a result. It was down 22% the day of their last report. So coming in at around $70 a share into today's trading, the shares are off by about 15%.
Fat cats are back from lunch.
Prior to their October guidance.
I think we're down to our last chance here, squeezing out of SMCI on the pullback here. $600 put's now at $7. One, two, and three. Be right back with some warm coffee. We're going to squeeze any second. Volume is stunned here. So I think it is.
Theoretically, at expiration, if those March options expired worthless, you'd be looking at like an $80.50 break even. But sort of how this would work going out to
On
March, theoretically, you can see that break even pretty close to the current share price. This is a positive delta trade. This is a long exposure trade, a bullish trade. It's going to do well if the stock goes higher, and it's going to do worse if the stock goes lower. Looks a lot like the calendar spread, but it's tilted on its axis to remove that upside risk. So a long call diagonal here, Jenny, going out to April, selling March.
Yeah, and I think pretty straightforward here. Of course, that nice feeling to the upside today. We'll be watching this today, though, because now I'm curious if it's like the barometer of EV health, since it did somewhat come before some of the downtrend in the overall EV space, but one that could obviously benefit from the recovery also in the same breath. So, well, that leaves it here for FOMO. Now it's time to look at a developing story with Renita Young, senior markets correspondent here for the network. So, Renita, we're talking all things Boeing, and my goodness, the bad headlines cannot stop as Boeing is delaying some of these 737 MAX deliveries after finding more issues.
Bad.
I mean, walk us through this story.
Well, Boeing's been dealing with the fallout of several safety and quality issues on its 737 MAX for years and spent billions of dollars to try to make planes safer for passengers and try to fix its reputation. And today, shares are falling on yet another issue with supplier Spirit AeroSystems says that it found another flaw, this time coming with 2 holes drilled on a window frame on some of the 737 MAX fuselages. Now, those holes may not have been drilled in line with the specifications of Boeing's requirements.
That sounds holy to me.
Right now, the BA commercial airplane CEO Stan Deal reportedly said that this is not an immediate flight safety issue, and all of the 737s can continue flying safely, but Boeing will need to do more work on 50 of those undelivered planes, and that could delay some near-term deliveries and impact Boeing's production schedule. Now, Boeing is planning to devote some factory days this week on this to try to catch up and speed up the process a little bit. And the company is expected to finalize the amount of rework time that they will actually need to complete on all 50 of the planes. And as this is happening, Boeing has asked an unidentified major supplier to stop shipments until the current jobs have been completed to specifications. Of course, many reports are assuming that that unidentified supplier is Spirit AeroSystems, but right now, Boeing shares falling. Spirit AeroSystems finding a new flaw on the 737 MAX.
I know, and it's just not exactly like the public perception you want. I mean, frankly, like, I think this creates some major consumer concern. Like, are their planes ready to be flown? I guess they're still flying. It doesn't seem like, you know, this is a major move to the downside, at least as far as the stock is concerned. But it makes me a little bit nervous because I've flown on several Boeings. But as far as the investigations going on the 737 MAX 9 specifically regarding the Alaska Air incident, what's going on there, Renita?
Well, we're supposed to hear an update from the FAA on that later this month. But in that time, several things have happened. The FAA stopped Boeing from producing more of what it planned to produce of that particular plane this year. They halted the expansion of the production. And then there's still a few class action lawsuits that passengers have filed against Boeing that we should hear more about as well as the story rolls on.
And I'm sure the story will roll on, as it feels like Boeing always makes its way into the headlines. So we'll be keeping this one on our radar. Appreciate the breakdown, as always, Renita Young, Senior Markets Correspondent for the network. Now, coming up next, time to talk a positive story. And it's pretty much always the positive story because that is all things NVIDIA, with new all-time highs in today's session. The stock is still up around 3.9, almost 4% on the day. Amazing story, price target hikes. We'll discuss that more coming up next.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot of questions.
Goodbye. Okay, we're back down to the channel support on SMCI. If it doesn't hold this, we go to the 200, but dingling. Patience really pays off in this market. No junk on here now.
Good afternoon to you. We got to talk some NVIDIA. The stock is constantly dominating headlines, even when it's not, although this on a analyst move that we got this morning.
That's right. Yeah, NVIDIA hitting another record today. Shares jumping 4% at the moment as it just continues its upward trajectory. This coming after Goldman Sachs reiterated the stock on its conviction buy list, raised its price target to get this $800 a share. It seems more room to run for this stock. Keep in mind, its market cap as of Friday was already over 1.6
You believe him, huh?
So just continuing to add to it today. Here's the rationale for behind the boosted price target from Goldman Sachs. They're seeing robust AI server demand. We know that NVIDIA has really been kind of the poster child for this surge in AI and generative AI in specific. GS pointing out improving GPU supply and just talked about even the comparison from a competitive standpoint when you think about AMD, which we know we've talked about that being kind of a distant second. GS saying from a competitive standpoint, quote, although AMD is making good progress, we believe NVIDIA will remain as the industry gold standard for the foreseeable future. Goldman also not assuming losing their base case of a drop off in data center revenue in the second half of 2024. So it's seeing in consistent growth and demand there through the first half of 2025. So boosting its targets for 2025, even through 2026, boosting its earnings estimates for NVIDIA by double digits by more than 20%.
Yeah, I mean, Dan, it's frankly amazing to see like an $800 price target, but hey, we're almost at 700 even just today. So it's like, it feels like sky's the limit for this name. But overall sentiment now going into their earnings, which I know we have some time, it's February 21st, I believe, but I can imagine your take is things seem pretty positive as far as the analysts are concerned.
Yeah, I mean, as far as the analysts are concerned, I mean, this is, again, the industry standard. NVIDIA continues to be the front runner. When you, like, let's say if you use the analogy of a race, it's the Usain Bolt when it comes to this space, to the AI space and where they are. They are the front runner. They are the leader, and they continue to top target after target. So GS boosting its target, again, maintaining it on its conviction buy list. We'll see if they hit that target. Of course, as you mentioned, the next potential catalyst for this will be February 21st, so just over 2 weeks from now. We'll see if they live up to the hype.
Yeah, and that hype has been hard to live up to so far, though I guess it's been a pretty mixed picture.
But they have.
So yeah, some companies have been able to do it, some have fallen short, so we'll have to see where NVIDIA falls, of course. But great breakdown. Appreciate all the insight. Diane King-Paul, markets correspondent here for the network. Now coming up next, it's time for Under 30. We're talking Sphere Entertainment, one that excites Alex and I both. Shares are up 10% today after the company's first quarterly report as a public company. We'll discuss that more coming up next.
I was born on the south side of Chicago.
$2 billion, last number I checked. In today's report, it looks like investors are excited about what they're seeing come out of the Sphere segment of this company. Earnings per share did miss with a loss of $1.59 versus the 88-cent loss expected, but revenue beat, coming in at $314.16 million versus the $301.83 that was expected. That was up 97% year over year. Adjusted operating income came in at $51.4 million versus the $13.2 million loss they saw last year. Again, that's because the Sphere opened. We saw more advertisers. We saw more artists coming in. However, operating loss did expand to $159.7 million from about $109 million last year. Now, that is in part due to them abandoning the London Sphere project that they had set up. Now, Sphere provided more revenue than the MSG network, which is also under the Sphere umbrella. And Sphere came in about $167.8 million, where the MSG network came in at about $164.4 million. However, that Madison Square Garden network still provided most of the profits at about $37.3 million of the $51.4 million in adjusted operating income.
So I'm curious if there's any seasonality impact, because I was reading MSG Networks we're about halfway through right now the NBA and NHL season. So I mean, like, is there the possibility then that when we're in like sports peaks or we're in valleys, that this company's influence at all?
Yeah, absolutely. I think it could be a cyclical, especially when you look at the MSG side of it, right? And I know that business, like a lot of other businesses out there, are dealing with more and more customers cutting the cord, getting away from their traditional television viewing habits. And that's why we've seen MSG launch the MSG Plus app. They are trying to get back some of those cord cutters to get to the application. In terms of the Sphere side of it, there also is potential for a downtime during that aspect as well. If you think about how people go to Las Vegas, there's certainly times that are more heightened than others, more travel that we see that direction. It'll be interesting to see as this goes on quarter over quarter, as we continue to see more and more fans come to the Sphere and more projects like the movies that they've shown so far, whether or not that excitement continues to be there and we continue to see more and more revenue come from the Sphere side and less from the MSG network.
Yeah.
What are we looking at from like a debt standpoint for this company, Jeff? Are we looking at one that's borrowed quite a bit to finance some of these projects? You mentioned how big the project was. I'm looking at the market cap of the company. I think you said $3 billion, $2 billion project, and we're not even talking about a company that's valued at that level.
Yeah, exactly. $2.3 billion was the price to build it. They certainly did take on some debt. We know that they've issued new debt recently as well. I think back in December, if I remember correctly, they had a debt offering of about $225 million in convertible debt. So the company, that is something they're dealing with, right? And in terms of driving that revenue to pay that back, we have heard the company talk quite a bit about that. They broke down their Sphere revenue over the last couple quarters. And I think that overall, we're seeing confidence from management that they're going to be able to handle the debt that's come along with this huge project.
Don't look too
good. I have to imagine that if they have London cancellations, that this isn't exactly something that's going to keep popping up. Because Alex and I were looking at some visuals beforehand, and I was like, they need to build these all over the country, all over the world. But I guess they're quite costly, I'm assuming, if London isn't going through with it.
Yeah, absolutely. I mean, $2.3 billion to build the one in Vegas, depending on size and location, it could be more or less in a place like London. So certainly you have to know that you're going to be able to get it the price you want, and that, frankly, the demand for that product is going to be there. In Vegas, it very much makes sense, right? People go to Vegas for shows, for entertainment. London, certainly that happens, but maybe not to the degree that we see in Vegas.
Yeah, I was going to say, Jeff, this feels like the most Vegas thing other than, like, Vegas itself. Just, like, a visual monstrosity, but like you can't help but stare at it at the same time. Appreciate the insights as always. Jeff Pierce joining us, Senior Manager Derivatives Trading at Charles Schwab & Co. Jenny, we've got a little bit over a minute or so here. Let's talk some overall markets.
Here's your knife, SMCI.
We saw some weakness in the mid-morning. We've rallied back to kind of where we started, but this after what was a just almost excruciatingly busy week last week, as every second there was something coming out that was moving the markets.
Yeah.
Kind of just got a second to catch our breath.
I know, I have to say that for a person that was calling everything lackluster last week, I appreciate maybe some more quiet activity as we're down about 0.25% in the NASDAQ. S&P is down 0.3%. Dow down 0.6%. Of course, the Russell's still leading the losses, down 1.1%.
Woo, the Russell IWM.
Red here. I mean, if you want to make anything interesting, we're seeing some weakness, but still off of lows here. So overall, sort of ending things where we started, Alex. But I do appreciate a slower start to this week.
Yeah, we're crashing 0.6% off all-time highs, and NVIDIA crashing 2 new all-time highs. I mean, for NVIDIA, up 25 is the new down.
I know, and NVIDIA is like, in terms of like
the
NVIDIA, it's basically our green name in a sea of red. Although Apple is also up about 1.5%, so not too bad for Apple. But we
broke that first linear.
Investing. Now coming up next, we have the watch list with Nicole Petalides.
Boom, 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 boom. 700. It's target. Sorry. She's going to tell us a story about the Stewarts on the airplane. That if they weren't scared, she wasn't.
Welcome to the watch list. I'm Nicole Petalides. It's 2 p.m. Eastern Time here, live from the New York Stock Exchange. Glad you're with us. We're up off the earlier lows of the day, but a lot of down arrows here on this Monday. Here's what's coming up in today's show. On semi, Caterpillar shining after earnings, others less so. In the meantime, we'll have reaction to Chairman Fed Powell, his comments on 60 Minutes yesterday, and leading folks to believe not as many cuts, not as fast. And we will break down those McDonald's earnings and the market's reaction to that report. In the meantime, as I said, with the Dow is down over 400 points right now. It's down 234 points. This was after a winning week last week. The Dow, the Nasdaq, and the S&P all up over 1%. In fact, it was the best week for stocks since mid-December. But the concerns about fewer cuts, and that has weighed on the market overall. The S&P's at 49.45, and the Russell's pulling back 1.1%. Oil and gold are mixed. Oil's at $72.94 the barrel. In fact, just turned into the green. Energy is now a green sector. Hadn't been throughout this morning. Gold is down 12 bucks. Had been down closer to 20 bucks. So off the lows there. U.S. dollar 104.29. That's been showing some strength today. Bitcoin 42,870. Kevin Hinks is with me, senior equities contributor here on Schwab Network, talking about some of the biggest stories. And on semi, this is a winner, reporting its earnings this morning, and you're watching this one. Wow, it's up almost 10% right now.
Yeah, you're right. The stock is up right around 10%. Feels like a bit of a relief rally, Nicole, as if you look late summer and fall, this stock sold off hard from $111 down to the low 60s. Now, their earnings were nothing really to be to write home about. They came in with earnings per share of $1.25 versus $1.21 estimates. Revenue $2.02 billion versus $2 billion estimates. Some of their guidance was actually quite muted for the first quarter. 98 cents to $1.10 per share versus the $1.10 estimate. Revenue 1.8 to 1.9 billion versus 1.92 expected, but they did promise and give some upbeat on the future of this company. Their CEO came out and said, driving innovation beyond silicon and silicon carbide with our upcoming analog and mixed signal platform to further our leadership in intelligent power and sensing solutions. So a bit of good news there for the future and a bit of a relief rally going on right now in non-semi.
Yeah, all right. And then what about Caterpillar? We look at all-time highs. A lot of positive comments from that report. Your thoughts on Caterpillar?
Caterpillar up around 2%, currently trading about 321.47, 321.50, let's call it. They had a really nice beat on earnings, $5.23 a share versus $4.76 estimates. Revenue $17.07 billion versus $17.15. A little light there, but all things considered, revenue growth up 19%. Adjusted operating profit margin 18.9%. They said, their CEO said demand remains healthy. Price increases were able to exceed the manufacturing cost for the year. Government spending on roads, bridges, infrastructure.
Yeah, I saw that diamond.
Remains healthy, and demand for their power generating engines because investments in levels with data centers gives demand for their power generation. So some good news across the board there out of Caterpillar. Stock up right just a little higher than 2% on the day, Nicole. So good news out of both these companies.
All right. Thank you for that. Kevin Hinks, great to see you. Thank you. Two big movers there. Eddie Gabor is with us. Looking at the bigger picture, Eddie Gabor, owner, Key Advisors, Wealth Management. Thank you for being with us. A new week, but a lot of down arrows. What say you?
So look, this is nothing more than a little pullback from an oversold condition. I wouldn't even really call this a big sell-off, relatively speaking, to the run-up that we've had. And I expect the sell-off that we're starting to see here, or this pullback, as I'll call it, is nothing more than an opportunity. I do think we'll get more weakness here in the coming weeks. But again, we will be looking to buy that. So we've been very active in our portfolios, but we aren't buying today's dip because I think there's going to be a little bit more legs, and it should, right? This is healthy for a market to actually have things cool down. I think you're in a position here where we're in very overbought conditions. and almost everyone seemed to be bullish, and a lot of times it's better to play the other side of that. So
I was.
Having some dry powder to be able to buy the dip or correction, whether it ends up being 5% or 7%, who knows? But ultimately, I think those dips
I
are
heard
going
6.
to be an opportunity to be able to get more capital to work for those investors willing to take that risk.
How worried are you when our Federal Reserve Chair Jay Powell said in the 60 Minutes interview yesterday that the Fed will take its time to deliver rate cuts? And folks are really hoping for more and a lot of them and such. Is it the kind of thing that could really spook the market throughout this whole week, throughout this whole month?
I think the interest rate market is really the biggest thing you need to watch. You just look at the 10-year bond. I mean, we've had a huge rally in that, and I think that's the biggest culprit for today's sell-off is what's happening in the 10-year. In regards to what Chairman Powell is saying, why would they aggressively cut rates if we're not in a recession? And that's the thing that I just don't get. If they cut rates too aggressively, the biggest risk you run is a reacceleration of inflation. And then they have to come in like they did with Volcker when they cut too soon. And then you have a bigger problem. So I don't have a problem with what he said. And I just never fell into or bought into the story of 6 rate cuts this year. If you're bullish on the economy, why would you beg for a rate cut? And to me, it doesn't make any sense. So I'm glad they're going to take their time. The market probably won't like it, but at the end of the day, if the economy stays resilient, equities will bypass that and grind higher. So I think their biggest fear is a reacceleration of inflation. And in my opinion, that's what will happen if they cut too soon and too aggressively.
I see. So at this point now, you don't want inflation to come back, and they're being very careful about the whole thing. How do you advise folks who are investing this year?
I think you have to be very nimble. I mean, we are in very uncharted territory. When you take a look at the massive amount of debt that we have, even this rally that we've seen, it's been very, very concentrated. There are lots of areas that are still well off of all-time highs. So I think for this year, what we have told our clients is that we're going to be very nimble because anything can change and you have to be able to change with it. We're not just going to blindly buy things and just hold it and hope that it goes up. So we'll continue to be nimble, be very active, and look for opportunities. And I think there will be some opportunities here in this market. But you got to take it day by day, week by week. Trying to predict what's going to happen 6 and 8 months from now in this type of environment, in my opinion, is just too challenging.
Yeah. Now, I know you have international and small caps on the mind. Tell me a little bit about those two areas.
So India has been an area that we've been very bullish on since June of last year, and it has been, in our opinion, a great performer and has had plenty of days where it's generated some alpha relative to the domestic markets. And for us, wanting to diversify and going outside the U.S., we felt like India was the best place to be. Their inflation situation is really good. They're seeing accelerated growth in regards to their GDP, so we still feel comfortable there. In regards to here domestically, we did buy the Qs and the SPY after Chairman Powell's press conference, and we saw an acceleration of the selling there, so we did add to those places. And small caps, to me, if this market is going to stay strong this year, you're going to have to see it broaden out. And the Russell 2000 is still down approximately 20% from its highs of 2021, and that's one of the biggest divergences we've seen in a very long time. So we did not buy small caps today. We think they're still going to go down lower, but we will be buying small caps throughout this first quarter if we continue to get the dips that we anticipate. So we'll keep the bigger cap names as our core holdings and to generate some hopefully additional alpha to the portfolio. We will look to add small caps and potentially be aggressive there based on what we're seeing.
Right. On Friday, the Dow had its 9th record close of the year. You could use the S&P. Obviously, that's had some record closes as well. Do you see records happening again?
I do. I think the trend is going to continue to actually be higher after we get through this little sell-off that we're going to be dealing with here in the first quarter. Because again, right now, you've got a lot of stimulus still in the system, and your money flows are still heading
This guy's a
into
good
the
talker.
equity markets. And so I think unless we see a huge drop-off in growth, and we'll be getting some GDP numbers, if we see a huge drop-off in growth or we see inflation start to show signs of accelerating, those are the two things in conjunction with the Treasury market that could derail our thesis that the market will continue to grind higher and be at new highs in the coming months.
Eddie Gabor, Key Advisors Wealth Management. Thank you. Good to see you, Eddie. Coming up next, Jay Powell expressed hesitancy when it came to rate cuts, and so let's break down some of the market reaction next here on the watch list.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platform.
I'm taking a little fast scalp here on SMCI. SMCI. Now you could probably get out here once you hit the 63 if we have one more candle. That or it comes down and it hits 645, which would be a real nice ticket right now. See how it came down and created a hammer right there? That's the 63 EMA. Then you got another support right here. One, 2 bits, 3B. Now's your exit 650 if you want out. I want to see if I can get another candle. It's not really acting like support. Kind of held here. And it'd be a good idea to get out though, Jimmy. There we go. 665. Come on, give me $100.
Absolutely. You know, this is the first time they've been fighting inflation in a cycle for a long time. So, you know, being patient is going to be key here. The last thing they want to have to do is have a start and stop and blow some credibility. They're going to try and get it as right as they can. You know, the deflationary trends were
They're doing a horrible job, sir.
Robust in the fourth quarter. That's part of the reason why we had this run up in the equity market and you know, the dropping of interest rates and the pricing in of aggressive cuts. But what they're worried about, I don't know if you've looked at container rates and some of the shipping areas. You know, we know the goods inflation scene is going to get a little stickier, and we're also seeing very very robust service sector data that tells us that the service sector inflation may get a little sticky. So they just want further data like these messages to see where we're heading and not be in a rush to jam some cuts in early in the year.
Mm-hmm. You know, as we have yields on the rise, in fact, a jump over a couple of days. Pretty significant move as everybody's expecting this higher for longer environment. What do you say about the market and trying to invest in the market when you have yields higher and the dollar higher?
Yeah, it's difficult. I mean, you had, like another guest mentioned, it's very inconsistent pricing of risk now. We're pricing in really no downturn and an earnings acceleration, yet we want aggressive Fed cuts and deflation to continue. That's a difficult environment. I think the equity markets could be kind of like, 10-year yields last year. There was a lot of noise, but we ended up
SMCI
started. I think equities could see a similar pattern this year where we get excited the earlier part of the year. Certainly it's in the best interest of the Fed and the Treasury not to disrupt the market in an election year. So maybe we get some run up in equities, and maybe they have to realize that higher for longer raises some of the economic risks, and we have to give some of that back. And these PE, these multiples in the equity market are not sustainable for the whole year. So maybe the equity markets have to give some back, and we end up with low single-digit returns by the end of the year. And so maybe your first line of defense is more bonds in the portfolio. If that's a position that's possible, maybe the certainty of return in the fixed income market is your yield, right? And you're certainly going to get some cuts at some point, which will mean price gains for the fixed income market. So your first line of defense is perhaps more bonds in the equity portfolio.
Right. As you see earnings coming in thus far, is there anything that sort of has stood out to you, or a message that you have received when you look at the guidance, for example, or different sectors?
Yeah, I mean, they kind of lowered the guidance ahead of the season to make it easier for B tier. So again, the market was priced aggressively for reacceleration of earnings. We're not as optimistic. We think, pricing power is going to wane. It's going to be difficult to maintain margins. You're seeing job cuts in the tech sector.
It's acting like a support now.
Your margin is actually to cut jobs. So, we think it's, the economy's been...
The 63.
If you look at the manufacturing sector, the ISM sub 50 for a very long time, that doesn't bode well for future earnings. So we think they're going to deliver. They're going to look okay on the surface, but we worry about the reacceleration that is predicted. And I think the way you handle that is kind of spread yourself out a little bit better in the equity. You don't want to just be hunkered down in the mega cap growth. I think that's been very tempting, but those valuations are off the chart and going to be difficult to maintain in a market that's going to run into trouble as the year progresses. As the economy, higher for longer raises the economic risk over the medium term. So the longer they have to keep restrictive policy, the more difficult that is to maintain the economic growth as the year progresses. So we think you got to be high quality, look for stable cash flow. Those baskets are difficult to put together because you end up with a lot of mega cap growth. I think you have to certainly diversify that a little bit better, and then look selectively internationally, places like Japan, places that still have policy support going the other way and valuations that are attractive.
Right. And just to circle back to your concept about bonds and the fact that seeing that bonds could be the outperformer in 2024, I mean, how much of a portfolio would you put into bonds, and which ones would you recommend or say are best bets?
Yeah, I mean, for asset allocators, they're going to be attracted to yield. You're going to see one of the things, it's kind of a self-fulfilling prophecy here, right? Because, the more attractive yields are, it's going to draw some of that asset allocation money to bonds, which is going to keep spreads stable and the flows going into fixed income. I think you're high quality. You don't need a big overweight, but if you're an asset allocator in that 50-50 area and you put another 5-10%, you're putting some duration in that portfolio, which I think makes a lot of sense. And because spreads are tight, but yields are high, so you don't need to dip down into lower quality as aggressively. This is not the time to reach for yield. You're still getting close to 6% in investment grade corporate bonds, AAA mortgages. Agency AAA mortgages are getting you similar yields to investment grade credit, which is not usually what they're giving you. So I think you just add high quality core fixed income. You don't have to make it complicated. You don't need a lot of high yield emerging markets, preferred stocks, things like that. I think you need core fixed income and duration on the equity side would be helpful.
All right, Rob Williams of Sage Advisory, thank you so much. Coming up, the Magnificent Seven. Well, we certainly dominated the markets in 2023 and somewhat in 2024 as well. Some more details. We'll be right back.
There it is. Finally. Now, 1 Tubus 3B.
businesses with unique prospects and opportunities and valuations, and I think we need to look at them as such. And I think this most recent earnings season is showing that in the numbers. We have some that are doing very well, we have some that are doing a little less well, and then we have others that are continuing along with a pretty strong secular growth trend. So we still like a number of these companies. We own 4 out of the 7, and we think for long-term investors, they still make sense in the portfolio.
Right, I know you have no Tesla, no Nvidia. You skipped a few of them on your radar, right?
No,
Which
no
ones did
Meta,
you skip
yeah.
and why?
Yeah, so we owned Meta, otherwise known as Facebook, for years, and we sold it a couple of years ago because we thought the culture at Meta was somewhat toxic, and I think that was leading to some suboptimal business decisions. Obviously, that now looks wrong in hindsight. You're not going to get them all right, but I think long term there are still some headwinds at Meta, to be sure. One of those now being the focus on plowing $15 billion in capex into the metaverse, despite trying to be now an AI company. So there's some cross currents there. Tesla has been a challenge on valuation and competition for some time, and I think obviously the challenges with their CEO in terms of his attention and his manic dispositions have been a problem, and we're seeing that show up in the stock. And then Nvidia is just one we missed. I mean, that's a stock that was on our buy list for 7-8 years. We never pulled the trigger on valuation, and now AI, of course, has created a double and a triple in that stock over the past year or so. So we still like it. We don't own it. It's on our watch list. It's just too expensive.
What's SEMIS? SEMIS.
You do have Apple, Amazon, Microsoft, and Google Alphabet. Apple's an interesting one in that some people have been turned off on Apple lately. What are your thoughts?
Yeah, you know, we still like Apple long term because we think the things that are turning investors off right now are short-term problems. Like we're seeing, obviously, China has been a hiccup for Apple for the last couple of quarters. Revenue growth for Apple over the last 4 quarters has been slightly negative, which is the first time we've seen that since 2001, before they launched the iPod. And valuation is more expensive, right? We're talking about a stock that's trading at 30 times earnings. It had a great year last year in terms of its stock return, and yet the business kind of went nowhere at the top line. And obviously, China is the second largest market for Apple, so growth slowing there is a concern. But we think all of those are really kind of looking at Apple short term, and instead we'd rather look at Apple long term. And what we still see in Apple is we have this installed base of devices, over 2 billion devices that are out there that can be upgraded, we can see services being sold into. Apple's services business, something we've been bullish on for 5-6 years now, continues to grow at double-digit pace, and it comes with much better margins, 2x the margin over the iPhone. Meanwhile, there are new categories that are being invented. We're actually quite bullish on the Vision Pro, not necessarily the $3,500 developer version, but the version to come, which is effectively going to be AR, AI glasses that are probably going to cost the same amount as an iPhone and look a lot more like regular sunglasses or eyeglasses that you would wear around. So we still think there's a lot of opportunity for Apple. Last point I'll make, Apple is not at all in the AI hype right now, but we know Apple is in fact working on some AI things. We'll probably see an AI app store launch maybe.
We're coming back in and buying
there's a lot
it.
of good things happening still in Cupertino. Valuation's not cheap, but we still like the stock long term.
All right, thank you for all that, Jason. So Amazon, Apple, Microsoft, and Google are the ones that you've had the most interest in of late, based on your positioning. I'm going to leave those for a second because I know you also have Uber and Disney to speak about today, and I don't want to run out of time. Uber has been incredible in that it's always fun to see a stock listing and then, you know, the path to profitability, and then in fact hitting that profitability and then going into the S&P 500 and things like that. It has been stellar, and you still like it and think that now is a good time for it. Why?
Yeah, I'm not sure I'd say now is a good time for it. I mean, the stock has tripled off of its lows in mid-2022. So really the best time was to buy it when nobody else wanted to own it 18 months ago. But look, we still like the story long term. Uber, this is really a 2-horse race in rideshare, and Uber is winning that rideshare competition with Lyft in spades. Daria has done a great job since coming in as CEO and managing costs and getting the company to profitability. We're looking at a company that did, $1 in EPS last year. They're probably going to do close to $2 in earnings this year, on their way to $3 to $4 in earnings by the end of 2026. So if you look at a couple of years, the growth in the profit contribution to Uber still looks really good. The stock's trading at a 25 to 30 multiple if you look a couple of years down the road. And this is a business, again, where they're dominating the market. Competition is not taking away from their growth rate. So we're really optimistic on where Uber can go. Again, it's had a big run. So, valuations a little more extended near term, but when we look out long term, we still like it.
Okay. Last but not least, Disney under Iger. Your thoughts there?
Yeah, still got a turnaround going in Disney Plus and the studios business. The parks and experiences business is still doing great. It's been doing wonderful for the last couple of years. It's taking up more of the overall business mix. Look, Disney Plus has been growing subscribers quite handsomely over the last couple of years. Profitability has been difficult. They were running at like negative 15% operating margins. Meanwhile, Netflix has, a mid-teens operating margin. Not sure they're going to be able to get quite to Netflix margins, but we do think that they're probably going to be, running at about flat at the end of this year, and then we might see some growth from there. So if you look at a couple of years on Disney earnings, we think that the stock is reasonably valued, sub 20 PE on 12-month forward earnings for a business that still has a wide moat and a lot of opportunity ahead. So great parks and experiences business. Streaming is going to be profitable here in the next year or so. Iger sticks around for a couple of years to make sure that gets solidified, and we think the stock for long-term investors still looks attractive.
All right, that sounds good. I'm not sure Nelson Peltz agrees with you, but let's see. And I'm glad you were on,
Sure.
Jason, today to tell us about some of the names that you like and how your vision is shaping up for some of these names. Jason Ware of Albion Financial. Thanks, Jason. Still ahead in the second half of our show, we'll dive into a couple of more stock names that are on the move you'll want to hear about, and we'll get our panel's reaction to the McDonald's earnings. Stay tuned. We'll be right back. Schwab Network.
McDonald's wasn't too happy. Uh-oh, SPX broke out. Resistance.
Just advising how carefully the Fed is moving pertaining to rate cuts, and that spooked the market today. In fact, the Dow was down over 430 points today. It's come off the lows, though. You have some sectors, and here are the numbers for you. Some sectors like tech and healthcare, even energy, have turned into the green. As right now, we are seeing the Dow down about almost 200 points, but as I noted, have been down 434 at the lows. The S&P is at 49.53, and the NASDAQ is just fractionally. Look at that. In a moment, it could even turn into the green. continue to follow some stocks in focus on the move. Joining me right now, Diane King-Hall is with us, markets correspondent here on Schwab Network. And we're taking a look at air products and chemicals. Now, this is one that has been beaten down badly today.
Indeed, down nearly 15% at the moment after turning in a worse than expected quarterly report card. So that's APD, Air Products and Chemicals. It's an industrial supplier of gases or seller of gases. EPS, adjusted EPS was $2.82 a share. That missed expectations. Revenue about $3 billion, also a miss. There were a lot of headwinds globally for this company, citing issues in Asia, namely a slowdown in manufacturing in China. There was lower helium demand there, along with some higher costs from the sale of equipment project, and also it talked about the currency devaluation in Argentina and how it hit that company. We've heard that talked about in some earnings so far this reporting season. Revenue in the Americas was down 10% year over year. Europe revenue declined 8%, and also the company guided lower than expected. So really just a lot of issues with how the company performed both in the quarter just passed and the current quarter. The expectations there, really some challenges for Air Products and Chemicals, down at the moment, again, about 15% there. So getting really hit hard there, not causing as much damage as it did earlier in terms of the S&P 500.
All right, and then we turn our attention over to AbbVie. We think of Botox, Juvederm,
Yes.
some of those things.
Yep.
But this one's on the move, but this one's higher.
Yes, it is. AbbVie getting a bump, although there's some mixed reaction in the analyst community. You have some different price target there. Wells Fargo raising the price target on AbbVie to $200 a share from $180. It's maintaining an overweight rating on the stock right now. AbbVie is up about 2% there. Talked about AbbVie's growth story and its pipeline. So Wells Fargo sees this as a positive. Barclays, on the other hand, lowered its price target. It lowered it to 280. It had it above 3. It had it at 325. It is maintaining an underweight rating on the shares. Barclays saying that its Q4 results may indicate the start of a tough operating period. We know AbbVie cited some challenges. Of course, we know it has some competition for Humira, but on the flip side, the positive is that it expected the whole Ozempic face trend to be a net benefit for it because it believes that will add to demand for Botox. One more analyst target out, the B of A, raising the price target on AbbVie to 167 a share. So it's lower than where it is now, but it's maintaining a neutral rating on the share. So mixed reaction in terms of the analyst assessment of AbbVie, but in terms of how investors are viewing it, they're looking at the positive for AbbVie.
All right, a lot of good analyst reports on that one. Thank you so much, Diane.
Thank you, guys.
Great to see you. Diane King-Hall. Now we turn our attention over to the January stocks report. What's that? Schwab Trading Activity Index. Joe Mazzola is with us, Trader Education, Charles Schwab. Thank you so much for being with us. So what did we learn from the latest stocks report?
Yeah, well, hey, clients were buyers. They were buyers in January, but they were selective buyers, Nicole. I think that's the takeaway is that, they used, I think they used interest rate moves. They used stronger economic data to make some pivots. So they pivoted away from some of the interest rate sensitive names that they had purchased in December, moved a little bit more into the Mag 7. Some of the big net buys that we saw were in Nvidia, Amazon, Microsoft, AMD, even Tesla was a stock that was bought across the board. But like I said, I think a lot of that had to do with expectations heading into earnings, and then really kind of drilling down into companies that when you think of maybe 2023, companies that did well in a rising rate environment.
How does this rate, when you look at the historical perspective, the exposure is still relatively low. Is that right, Joe?
No, that's absolutely right. And, it might be a little surprising to think that, at the beginning of the year, coming off the strong November, December that we saw, that we didn't see a little bit more bullish client positioning. But like I said, I think it was selective buying. You look at the number, it was 44.73. So, we look at a stacks, which is a traditional range between, say, 35 to 75 on the upper end. So it is moderately low, and I look at that as a client that that potentially still has cash available. It doesn't necessarily mean that that they weren't buying. It's just that maybe they weren't buying as much, right? So they weren't levering up. They were kind of sticking to cash transactions. So basically, Nicole, the way this works is we have 35 million accounts that we can look at. We take a sample size of that, and we look at trading activity. And what I like about this is that it's behavior based, right? It's not attitudinal based. So we're actually looking at what they're doing to gauge that sentiment.
Right, understood. And at this point now, they also sold off some names. So when they're selling, it doesn't mean they've dumped out entirely. It could be that they're just taking some profits or trimming a position, right? And you have some names for us there.
Absolutely. Yeah. So Bank of America, Walmart, GM, Carnival Cruise Lines, and then Warner Brothers Discovery. Those were the 5 largest sales from client accounts. And once again, I think when you look at these names, these are names that tend to be a little bit more interest rate sensitive. Maybe not Walmart as much, but a little bit more economic sensitive. And so those were the ones that clients kind of peeled off a little bit in the portfolios and rotated into some of the mega cap names that we had mentioned before. I think another takeaway from that is I just kind of look at the economic backdrop, right? And I think to me, it really goes back to the interest rates. Interest rates, rallied from basically 3.8 in December to about 4.15%, kind of topping off it during that period when we look at the stacks from January into January 24th, and that was kind of the end. So to me, that between that and the dollar strengthening, I think that was one of the reasons that clients pivoted.
When you mentioned some of the Magnificent Seven, you said they were going into names like NVIDIA. What were some of the others that seemed popular of late?
Yeah. So we had Microsoft, AMD, Tesla, and then you mentioned NVIDIA, yes, and then Amazon, excuse me. So those would have been the 5 biggest buys that we saw from clients. And like I said, I think out of those, they did a pretty good job nailing a few of them. Tesla pulled back a little bit, but as your previous guest said, you can't group all the Magnificent together anymore. You kind of have to look at those on a separate basis.
Yeah. And look, this is proprietary data to Schwab because they see the investor movement. It used to formerly be known as the Investor Movement Index, and so it really gives them a glimpse into the behavior and patterns of some of the traders, investors, whether they're day traders or long-term. Any other final takeaways from this or just the week ahead?
Yeah, so, Nicole, what I would say is this. We get this question quite a bit. How do you use this, right? I think this needs to be used in conjunction with the other type of analysis that you do, whether that's fundamental analysis to kind of identify sectors and opportunities within industry groups and stocks, technical analysis to look for, entry and exit signals. Then you can also incorporate this. This is kind of behavior analysis from clients and behavior analysis from the retail public. And to me, that kind of strengthens, whether that's a bias towards a bullish or bearish, just using all 3 of these components together.
Yeah, and luckily we'll get it again in February. Not too far away. Thank you so much, Joe Mazzola. Great to see you of Charles Schwab. Thank you for that. Still ahead, we'll bring in our panel to talk all about McDonald's. Now, this name has been under pressure. In fact, all the restaurant names mostly down arrows today. Let's find out what some of the headwinds are and if there's opportunities in the group. Schwab Network. We'll be right back.
Meta boom.
The group, Dan Aarons is with us, Advisor Shares, and Andrew Wong, Runnymede Capital Management. Thank you both for being with us. So, Dan, I know that you have McDonald's in the Eats ETF there. There are a lot of positives when it comes to McDonald's, but the stock is selling off today. Do you see this opportunity, or are you concerned?
I'm a little bit lukewarm on McDonald's. We have it in our Advisor Shares Restaurants ETF, Eats, but it's a little bit of a underweighted position. People have to realize that McDonald's is a true global brand and therefore carries, that global macroeconomic risk. And that's what its problem was this past quarter, especially with worldwide conflicts, the Middle East in particular. We're a headwind to McDonald's. They had a pretty big focus on their forward guidance on China. High risk, high reward again. So again, we're middle of the road on McDonald's. We have in our fund because it's a little bit of a bellwether for the restaurant industry, but I think there's some better stocks to own.
Yeah, and I would love to hear what's contrary to that, right? Like, for example, but hold the thought. Let's get to Andrew Wong. Your thoughts, you actually saw some good things pertaining to McDonald's. Do you see today as a buying opportunity, Andrew Wong?
I think overall it was a good quarter for the #1 fast food restaurant in the world. Fourth quarter earnings estimates per share beat, came in at $2.95. Revenues missed slightly, 6.41 versus 6.45. I consider that in line. What investors are really paying attention to here is that this is the first time in 11 quarters that McDonald's has missed on comps. And I think what we have here is that McDonald's has delivered exceptional performance over the last 4 years with strong broad-based momentum when compared to 2019. And price increases over that period have been a driver of growth. And now macro headwinds have management saying that comp store growth will likely moderate to normalized levels.
How important is something like the loyalty program to you, Andrew?
I think the loyalty program is very important. The company has done very well with its loyalty program. I think it boasts about 150 million users, and the company has aspirations to grow that quite significantly. I like that the company continues to innovate with its menu. The McCrispy sandwich, launched in just 2022, is now a $1 billion brand across 30 markets. And McDonald's did $25 billion in annual system-wide sales in chicken.
And Dan, I mean, you mentioned the concerns that you have about the global footprint and some of the headwinds. I mean, the company noting Middle East being problematic for the company. China is an area where they are heavily invested and expect growth, but that is something that also worries you. What would be contrary to McDonald's, a name that you seem to count on a little more these days?
factor. And again, we like McDonald's. We just don't love McDonald's in the current environment as well as much as some others. Now, one way to play McDonald's, in our opinion, is through Arcos Dorados, ticker symbol ARCO. They are one of the world's largest franchisees for McDonald's. They have exclusive rights to McDonald's throughout Central, South America, the Caribbean, where McDonald's is almost a little more of a luxury in many of those areas. So we like Arcos Dorados as a smaller cap stock, much smaller obviously than McDonald's. Also in our fund, we're liking Wingstop right now, Chipotle. We have a heavy focus currently towards fast food and fast casual. And one thing we like about the entire industry right now is their ability to have flexible pricing. They have raised prices with inflation, and right now, people seem willing to pay up.
Not me.
McDonald's did well too in their U.S. sales. They had a revenue beat, largely based on inflationary pricing. So there's still a lot to like there.
Yeah, and you mentioned Chipotle is one of the names, and that has been an incredible performer since it listed. I mean, it has certainly made its shareholders very, very happy. Andrew, I'll give you the final thoughts here. As you see, you think it's a strong brand. You talked about the new stores that'll be opening. It has the biggest footprint, right? I mean, where do you go that you don't find a McDonald's? Is that a good idea for you?
Well, I think the key here is that I think it's worth paying attention that CEO Chris Kempczynski, he's been expecting a recession since the fourth quarter of last year. And in the recent earnings call, he mentioned that affordability is coming into focus for some customers. So there are things beyond McDonald's control. It has a very strong system, but the continued war in the Middle East, some customers pushing back on price increases. I think that investors should kind of take a wait and see attitude here.
Yeah, and just quickly, Dan, you had mentioned the Cosmix coffee. Where do we stand on that? Because we know some of the others, Dutch Brothers, and the other one in China, I can't remember what it's called, that was supposed to take over Starbucks but didn't. Final thought?
Well, I like the Cosmix, but it is just a tiny experiment at this point. It's a neat concept, sort of a fast competitor to the Dutch Bros model of coffee. And hey, people like McDonald's coffee. It's always high rated. So I think it's a neat concept that they should expand on and go with it.
Yeah. Lock-in. Lock-in was the coffee name that sort of escaped my mind for a moment. See you both. Thank you both very much. Dan Ahrens of Advisor Shares and Andrew Wong of Runnymede Capital Management. Good to see you both. Thank you for being with me, friends. I'm Nicole Petalides, live here on the Watch List every single weekday at 2 o'clock. I see you at 11 a.m. and 2 p.m.
4 more minutes, Power Hour.
Network. But keep it right here because up next, Oliver Rennick, Market on Close.
market on close. I'm Oliver Rennick. You're watching the Schwab Network. 1 hour left in the first day of the week, and things are going okay. Nasdaq's popped back after some red earlier this morning. Markets were in a little rougher shape after some compelling data came out on the services portion of the economy, and that sent yields spiking. They're still spiked in the dollar too, but stocks continue to grind higher. Very important development last week. Equities rallying when yields are up. We saw it after the employment report, and we're getting a little bit of it today as we see some dip buying from the early trade. Nasdaq first to go green. We'll see what else follows. S&P right behind. You don't have a majority of the Mag 7 higher, but you've got 3, and you've got chip makers that are rallying too. Always important to have the backbone of your tech narrative going in the right direction, and that's what you've got. We do have some earnings after the bell today. We're going to be hitting NXP in particular, looking for more information about the tech and autos trade. Right now, the still biggest move of the day, though, is in bonds. Your Russell's down 80 basis points, but kind of par for the recent course for the small caps. The big move in treasuries. A pretty juicy sell-off last Friday and another one today. Makes sense when the data are this good. As we saw, both the final read for PMI manufacturing hanging out well above, or services rather, well above 52. The last manufacturing print for PMI was above 50. The services ISM has been the real heart of the economy, and that had a pretty big jump in prices paid this morning. So the inflationary component of the ISM services, which is pretty standard to be above 50, but seeing prices paid really pop. Pretty big jump in new orders too. After the ISM manufacturing from a couple weeks back got so close to expansionary territory, we're really seeing very few gaps in the economy right now. Even compared to the last couple of years, we have definitely seen worse patches of data. Got some in 2022, got some in early 23, but not recently. It is just beats around the board. So the dollar and yields are rising. The dollar, as I mentioned last week, looked to have some more conviction and a better trend. Yields were out of place, is the way I described it Friday afternoon, and so we're now getting them back in place. Dollar, more reliable. I've said it over and over and over. More reliable than bonds. Really pay attention to it. It's so helpful. Because when the dollar and yields are out of whack, yields always seem to come back to where the dollar is. So once again, the greenback leading the way. As the trade that represents an overall market perception of the Fed that's not quite right. So the perception in the middle of last week was when the bond market told Powell to shove it, basically. He said, we're still thinking March is a very possible thing. And then, after the employment report on Friday, bond bears took over, and some of the doves were forced to reconsider. Then you've got Powell doing 60 Minutes, aptly timed over the weekend, pretty much saying what he said last week. And so now there's no real mistake in it. Bonds selling off, dollar rising. Seems to be like it makes sense and should be the trend until we get some further inflation prints in the next couple weeks, couple months. Got about a month and a half until March. So you're going to have 2 more inflation prints in there. Things could change if those look really, really dovish. But right now, you're starting to see a little bit.
We got a little pullback here.
In some of the macro trends that were really helping the fringe elements of this bull rally outside of the Mag 7. Think about the unprofitable stocks, the high beta risk assets, stuff like the clean energy ETF, PBW, ARK-K, moonshots, the small caps. There is definitely category companies here underneath the surface that are sensitive to rates. Apart from the obvious stuff, there are now clear distinctions being made by the market on who depends on this very dovish narrative. Notice the way the ARK fund peaked out basically as the calendar year changed. That's when we put the bottom in for rates. But then the PBW ETF, or Clean Energy Fund, has just been getting hammered because there's also some cyclical concerns there too. So the worst place to be in the market right now is interest rate sensitive without clear, fundamental, profitable, high margin businesses. And so the worst group really in the market right now is that PBW ETF. It's so just a mess. Maybe it doesn't bode well for NXP tonight, but On Semi, another auto-connected trade into the EVs, is rallying this afternoon despite kind of a mixed report. Bottom line is, chip makers are up 2%, and NVIDIA continues to run, weeks away from its earnings. And so that drives the NASDAQ forward, and once again, it flips green into the last hour of the day. Kevin Hanks, Jenny Horn, with me here in the studio. we're starting to really kind of see, Kev, who's interest rate sensitive and who's not in this market.
Sure.
I mean, it's painfully obvious, right?
Well, certainly anything without, you mentioned solar companies, right? You can almost stop there, right? That's its own story, and it's interest rate sensitive.
Yep.
Right?
And it's got fundamental issues.
And it might have government spending issues going forward. There's a lot of reasons why these stocks may have peaked out. You've got First Solar down, but Solar Edge, First Solar is actually having the best day of it. It's only down 1%. Solar Edge down 3.3, Enphase down 3.7, Sunrun down 4.6.
The best stock is only down 1%.
So yeah, exactly, and that's the winner on the day of those 4 solar companies.
Some of the other stuff is kind of, utilities, the kind of real estate naturally kind of gets pressured on days like today.
Utilities
First Solar's had a pretty good sell-off.
Interest rates, right? You go to real estate, you go to utilities, those will be heavy because of the debt that they carry.
Yeah. So that's kind of standard.
Yeah, it'll be bouncing pretty soon. It's that time.
Responded to this in the past. They're down again today, but we got all the Boeing mess too. So it's like I don't really know whether or not we should put that in this
Please get off the headlines if you're Boeing. Remember, their quarterly numbers weren't bad. They were joking about him at the Grammys last night. It was just
what's funny
get
about
them
it?
off
I know, it's
the
like air
headlines.
safety is not funny.
Yeah, exactly.
No jokes, please. Seriously. All right. Okay. The thing though that's saving the market kind of today, Jenny, is on semi. I don't look. This report feels like you could spin it either way. The guidance to me seemed like they came up like short, like outright short for the next quarter guidance, where their top end's going to meet the estimate. But what did I miss here? How come the market loves it so much?
I mean, for the first quarter, they expect sales of $1.85 billion. She was expecting over $1.9 billion. So that was a miss.
Clean miss. Just a miss.
Clean miss. And their sales came in perfectly in line. It wasn't like a super upbeat number. Earnings were slightly a beat, sure, but both figures fell from a year ago. So it wasn't like we saw growth on top or bottom line. I think the read is perhaps that we did see the stock sell off 22% following its last quarterly update when they really, really dialed back their guidance. So perhaps so much pessimism had been priced in that today's result was maybe not as bad as feared. I mean, even the 22% move to the downside brought down names like Tesla, saw some selling on that day because this is seen, at least in terms of like what the street is like trying to predict as far as the EV market, as perhaps a gauge for the EV weakness. It was one of the first that highlighted some of the signs of weakness in overall EV and automotive. So that's kind of interesting. I wouldn't necessarily say it's like an indicative. I think it just sometimes can coincide with what we're seeing in the EV space because it's obviously not a pure EV player. But I do think it's interesting. Shares are down 15% since that October release. Shares of NIO are down 26%. Tesla's down 9%. BYD's down 30%. So it has been an industry-wide selling. So I just think maybe perhaps it wasn't as bad as feared because really this was not enough to me to warrant a 10% move to the upside, but here we are.
There's a relief rally feel to this move.
Yeah. Well, it could have been worse.
Remember, last July and August, the stock was trading $111.
Right. And then it got down to 60 in the last earnings.
Right. So the fact that their CEO came out and said, things are getting better, and he gave a kind of an upbeat look at the future, it feels like a relief rally.
Par for the course for chips, though, right now. All the CEOs are saying that, which to me is like probably some better options out there than on semi.
And companies are saying that, and their earnings and bottom line and top line are beating, and they're growing, and they're maintaining their guidance.
That's what I'm saying.
This was a miss. I mean, like, to me, numbers are all that matter. You can say you're the greatest company on earth, but if you give disappointing guidance, I mean, numbers are numbers.
Seems like the market basically is giving the longest leash, without question, to chip makers. I mean, like, bar none, right? That's kind of your baseline assumption. If you're generally in the category, it takes a lot to disappoint at this juncture. You know what's kind of the best auto-connected trade right now? General Motors.
Well, GM had a great quarter. Yeah. And remember, they were trading at what? Between a 4 and a 5 PE when their earnings came out. So, yeah, it's actually a pretty good comeback story. But people don't trust GM yet.
Well, it's up 50% in the last, 3 months, whereas everything has been getting pressured elsewhere in cars. Tesla made a fresh new low today, but it did bounce back. We're at $180 right now, but it was getting smacked around pretty hard earlier. We were down below 175 at one point. So, all right, that category, we're going to talk some thematic investing with BlackRock here in a sec. So that theme of autos, especially EVs, is a pretty big disappointment. Right now, things connected to it and clean energy are disappointment. But, you know, when NVIDIA and all the chip makers get bought no matter what their earnings show, it's like you can't keep the market down. At least not the NASDAQ.
Can't keep and when Nvidia's up almost 4%, it's hard to keep the market. And Apple's up. I mean, Apple's up about 1.5%. There's the strength right there in those two names.
Think people liked all the Vision Pro stuff over the weekend? Did you see all that online?
I did. I watched about a 2-hour documentary on someone reviewing it.
Yeah?
Yeah. And so the overall takeaway is it's heavy. Is that your spatial awareness becomes disoriented because the thing weighs so much. But I mean, it looks really cool.
I have a feeling I know how Kevin Hanks feels about it.
Actually, in small doses, I think there's probably something you can do. Think about watching a movie on an airplane with one of these.
Right.
Probably okay.
Yep.
I saw a clip of someone standing courtside in an NBA game with one of them on. Okay.
That looks
the
cool.
The clip of them getting hit in the head with a basketball is coming down the pipeline. Or run over by a player or something.
Yeah.
That's going to happen.
Yeah, I don't really saw the video of the guy skating around with it. Well, what is that?
I'm more like the huge screens. Like you can make projectors in your own home. With
We're at the 200 now on the SPX.
Sphere killer. I think you guys talking about the Sphere.
We're at the 200 on the SPX. SPY, same thing. Above the VWAP. I don't know why I got out on here. I ain't out of it yet.
Every day. It seems everything in the chip making space gets a lot of forgiveness around earnings right now, if they're even vaguely connected to this theme. How do you guys figure out what's actually going to change for companies?
There it is, the 200.
Based on the information we've got right now from a few big products.
Well, I think there's two things to look at. One is at the top of the AI stack is really thinking about what are the applications that are being built using AI today. So actually going back to autos, we're seeing more and more cars starting to integrate AI into how you interact with them. We're seeing a lot more software developers integrating AI, either on the programming side or in actually the product they deliver to the end client. So we're seeing users of AI really grow. I think at the other end of the spectrum, though, is trying to identify what parts of the market are overlooked. And as much as the Magnificent Seven was up last year, about 100%, digital infrastructure, which is where all this AI is happening, was basically flat. And so that shows us that there are parts of the AI ecosystem that have been just completely ignored by the market and still could have a really great bounce as fundamentals catch up.
Seems like right now, based on a survey you guys did, we'll pull up that pie chart again here, that for the most part, it's about cost savings right now. It's about efficiencies. That's in the green, 60% of respondents. New revenue streams, that's kind of interesting, 30%, so some new products. I thought it was kind of funny that there's 6% that don't really have a strategy for AI. But does that mean is the implication they're adopting it anyway, though?
I think they will soon. I mean, the reality is this is a This is an unstoppable technology at this point. I think you either have to decide if you are going to use it or at least be very intentional why not. I mean, you see in the green right there, a lot of CEOs view this as a way to get more efficient. And in a more difficult economy where companies want to make sure they're spending dollars the right way, if they can continue to grow the top line and do it with AI as kind of a new product or service, or if they can get more efficient, I think that's absolutely what's going to drive decision making here.
So where are we at in the build out of the hardware, the picks and the shovels to the mind-blowing applications? So far, it seems like a lot of the LLM stuff, ChatGPT is our main product. Microsoft's got its assistant coming out. What else is flashing on your radar?
Well, we talked about digital infrastructure. I think this is really an overlooked segment within the AI stack, which is just literally where are all these chips being housed, being cooled, being secured. That has to happen in the real world, and these companies have largely been overlooked. That's identified by our IDGT ETF. Semiconductors, although you've seen a lot of activity in the GPU manufacturers, those really cutting-edge chips, the Ferrari of the semiconductor space. What's been a little bit more overlooked is the CPUs, the kind of more run-of-the-mill general central processing units, which as we do more AI, as there's more calculations, as we get more efficient at it, we'll actually transition to the CPU space as well. So you can really see a broadening of this AI rally beyond the Magnificent Seven to other segments of the market, especially in the semiconductor space.
What was the ticker you gave there, Jay?
IDGT is our digital infrastructure ETF, and that's really looking at where is AI being housed, where is the physical real estate where AI is happening around the country.
Is that different from like the cloud real estate where all those data centers got built up?
So it's similar. It's where a lot of the cloud and AI is happening. The reality is cloud and AI are intrinsically linked because at the end of the day, the fuel for AI is data, where data is being collected and stored. And then you have all the processing power that's going on beyond that. But if you look at the digital infrastructure space,
Meta just fell back to
the amount
support.
of space that will be needed by 2030 will basically have to double from today. And maybe some misconception is that this happens in the cloud. It doesn't matter where
Meta.
it's happening. The reality is, if a lot of AI demand is coming from cities in New York and San Francisco and Chicago, you name it, you actually want a lot of that processing power to be located very close to where it's needed. So real estate does matter, and there's a lot of specialization that you have to incorporate around cooling the chips, around providing the right security, around co-location with other data providers. And so when you add that all together, digital real estate is actually a very valuable property these days.
I do wonder, given the overlap, if there's so much overlap with the forces and the companies and the build-outs that were necessary for the cloud domain to prosper during COVID, will these companies benefiting from AI already kind of have pumped up valuations lingering from COVID? Some of them have come back really hard, and some of them got to such exorbitant valuations during COVID. Is this going to be a force to be able to push them above that, or what do you think?
Well, I would separate the SaaS providers, the software cloud providers, which did see very large run-ups during COVID. I mean, imagine companies that deliver remote video services versus the actual real estate where that cloud
I'm
is
thinking
happening.
real estate.
And yes,
I'm thinking like those big data centers and big foundational REITs and stuff that were real popular back like 2017, 2018.
Exactly. So those are what's coming back. I mean, largely it was flat last year, so the market didn't really make that connection yet. But when you look at the supply and demand, this is one of the challenges for AI. There's so much demand for AI that you start to see these bottlenecks in the value chain. And one of the bottlenecks is who can build GPUs faster? Can you get your hands on the chips? But even if you get your hands on the chips, where do you host them? That's an issue in the supply chain right now. So there's a lot of ability to build new real estate or to charge more for existing real estate if you can house all of this processing power in an efficient and in a very good location.
Okay. The other thing you guys are thinking about right now, I want to make sure to talk about, since we've got the inflation conversation in the background, is the supply chain companies, a little tech connection here too, a little disinflationary force. What are you guys tracking in this regard?
Well, look, we're continuing to see supply chain pressures. It's changing, it's evolving as we see, different relationships with different countries forming. But right now, one of the ways to remain insulated from whatever happens across the world is to look at more domestically focused companies. So what we really like is IETC. These are companies in the United States that predominantly develop their technology in the United States, hire in the United States, and sell within the United States. And that kind of insulation means that if you see supply chains being disrupted, if you see anything that would really slow down global trade, these companies will be less impacted than normal. Why is this important for technology? Well, technology is one of the most globally integrated sectors in the world. Just on a sales perspective, U.S. technology companies do about 60% of their revenue overseas. So in boom times where supply chains are working well, that can be a tailwind, but it can also be a headwind if you're starting to see supply chains slowing down, which we see right now.
Pretty big tech focus, some of the consulting firms in there too, but you're going to get a pretty big overlap with the Mag 7, I would assume.
You do, but there's more nuance in the weighting. So we're down weighting companies that are going to have more of that global exposure, either from kind of where they're getting their products from or where they're selling their products. So this is more akin to looking at kind of a broad tech sector and tilting the weights towards those that favor really the United States in terms of geographic exposure.
Got it. All right. Cool stuff. Thanks for the update, Jay. Appreciate the deep dive into the funds. Always good.
Thank you.
Sure thing. Jay Jacobs, U.S. Head of Thematics and Active Equity ETFs at BlackRock. All right. A couple new tech-focused funds. Zooming in on some of the specific developments and new iterations of tech development. When we come back, we're going to take it down from the tech a little bit, talk some burgers, talk some tacos, burritos. A lot of restaurant earnings on the way. Mickey D's off to kind of a down throughout the session today, lower by about 4% right now.
Today's coin just had a new low or close to it. Double bottom for sure. Humana down again today. 357.39 is what I have. Tesla, I think we're going to drop more. We broke below my 181. I got 160 on here. We've kind of got a gap. We're falling into the gap, so the pivot point right around 171.78, 171, 172.12. Right there. 72.78 to 167.76.
about this narrative that grocery prices came down, so people aren't going to go to McDonald's as much? I mean, is it that big of a trade-off?
That's a problem. That, in my opinion, is the challenge that most restaurants will face in 2024 because cost inflation is slowing, and that is a benchmark that a lot of restaurants will use, and that the price premium, let's say, for dining out becomes a little bit more visible. And so with a company like McDonald's, the good news there is they can lean into their value component of the menu. That's already established. They can do bundling exercises. There are all kinds of options to move the consumer around that menu and keep them engaged. But management, again, did mention that the lower
double bottom, baby,
is stressed, and we would expect going forward that same-store sales trend is going to decelerate. I think investors have to be prepared for that, meaning we're coming off of these high single-digit, low double-digit same-store sales trends that have been reported post-COVID. We're now going to target 2 to 3%. We're expecting 3% in the U.S. for 2024, and we think that is a good level of performance for McDonald's given where they are and where the economy is.
Okay. Now, would they have to cut any prices? When you say lean into the value side of the menu, does that means it seems like they're not going to be able to cut anything else?
No, we're not expecting discounts. This is where the marketing effectiveness of McDonald's can really come into play. What we expect them to do is to innovate on the menu. They've done a really good job of coming up with product innovation. We saw, in the past they had the adult Happy Meal. They've had some celebrity endorsements. So if McDonald's can lean in to what's on the menu with the type of bundles and products that already exist and repackaging them in a way that's not only attractive to the consumer but affordable, I think that's where we're going to see the secret sauce, so to speak, drive this profit model going forward.
All right. How about two other stocks here real quick? It seems like you've got higher hopes for Jack in the Box, trade at 77 to get closer to its old highs in the 90s than you are for big gains in Chipotle, where your price target's pretty close to where it's at right now.
Yeah.
How come?
Chipotle has done a really good job of executing pretty much since the new CEO took over back in 2018. So this is just a solid play, in my opinion. So Chipotle has done a very good job of leveraging their digital platform. They continue to execute with really nice mid to high single-digit comp trends. We expect that to continue going forward. They're accelerating unit growth, but we think a lot of the good news is already baked into that valuation. We still have a buy on the company and expect a good report out of them tomorrow, but nevertheless, as far as a momentum play, they're coming from a strong base, and they will continue to execute on a strong base. The way we're looking at Jack in the Box is this is really a turnaround opportunity as they really try to reposition the brand for growth. We've struggled with the concept of Jack in the Box and Del Taco driving growth in the United States, but we're starting to see green shoots. We're actually starting to see instances where these new expansion markets are working quite well. We've got feedback in 2 new markets where Jack in the Box opened stores in Salt Lake City and Louisville. They're way outperforming the average weekly sales volume we see in their core market in California. And we think that's going to lure new investors into the brand. It's going to be a long-term growth story that is going to require cost discipline, but they've got a new CFO on board at Jack in the Box, and I think that he's coming to the table realizing, appreciating how important it is to manage financially this company as well as to drive innovation and really lure new investors to grow the business as well. And based on valuation, we believe that the Jack in the Box has been trading at historically low valuation. So there's a lot more upside for this company to spring forward relative to some of the other brands that have just been performing exceptionally well for so many years. So for Jack in the Box, it's a little bit of a turnaround and the opportunity ahead. With Chipotle, it's just really consistent, strong, industry-leading performance at the double-digit levels that we think explains why investors have profited so much from Chipotle over the past couple of years.
All right. Like it. Okay, so a little bit more kind of baked in already to Chipotle. I can get that. The stock's been going ballistic for a long time, even though their earnings always seem to come up perfect. Jack in the Box maybe got some more room to impress and surprise. Thanks, Jim, for your time as always. Always like the good
You bet. Take care.
On food. Good stuff. Jim Sanderson, North Coast Research. Options when we come back. Rick Ducat's on deck. He's got some interesting trades for us. We're going to be looking back at autos with Ford, keeping up the Pharma Talk with Merck, and then a little revisitation of a regional banking category.
I remember when I first started flying, and we would experience
Mr. Rick Ducat joining us here, the Chart Master. Let's start with Ford. We've been talking a lot of autos, a lot of chip-connected themes in the auto sector, but one of the best-looking charts, I think, in the whole group is General Motors. Ford, not quite the same. Even within the legacy players, Ford's kind of an underperformer.
Yeah, I feel like Ford has just been going sideways for the better part of 2 years or so here.
Yeah.
So, interestingly, we are centered mostly around the $12 mark or so. And this trade caught my eye because it was a relatively large number of contracts here. Maybe not large relative to the total size of this options market. Like, I think we're about 320,000 total contracts traded today. But this trade, minus 6,000, March 15th, 13 strike calls at a 17-cent credit. And remember, we have earnings tomorrow on Ford. That's why this one caught my eye in the first place here. So a short call, 39 days to expiration. So not necessarily an earnings play per se, but we are probably going to be expecting some movement in this one here. And the interesting thing is that there was another trade that was placed at the exact same time, exact same amount, exact same expiration, minus 6,000, March 15th, 15 strike calls at only a 3-cent credit. So they're kind of
selling a bunch of calls?
Selling a bunch of calls, going for relatively low amounts here in terms of credit received here. So probably these are covered calls. You know, these are probably an existing stock position that they're looking to generate some premium based on the elevated, options volatility that's taking place before earnings here. So,
earnings hedge maybe.
Yeah, or an earnings hedge, exactly too. So worst case scenario, you sell at a profit. The stock goes up and you just are assigned on the calls. Best case scenario, you keep the shares and keep the profit. So. About $102,000 for this one, max profit. Our other trade, only about $18,000 here for max profit. So definitely an interesting trade. Downside is you cap your potential gains. That's the only negative part of the rather conservative covered call strategy.
Doesn't sound like they've got a tremendous amount of hope that this is going to be a blowout bullish quarter for them.
Well, I mean, the expected move for this option series is about $1.30 here. That would put us right at 13. So that would be the outer edge of the move. Basically, kind of the opposite of a YOLO trade, I guess you would call this. This is a rather conservative, low-risk type of trade here. So, and you don't really have juicy premiums on blue-chip dividend-paying names like this very often. So a covered call around earnings, that's a sensible way to generate some premium or collect a credit.
Okay, all right, interesting. So pretty volatile expectation for Ford for earnings. $1.50 move.
Yeah.
So for an $11 stock, pretty juicy expectations. Okay. What about for Merck? Let's talk pharma because it's had two big moves just in the last 6 months. Earnings were a catalyst to the upside. This sector of healthcare finally seems to be getting some, I believe, delayed and love because there's a lot going on here. And recently, these are all rallying again, basically.
Yeah. Cantor Fitzgerald reiterated its overweight rating on Merck today, 135 price target. They kept the same here. Merck is also acquiring the Marine Life division of a company, ticker ELAN, Elanco Animal Health.
Yeah, Elanco. Yeah, we have a CEO on a lot.
Yeah, definitely. So $1.3 billion in cash transaction here. But, an interesting trade on this one today was it was very large. It was plus 11,260, April 19th, 130, 135 call vertical at a 181 debit. So I look for three things when I'm doing this segment here. The number of contracts traded, the dollar amount of the contracts, and for the size of the trade relative to the total market. This one checks off all three boxes here because the trader put on this trade for about $2 million. That's the total risk here. Max profit, $3.5 million. So these are some pretty big numbers we're throwing around here. Break even at expiration, 131.81, about 4% or so to the upside. Expiration April 19th, 74 days here. So, consider this. The total size of this trade when you factor in the long and the short legs, 22,520 contracts. Total options market at the time I checked, only about 40,000. So this single trade was like 56% of the market or so. So very outsized relative to what you see in terms of options volume today here. Interesting and noteworthy, I would say.
Yeah, good story too with it. So really interesting options activity, number one. Then number two, interesting story. So good for your salmon and your seafood diet.
Yeah, there you go.
That's because that's one of their things they do at Elanco. They make stuff that keeps the salmon healthy.
Interesting.
So then we can eat them. It's a great system.
Yeah.
All right, last trade you got U.S. Bank and the regionals. Seems like there's still a little hangover here. The shares are down almost 2% right now.
Yeah, not really specific news on this one today, but it's kind of caught up in that whole regional bank meltdown situation.
KRE's down 1.5%.
Yeah, definitely. And, notable once again for my three criteria. Large contract size, minus 9,000, March 15th, 37.5 puts, and a 61-cent credit here. So, max profit would be about $550,000. So nothing to sneeze at. That's a hefty credit here for this type of trade here. And also, once again, a large amount of contracts relative to the size of the market here. This 9,000 lot trade was roughly 50% of the total options market, only about 18,000 total traded. So it's kind of like you're being a detective with this segment sometimes. You look for these outsized trades, you look for someone who has real conviction and they're putting on this trade here. Potentially you could follow suit. You could put on a similar trade here if you think perhaps this person is onto something here. But, a short put, kind of like a covered call in that it's low risk as long as it's cash secured, as long as you have the cash necessary to buy the shares, if the equivalent amount of shares if you get assigned here. If it's a naked short put, that's a different story. A naked short call, naked short put, those are quite risky types of trades here, not necessarily something that would be suitable for everyone here. That would be a dangerous situation if it goes against you because basically unlimited potential losses. A short put, naked, it can only go down to zero, so theoretically it's not unlimited, but max loss would be $33 million or so. That would be assuming the stock goes to zero, and the reverse situation for a naked short call as well.
Yeah, it's going to hurt if stock crashes more. So it's a pretty bullish, optimistic trade, basically.
Yeah, definitely. Neutral to bullish here. Basically, it's more of a soft target when you sell a put here. You just need it to stay above your break even, which is 36.89, only about 8.5% to the downside. So a pretty nice cushion on this trade here before you get to the danger zone, so to speak.
Okay, nice. Thank you, Rick Duquette. Good eyes in the options corner today. Appreciate it. When we come back, we're going to talk some commodities. Pretty wild action in the commodity realm. We'll give you the scoop on that. We're also going to talk Boeing, give you the latest there in the developing story of their mess. Plenty more ahead here on Market on Close.
Accelerate your market knowledge
and shift your perspective into full gear.
BYD, man, it's really took a hit. Buffett's.
Geopolitical risk coming out of that part of the world too, West Africa. At the end of the day, there's more demand than supply, and that's the one law that no politician can fix. And so you've got cocoa at the highest prices since 1977.
Wow.
Yeah. So
that's a lot of expensive chocolate. $5,000 a ton. Jeez.
Yeah. So now, this is like lumber. Remember lumber back during the pandemic when lumber blew up? Eventually, when supply catches up with demand, it corrects, and I guess the nice word would say it would correct horrendously. At some point here, it's going to go down. You know, we go up the escalator and we go down the elevator shaft. So somewhere looming out there, you know, when the last person gets long, when the last young commodity trader says, "Oh, this is my retirement trade," will probably turn. But right now, the volume has tripled. Generally, cocoa is not something, it's not as liquid as like you're trading bonds or trading mini S&Ps. So it can be kind of thin. Sometimes these
that's some expensive chocolate.
Roach Motel, you can get in, but then you can't get out. But right now, it's certainly an opportunity. And, you know, in a sea of commodities where a lot of commodities aren't doing very well, this catches people's attention because most people psychologically like trading bull markets. It's just something that human beings like to do. That, you know, anybody that's in the business for 20 or 30 years knows that bull markets are the most volatile, the most participated in. People don't like bear markets. And flip side, that's what we've got a lot in the grains here. We've got 3-year lows in corn and wheat. We've got 8-9 month lows in soybeans. So people are coming to this because it's moving and it's a bull market.
These commodities that have kind of limited growing regions are very susceptible to weather shock, right? Like even like they're like a more extreme. Oranges do it too, OJ, but cocoa is one of the most extreme. Cocoa and coffee, but yeah, cocoa too. So I guess it's too dry, it's too windy in West Africa right now. Apparently they can't get the cocoa.
High winds. Yeah, and you know, when this happens, people come up. You have a million reasons. So success has a million fathers. So blame it on El Nino, blame it on 3 years, blame it on. At the end of the day, you've got people, and then you bring in the chart traders who just like momentum. They're looking at this like they might as well be trading GameStop, right? It's just it's making new highs. Let's get long. You get into that type of frenzy, and that famous saying, markets can remain irrational for quite some time. But when this thing corrects, and it will, a lot of money's going to be made on the downside. I can tell you that. But guessing when that's going to be, that's the thing with commodities. Commodities don't trade like stocks. When commodities turn, they turn. And so, yeah, you've also got, I think we're at 10-year highs for sugar. Again, a very weather sensitive market. We just had a huge move in OJ. Again, very weather sensitive. And those markets, when they get very volatile, the liquidity is not always there. You see it in things like cotton too. They call cotton the widowmaker because, again, sometimes you get in and then you can't get out.
Yeah, man. Wild stuff. Going to be an expensive Valentine's Day. Going to have to spring for the
I'm sure
plush bear, I guess, instead.
Any excuse to be, this box of chocolate was $2.
Sorry, hon. Yeah, sorry, babe. It's $5,000 a ton. Not my fault. Hopefully it's transitory. Right. Hopefully it's transitory. All right. Thanks, Chris Robinson. Thanks. All right, nice phone. Cocoa, another 5% today. Wow. All right. Let's bring in Renita Young for a developing story. Checking in, unfortunately, once again, with Boeing. I think every hit, I'm just going to begin this with what this time, Renita?
That's, I bet, the same thing that CEO Dave Calhoun said when he heard that Spirit AeroSystems found another flaw in the 737 MAX airline family. Now, reports say today that the Spirit AeroSystems folks found 2 holes drilled in a window frame, which may not have been drilled in line with some of the requirements from Boeing on some of the 737 MAX airplanes. And right away, the company said, listen, this does not pose an immediate flight safety issue, and all of the 737s can continue flying safely, but Boeing's going to need to do more work on 50 of its undelivered planes, and that could delay some near-term deliveries and impact Boeing's production schedule. And Boeing's planning on devoting what they call factory days this week to catch up so that they won't be too far behind schedule on delivering these planes. And they're not, however, sure just how long it'll take for them to do this, but they expect to find that out pretty soon. Now, meanwhile, the FAA is expected to give some initial data, some initial findings into that Alaska Airlines flight that saw the door plug fall off last month. And they are coming off of this time of enhanced oversight into Boeing's quality controls that it started last month. Now, they've been observing work across 737 MAX assembly lines in a factory near Seattle, and they didn't comment on any findings to date yet, but they've said about 135 of 144 MAX 9 jets operated by United and Alaska have now been inspected and returned to service. And after those findings come out, by the way, whenever they do, the Federal Aviation Administration plans to use them to reimagine how it oversees aviation manufacturing.
Okay. So they are still mired in this pretty deeply. It's got to start affecting the financials, I would think. I mean, too many delays, too much extra work, catch-up days, factory days, all this stuff.
All of that is going to be factored into just how much it will cost Boeing Airlines. Now, if we talk about it, Alaska Airlines, they haven't come out with an amount that it's going to cost. However, Alaska Airlines has filed a $150 million suit against Boeing. They want that much in compensation from Boeing for having to ground its 737 MAX 9 fleet, for having to spend money on overtime for its employees, for also having to reaccommodate passengers and issue refunds, as well as issuing that $1,500 one-time fee, or not fee, but giving that much to each passenger on the plane. We know that Boeing has already lost billions of dollars in market cap. We still have yet to hear what United may do, but we can imagine they may want some sort of compensation as well from Boeing for this situation, since they lost probably around the similar amount. But this is also as different class action lawsuits come out from these passengers claiming the intense physical and mental strife that they've had to endure since then.
Wow, okay. Yeah, definitely not the last of the story. So thanks for the latest in the update. Appreciate it. Renita Young in the Schwab Network newsroom coming up. Let's close out the market session with our big picture discussion with the team at Charles Schwab. Don't miss it. 10 minutes left. NASDAQ still close. Very, very close.
I was born on the south side of Chicago. It has been a long road, but now I'm working for Schwab. I love to help people understand the world through their lens.
paid jumped to the highest level in 11 months, and it was a noticeable uptick when you look at the chart. That's a bit concerning when we're trying to, determine how quickly and make sure that inflation is returning to that Fed's 2% target. But also a lot of other things. Employment jumped in line with the stronger jobs report last week and new orders. So altogether, it was a strong report. And for a while, we've had this gap between the soft data or survey-based data being relatively weak, and then strong hard data. And now they tend to be meeting in the middle, but more because the survey data is improving. So if anything, it looks like the Fed's going to be paying close attention, could push back the start of the rate cuts even more, but we'll see as the next few months progress.
All right. Yeah, that ISM prices paid for services, pretty warm. Manufacturing prices paid too. I mean, any reason why we should ignore that, Colin, to follow up on that point? I mean, pretty good indicator generally of kind of the direction of things, is it not?
Now, they do. I mean, ISM are very important surveys, and I know that Fed officials are going to look at them. They do focus more on the hard data, but I think this goes in line with comments that Powell made last week and last night on 60 Minutes, where he's talking about the patient approach, just to confirm that inflation is, in fact, moving lower. I mean, all the data appears to be very good right now. The Fed is happy with the data. They don't even need to see necessarily an improvement in it. They just want to make sure that it continues. And now 1 month doesn't necessarily mark a trend with either of these ISM indices, but it's certainly something that we're going to be paying attention to. We've already basically taken March off the table for a rate cut. That buys us even more time as we get closer to May.
Okay. Michelle, has there been any notable adoption of the Powell tone in any of the global bond markets or central bank indications?
Well, we started the year with really high expectation for rate cuts, and that's globally. Since then, economic growth has come in better than expected. We had global manufacturing above 50 now, first time since 16 months of contraction. Services also improved as well. And inflation has ticked a little bit higher as well. Input prices in the global manufacturing PMIs ticked slightly higher. Output prices have moved sideways and global services have edged lower. But, markets just got a little carried away with those rate expectations. And as Colin noted, they just want more data. Central banks want more data and more confidence that inflation will continue to moderate before starting to cut rates. We're seeing interest rates not only higher here in the U.S. today, but also globally, but not quite by the same magnitude.
Okay. And the calendar, what should we be looking for, Michelle, as far as the rest of the world? What's the event this week to watch for?
Well, this weekend we have the Lunar New Year for China. And, the economy there is weak, expectations are low, and those low expectations have kind of taken on a life of their own by kind of creating a downward spiral of reinforcing cautious behavior. There's been rumors that more measures will be coming before the Lunar New Year and before the big policy meeting, the National People's Congress on March 5th. But we really need to see them follow through with some bold measures. If they do, they could produce a big rally in Chinese stocks because they've rarely been this cheap. But how long that rally lasts will really depend on whether or not policymakers show a determination to follow through with, some meaningful change.
All right. A little bounce in Chinese stocks today. 2%. Got to start somewhere. Thanks, Michelle. Thanks, Colin. All right, when we come back, we've got some earnings. We're going to take a look at Pharma with Vertex. We heard the bull case for the stock on Morning Trade Live. We're going to follow up and take a look at the company that has continued to broaden out its offerings in the biotech world. But we've also got more chips, too. We're going to be looking for NXP, which has been a bit of a laggard in the semiconductors category, but it's pretty close to multi-year highs. Anything could happen. Be right back. We got more ahead.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. She
She had a lot of questions when she came in. I watched my mother go through being a single mom. At the end of the day, my mom raised 3.
Ew. That's it. Well, today was definitely a market correction day. It didn't seem very stressful though, as other days that we've seen. I still think we're at a point of irrational exuberance, and we do need to consolidate. They've said it a couple times on here today. It's very healthy. There's a lot of stuff being sold here on NVIDIA. NVIDIA's hit that resistance high in the channel. $700 would be the magic number. I try to put on SMCI. The SPX was just wonderful to trade again today. Here we pulled back down to a triple bottom into close. Nailed the bottom in here today. I mean, this was beautiful. Called right here, then called right here, and boom. First thing out of the gate, a little trade. Looks to me like an expansion pattern here, I just now noticed. One guy said we'll see a lot of volatility into next earnings. I don't think earnings were that good. A lot of concentration on the, you know which ones, the Magnificent Seven. Tesla pulling back. So I'm going to get out of here and relax. And we'll see you all tomorrow. I think that's about it. Thanks for everybody's participation today. You know, for anybody that's having trouble learning how to trade, I mean, it's easy to follow me in these SPYs and SPXs. You can learn a lot about charting. It's like this trade right here, this double bottom came in. Pulled right back to a double bottom, boom. Inverse head and shoulders, triple bottom more or less, kinda. I think that's all I really need to trade. Entertain myself and trade the SPY and SPX and the QQQ and IWM. However they come out in the morning. They're the easiest. But it's good to see some of these pullbacks. We need it. We'll catch y'all later. Thanks a lot.